We'll certainly see how this all shows up on the index level. As Val said, futures are pointing lower. It is going into a weekend. Fairly normal to have a risk-off kind of day, but it's also been a pretty risk-on week. As Val pointed earlier, where does that leave the opening trade? Well, it's time to find out. The FTSE 100 right out of the bat, kind of waffling around at that 0% level. We'll see if it starts to sell off as futures had initially indicated. This is going to be a crucial one as well, because as you mentioned, Tom, we are talking about BP and the likes of GSK as well. That is all going to show up in how the FTSE 100 trades. And right off the bat, a lot more weakness when it comes to the continent. The Stock 600 down about 0.2%. The IBEX really taking it on the chin there, down about 0.4%. So seeing some pain, seeing some risk-off stories. I'm going to just wait for the CAC 40 to open as well, because that's going to be a key piece of this, down 0.4%. But then I look at that move from the DAX right out of the gate. We didn't even have to wait till 8:03 for that to hit, down 0.5%. And I feel like when the DAX opens that quickly and down that sharply, Val, right off the bat, it suggests some sort of retracement from the gains of the week.
Yeah, let's take a look at the sectors on the move so far in this morning's trade. We are seeing consumer products, the worst performing sector this morning, as long as retail and technology, media, travel and leisure, and auto parts also joining that. Maybe some of those tariff-exposed sectors also taking a back foot. We do have one sector in the green, that's insurance. So it's fairly looking like a risk-off day so far this morning. Tom, any single stocks catching our eye so far?
Well, we touched on the BP story with a look ahead to Q2. So that stock is up 1% right now. So the oil trading business looking like it could be performing quite well, and production set to increase. Of course, we have the broader macro picture of softer oil prices generally. But nonetheless, in the session today and in the first few seconds, BP is up 1%. Bruno Cucinello, we're talking about that story with the earnings coming in line with the estimates, but seen by the analysts out there as positive given the broader environment. So that stock is up just 0.6%. Some of the individual names on the move, nothing significant on that front. Let's see at GSK as well, because we had that Delaware ruling and we talked about the Zantac story around that. It's been long running, of course. GSK largely unchanged so far on the FTSE 100, of course.
I think it's a day where heavyweights are really selling off. You look at the biggest contributors to the downside, LVMH. On the surface, it just looked like a rotation of what we've seen this week. So let's see if some of this price action continues throughout the session. In the meantime, I want to get a little bit more analysis this morning. Patrick Armstrong joins us, Chief Investment Officer over at Plurimi Wealth. Patrick, pleasure to have you. Thank you for joining us this Friday. Jamie Dimon says there's complacency in this market when it comes to the tariff threat. We've seen it. We've seen volatility barely compressed despite the tariff threats increasing. Does that make sense to you?
I'm worried I'm complacent because I am looking through it a little bit. There's threats all the time. We've seen what's happened in April, put in place, pulled back. So it's called the taco trade. I do think that continues. I think extreme threats are put in place and then walk back to more moderate views. I don't think the policy is good for growth, but I don't think the extreme tariffs, 20% blanket tariffs cross, will end up happening. And if they do happen, they're short-lived. So I'm potentially complacent myself, but I do think that's probably the end game for where we get to.
Well, talk to us about then, what is that red flag to you? What do you think there's that line in the sand that says, okay, maybe I need to do something here?
Yeah, you have to call his bluff almost at this point. You've got to wait to see if they do stay in place. And markets punishing Trump get him to change his mind, is how I feel. So I think you've got a self-correcting mechanism with bond yields and equity prices. Trump won't want to cause a significant recession, a long-lasting recession. He may be able to handle a short recession, but a bear market and a spike in bond yields, it's not palatable to him, and that will normalize his behavior, I believe.
Yeah, Patrick, that sounds like he's going to be more emboldened by the S&P 500 reaching all-time records yesterday. I mean, he could possibly go further with universal tariffs, sectoral tariffs, these tariff letters he's sending out today. Is that the kind of impression you get?
He may think everything is good and everything he created, the storm he created in April is now past, new all-time highs. But, yeah, the market will react to tariffs if they are put in place and they have teeth that are long-lasting. I think you would see another correction and probably moderation of policy. I don't think this is a winning policy. I'm not sure he views it as that. I still think this is, unfortunately, in the opening gambit type thing where he was hoping to provoke a wave of trade deals from April through August. It's not happened, and I think he's hoping this will be a catalyst for that.
Okay, what do you, I mean, at least the one country we've not gotten a lot of news out on is the EU. Seemingly, we're inching closer to a deal, but then Trump told NBC News yesterday that the EU might receive a letter today. Where do you stand on those negotiations? Do you think it's impactful? Are you following the story?
Of course you follow this story. There does seem to be progress made, but yeah, at the last minute, Trump can send that letter and hope that's a catalyst to finalize a deal, but it can have the unintended consequences of making a deal fall apart potentially as well. So it's something that's a risk. It's something I expect will actually happen, but I don't think there'll be a long-lasting effect from it because I think that will provoke both sides to get to what will end up being a deal.
Patrick, you still think Europe outperforms the US this year?
I do, yes.
What kind of deal derails that assumption?
Well, a deal wouldn't derail it, I actually think. I don't think the EU would do anything that's punitive to their economy. I think the EU's got enough clout that any deal will not basically get rid of European manufacturing. The US will still have its big trade imbalance that they're trying to get rid of. I don't think that does end. But a no deal would maybe change that view, but I'm not sure it would. The parts of Europe I'm investing in aren't so much on trade. They're on German infrastructure spend, Heidelberg Materials. It's a boring cement company. It's not going to be derailed by trade. European defense stocks, these have structural spending ahead of them. Europe may be moving away from U.S. arms producers towards European ones in a trade conflict. So you can sort of be long Europe and not worry about the trade as much as it may on an LVMH or an exporting company like Pernod Ricard, those kind of things.
Where's Anna Edwards when you need that? She loves a cement stock.
Loves the whole thing.
Patrick, that's really interesting. There are parts of the European equity market that continue to outperform even if there's no deal, and that's interesting. You are also, though, at the same point, raising the red flag around inflation risks. And you're saying that's underestimated in terms of the inflation
definitely
story.
I just don't see any scenario where you get this immaculate decade that inflation swaps are pricing in, because we've got populist governments all around the West, and austerity is not being considered for the debt, raising taxes, the opposite's happening. So you need incredible growth. That's how you can grow your way into the debt. It's not going to happen. The White House says it's going to happen, but you're not going to get the 4% growth you'd need to grow your way into the debt. So it's a debasement strategy. That's the end game of populist strategies, is printing new money to pay off the old debt, and unequivocally inflationary. Everything Trump's putting in place, apart from deregulation, is inflationary. So tariffs, trade wars, real wars. There's going to be environmental issues at some points in the next decade that create supply chain disruptions, and the market's just pricing perfection. Fed's going to deliver its target, nothing to worry about, but there's so many forces creating potentially intermittent spikes, not maybe structural every year very high, but there will be spikes in the next decade. Market's not pricing that.
It's like when you have a long list of things to worry about and to do, you just don't do any of them, right? At least that's how I operate. Talk to us a little bit about, you made a key point here, that the Europeans are not going to do something that's punitive to their own economy. Yet you have a lot of central bankers who are really cheering on the strength of the euro. How punitive is a strong euro to an export-based economy?
True. That's if you're a central banker, that helps you deal with inflation very easily because you're not importing inflation, basically, because your currency is so strong. But the ECB has cut rates very consistently. You're getting monetary stimulus that's offsetting currency strength, and not sure how much is left in that, probably a couple more cuts, but the monetary stimulus is offsetting the currency headwinds, I believe.
Patrick, staying on monetary policy, you were just talking about how it seems like the U.S. is going for a debasement strategy when dealing with their debt. You combine that with perhaps political pressure on the Fed to keep rates low. I mean, that just smells of fiscal dominance. I mean, surely the market is going to take that negatively at some point.
The bond market should. The equity market, that's a hit because you're probably discounting future cash flows at higher interest rates, but it's also in the short term, it's a sugar rush. Everything that's populist is great in the short term, long-term consequences. And right now, the market's rewarding stimulus measures. Debasement strategies aren't explicit right now, but I do think the market probably responds to a Fed funds rate that's too low. That does stoke future inflation, but that'll stoke an equity rally as well.
So equities will rally even though the Fed is cutting just under political pressure. You don't see them taking it as a negative
Equities always rally when there's monetary stimulus. So if there's growth and monetary stimulus, that's a recipe for equity rally and a spike in longer-term bond yields, probably.
But, I mean, surely if inflation spikes off of that, say we've got political pressure on the Fed, they're cutting into what is maybe or maybe not persistent inflation, surely there's at some point the equity market breaks under that.
Eventually you do, because eventually you either have spiraling inflation or you get a Fed that behaves in line with its mandate and raises rates to counter the inflation that's being created. So the risk is you get a populist president who puts in an extreme dove as the next Fed chair, who does put the 1% interest rates Trump's talking about. So I doubt that happens. I think we've got some Fed people right now who likely will be the next Fed chair who are reasonable, but they are very dovish. So you'll probably have a bit too much monetary support. That the consequence of it's in the textbook. When monetary policy is too easy, it stokes inflationary flyers down the road.
Patrick, very quickly before you go, you own 4 of the Mag 7. NVIDIA is one of them. Do you take profit now? It's at $4 trillion?
It's not a bad idea. I'm not taking profit, but it is back to a lofty multiple. I wouldn't want to sell these companies going into earnings. I think you probably have another leg up on the results that come. Nothing's indicating a slowdown in AI data center spending, so I do think you'll see good results.
All right. The view from Patrick Armstrong, Chief Investment Officer over at Plurimi Wealth. We thank you so much. Let's get a quick check on the core 6, the heavyweights that tend to move this market. And red across the screen, you can see the biggest contributors to the downside actually in the Stock 600 are LVMH, are SAP. So it really tells you that a little bit of cash moving out of some of the outperformers of the week actually across the board. Pain on the screen. Schneider Electric, though, almost flat, only down 0.1%. So perhaps they're the exception to a fairly broad sell-off. Let's get a check on some of the other individual stocks on the move. Chloe Melly has that update for us. Chloe.
Good morning. So let's start with some companies with exposure to Canada. So Trump announced or threatened 35% tariffs on Canada, and that's having a little bit, well, at least at the open, it was having quite a bit of an impact on those companies that have exposure there. So Stellantis was down by about 2% at the open. It seems to have been bearing some of those losses. It has a lot of manufacturing facilities over in Canada. We've also got Siemens Healthineers, and then over in the defense space, Hensoldt and SAB are also quite exposed to the country. But so far, it seems Siemens Healthineers is the one that has really the biggest drop at 1.5%. Moving on to DNB Bank. So DNB Bank is the first of the Nordic banks to report this earnings season. It is down 7%. It reported a miss in net interest income. Obviously, the rates are coming down and really weighing on that key metric for banks. And that doesn't spell the best news for the other Nordic banks coming up next week. Then we have Norwegian Air. Norwegian Air is up 8% this morning. It reported operating revenue that beat estimates, and it seems like travel demand is really strong there. And then finally, to finish off today, we have got BP. BP is up 1.7% this morning. It said that it expects second quarter production to be higher than first quarter production, and that's really driving the stock this morning.
Chloe Melling from our equities team. Thank you very much indeed with some of the stocks on the move. Coming up, another week, of course, upended by those trade and tariff tensions. We're going to take a look at the top 10 companies to watch, though, in the third quarter. That report from Bloomberg Intelligence is next. This is Bloomberg.
Technology is embedded in every aspect of our lives.
And laying the foundation for the future.
From finance to defense, AI to entertainment.
And from the road to the stars. Bloomberg brings you the latest stories of the people and companies pushing the tech sector to new frontiers.
And the politics that shape global tech markets.
I'm Caroline Hyde in New York.
And I'm Ed Ludlow in San Francisco.
Watch Bloomberg Tech every weekday.
Only on Bloomberg Television.
U.S. jobs numbers are released. Bloomberg has the report under surveillance with crucial data and expert analysis at terminal speed. Nobody covers Jobs Day like Bloomberg.
Our global headquarters in New York, I'm Danny Berger. Welcome to Bloomberg Brief. Let's set your agenda.
Bloomberg Brief delivers the market news, data, and analysis you need. Live every weekday, only on Bloomberg. Context changes everything.
Good morning, this is Bloomberg Daybreak Europe. I'm Tom McKenzie in London. These are the stories that set your agenda.
Taking you from the U.S. market's close to the overnight session in Asia, we'll walk you through what you need to know to kickstart Europe's trading day. Live from our European headquarters, we bring you the day's top market-moving stories, unmatched expert analysis, and on-the-ground reporting from across the continent. Tune in to Daybreak Europe, only on Bloomberg Television. Context changes everything. Why do the biggest names in business choose Bloomberg Television?
That's a great question.
It's a very good question.
Interesting question.
Good question.
Great question.
I so appreciate that question.
You certainly ask interesting questions.
Bloomberg Television. Top experts, great questions.
Africa, a region rife with potential for growth and opportunities, but not without its challenges. Bloomberg highlights the biggest stories, interviewing key players, and reporting on the issues impacting the region. Join us as we get to the heart of African business, politics, and economics, and ask the question, what's next? I'm Jennifer Zabasaja, and this is Next Africa. New episodes every month, only on Bloomberg.
Bringing you up-to-the-minute financial news whenever and wherever it happens. I'm Michael McKee at the Federal Reserve, and this is Bloomberg.
Welcome back to the opening trade. About 16 minutes and change into today's session. Red on the screen across the board, except for the FTSE 100. I'm going to say virtually unchanged right here in London, but we certainly have a sell-off on our hands, even in the DAX, down about 0.6%, but perhaps just a retracement of the gains that we have seen throughout this week in this region. Let's talk about earnings season. It's right around the corner, and Bloomberg Intelligence is out with a list of the top companies to watch this quarter. Bloomberg Intelligence Director of Research, Tim Craighead, joins us for more. You've got 10 companies on your list.
Yes.
I'm not going to ask you to tell us all 10. What's your favorite?
Well, put these into context. These are 10 that we've zeroed in on that are a broader group, that are part of a broader group of focus ideas that we have, which are high conviction ideas that we think are differentiated, and we see catalysts ahead. These 10 all have catalysts coming up over the course of the third quarter. And that's why we've selected these things. By the way, for terminal folks, you can find it on BI Focus.
I'm intrigued. There's a number of consumer names on the list at a time of macroeconomic challenges, at a time when the consumer in the US, even the US consumer is feeling a little strained, tariff risk. What is the rationale for having some big brand consumer names on this?
So there's one underlying thread, and that's the higher end consumer that we do think is less susceptible to some concerns that are out there that are well-founded. Think Diageo. Stock has been under huge pressure. Their sales last quarter actually were much better than anticipated, and we think that will continue. They're actually coming over in a bit of an overhang, a hangover last year of inventory, no pun intended.
Like what you did there.
Yeah, there you are. Another high end that you wouldn't think about is Dick's Sporting Goods in the U.S. This is a sporting good retail shop, but they tend to go towards higher end demographics. They've got a big new store format that's accelerating pace. We think it's well positioned. Aston Martin's also high end, but we have a cautious view. Yeah. The high-end luxury sports car market is oriented more towards V12s. Think Ferrari, think Lambo. Aston Martin's struggling, and we think there could be a capital raise coming.
Talk to us about how tech is taking any center stage in your top picks, because it's been one of the key drivers of the U.S. equity market, of the global equity market rally. Is a feature in your picks?
Absolutely. And if you look at the 50 companies to watch in the year ahead, the last couple of years, they've been embedded with AI names. It's true this time, but in an unusual twist. We've got Cadence Design, which is software company that focuses on design automation equipment. So you use their software to design chips like NVIDIA and Samsung, who are both customers. So that's key. Another is one Keppel DC. You've probably never heard of it. It's an Asian REIT based in Singapore, which is becoming a bit of a hub for the hyperscalers and LLMs within Asia. This is the company that has the real estate where you put the AI data center. Really interesting story. Rents are going through the roof.
So you've named a couple of long-term trends. You've talked about the tariff threat, sort of. You've talked about kind of this wealth disparity with some of these names as well. Talk to us about how the financials show up and kind of bridging those two themes.
Yeah, it's interesting. So you think right now is really convoluted with central bank policy. You know, some central banks are lowering, some are raising. You look at banks, there's pluses and minuses. We've set that all aside, actually, with two names on the list. One is Capitec. This is South African bank, low-cost, retail-oriented, but they're taking their low-cost model and they're moving it into the small business realm and into insurance. We think they're taking share. Revenue growth is quite extraordinary. The other one that we've layered in on with financials is AIA. And this is an insurance company in Hong Kong. And it's all about Chinese moving wealth, diversifying wealth out of China, which they're using Hong Kong as a hub. And also AIA in reverse is expanding its own footprint across China, across provinces. So there's two growth drivers that take it out of the interest rate cycle story.
A fascinating one as well. We're going to keep watching these. It's interesting. You're not picking on a lot of the heavyweights, but we will keep our eye on that. Director of Research at Bloomberg Intelligence, Tim Craighead, walking us through his favorites. Tom, speaking of heavyweights.
European tech giant, SAP. Thank you for that segue. The recent growth has been powered by a pivot to the cloud, with the company leaning heavily into artificial intelligence, a subject we were just discussing there with Tim Craighead. Now a leader in that space. As part of the latest episode of Bloomberg Tech Europe, I asked SAP CEO Christian Klein if Europe does actually need to build more data centers.
You need chips and data centers when someone is consuming it. But, there is not, the same demand for these chips in Europe like in the United States, where you have a lot of companies, who need chips for training their large language modules, etc. Here, of course, when you now apply AI, develop software, develop, new AI use cases, of course, there will be at a certain point also a higher demand for chips and for data centers. But, now just focusing on the infra layer, on building data centers, I would predict there is for sure not so much demand right now. So you need to come also from the demand layer, from the top, from the software, from the AI layer, where, again, the ways is not decided yet. And then, of course, what that drives is then finally more demand for chips, but in that order, not necessarily just building data centers for the sake of building data centers.
Is the EU AI Act, is it a hindrance to our development of this technology or a catalyst? How do you see the regulatory environment when it comes to AI?
When I'm sometimes, talking in Brussels or in other, councils in Europe, the first topic is always regulation. And I wonder sometimes, can we maybe first talk about competitiveness and opportunities and how we use now AI to make our industries more competitive? And because then, when you are leading there, then you can ask also the question how to regulate. I mean, honestly, I don't see in Europe now so many AI use cases, who need now deep regulation so far. Now, regulation, I'm not against it. The problem with regulation and with the AI Act is, I would say Brussels come in with the absolutely right intent. They say, you know what, this technology needs to be regulated. I'm not against that, as long as you're regulating, business outcomes, and you also ensure there is a fair competition. I'm absolutely in for that. The problem here in Europe is they're having all the right strategic intent, but then they are putting this in place, but the member states, they just keep what they have. And then you're just adding another layer. Because then you have AI policies all over the place, and then they're overlapping, and the one data protection officer says that, the other says that. It's like going to 5 doctors and they tell you 5 times a different thing. And now you imagine you are a startup and you want to scale your technology, and in every country you are going in Europe, you hear a different story on how to adhere to any kind of AI Act.
And you can catch more of my interview, which is exclusive, by the way, with the SAP CEO online in this month's edition of Bloomberg's Big Tech Europe. Bloomberg Tech Europe. It is big. It's the biggest company, publicly listed company, of course, and the biggest tech company in Europe as well. Look, Christian Krein, really interesting. He has driven and led this company since April of 2020. When he first took over as sole CEO, he pulled the guidance, the 5-year guidance. The stock collapsed 30%. Since then, it's up about 170%. He's repositioned the business towards the cloud. He's lent into AI. There are big question marks about whether or not that can continue and can extend. It's pretty richly valued, this stock. He pushed back on Jensen Huang's idea that you need to build data centers and at pace in Europe. He says there isn't the demand for that, and that is a misallocation of capital. He says that's not the way and where we should be focused on Europe, which was interesting. And on regulation as well, he was clear. Look, you have this EU AI Act on top of the 27 nation members of the EU. And then on an individual basis, each country has their own regulations. He says that's a thicket of regulations that is preventing scaling of some of these AI companies.
What was behind his comment around data centers? It seems a bit off consensus, or maybe is he more focused on the higher energy costs here in Europe? His
point to me, there is the energy cost piece, definitely. He didn't land there. He landed on the fact that this is a huge cost, and there isn't the demand because we don't have the large language models that need those data centers to train. That's why you need the data centers in the UAE. That's why you need the data centers in the US, because you have Anthropic, because you have OpenAI, because you have what's happening with Meta. They need to train their models on those data centers. He says, we don't have that in Europe. We have one, Mistral, not enough to require all those data centers. He says the focus on capital spend should be around on helping companies build applications on the layer when it comes to AI. It's a controversial position, but that was the line he took.
Well, we'll see if it yields some, quite literally yields returns, but also yields kind of rallies the troops, it feels like, when it comes to getting some momentum in the tech space behind Europe as well. We're going to continue that theme in just a little bit. We're going to stick with that technology story and whether Europe can break its dependency on U.S. big tech. This time, the view from Amazon Web Services. Tanuja Randeri, who is the EMEA managing director there, is going to be joining us around the table for an exclusive conversation on where Europe stands in this broader tech revolution. Stick with us. This is Bloomberg.
Today's CFOs are reshaping the C-suite. Bloomberg's chief future officer shines a spotlight on these dynamic leaders.
What's the hardest part of being a CFO?
It's hard to come up with that.
It's the vast responsibilities, the need to be engaged in different topics.
It's remembering which audience I'm speaking to and what I can say in that context.
The job is not just being the executive of the finance function, it's being an executive for the company.
I would say it's prioritization.
Complete the sentence. The hardest part of being the CFO is
telling people no. It's hard. It's the right thing to do, but it's always hard.
So being just like a touch of a heartbreaker, basically.
Yeah.
We have a plethora of good opportunities. Some are really, really good, but as we strive for the great ones, sometimes those really, really good ones have to be left behind.
Chief Future Officer, only on Bloomberg.
Jumpstart your trading day on Bloomberg Open Interest.
2 hours of single stock stories that are driving the opening bell action. We'll take you to Wall Street, Main Street, the C-suite, and beyond.
These are companies that are growing their market.
The great companies in the U.S. are the companies hitting the cutting edge. That's a different story.
Get the inside track on what's buzzing in markets.
With the players who are shaping the narrative.
If you have bad earnings reports, you're going to get punished.
They're not buying what the industry is selling. Join us on Bloomberg Open Interest. Every trading day, only on Bloomberg.
Flood of investment agreements.
Deals were once again on display.
The Saudis are open for business.
The cessation of sanctions against Syria.
Another big victory for the Crown Prince. Concerned that not enough guardrails may be set up just yet.
Headline after headline.
Trust Bloomberg for on-the-ground coverage.
The numbers will be quite substantial.
Up-to-the-minute reporting.
Driven the price of oil down.
And the analysis you need.
He's basically going to vault this region into the same sort of sphere as the US and China.
No one covers geopolitics like Bloomberg.
At a time when policy in Washington is driving Wall Street, we draw a distinction between the rhetoric and the action, bringing you market-moving guests and original reporting. This is Bloomberg Surveillance.
This is the opening trade about 30 minutes into today's session. We've got a sell-off on our hands across the European indices. The DAX down about 0.5%. The FTSE 100 is, we'll call it the outperformer. It's flat. It's not selling off. I think that's good news. But I think the takeaway you want to take from today's session is simply that it's a retracement from this week's gains. It's also a Friday. There's potentially some risk of headlines over the weekend. I think the market's bracing for that this morning, Tom.
Let's get to tech right now, amid that concern around tariffs, of course, and the trade picture. Also a factor, of course, when it comes to the tech story. But Europe is pushing for technological sovereignty, and that's part, of course, of the bifurcation that we're seeing in terms of the US and Europe, certainly. With growing ambition here in Europe and urgency, of course, the continent missed out on the opportunity to create global internet and cloud companies. Now it depends on US and Chinese firms for some 80% of its tech infrastructure. Our next guest says the US and China threaten to leapfrog Europe once again, this time on AI sovereignty. Tanuja Randari is the managing director for EMEA at Amazon Web Services, joining us now for an exclusive conversation. AWS, of course, the beating heart of the revenue stream for Amazon. Tanuja, thanks for joining us in the studio. So there is this push right now in Europe around data localization and sovereignty. Is that a headwind or a catalyst for AWS?
Well, I mean, maybe just to step back and why we're talking about sovereignty as well is, you know, when we look at the adoption that we're seeing on this Gen AI technology, it's phenomenal in Europe, actually. We've seen about a 30% acceleration just in the past year alone. And that goes from startups all the way to governments and enterprises in between. So for some of those companies who require more enhanced sovereignty or enhanced security, they prefer to see a cloud here in Europe. And actually, we're very excited that this year we are launching in Germany our European Sovereign Cloud. And the reason we're doing that is while the public cloud that we offer across various regions in Europe is sovereign by design, for those enhanced sovereignty requirements, they want something that's independent of any other region. And so in Germany, we'll have this. It'll be independent of any other region. It'll be controlled, secured, and built here.
And I don't want to sound like hyperbolic or paint an extreme scenario, but we're in a trade war right now with the US. If we got to some kind of scenario, it's an outlier, clearly, where the Trump administration turns around and says, actually, we are so annoyed with what Europe is doing in terms of targeting our tech companies, just pull the plug on Amazon. Does that data center, does that sovereignty, does that cloud service remain in that extreme scenario?
So in the case of all of our data centers, by the way, not only the European Sovereign Cloud, customers are the only ones who have access to the data. They're the only ones who can move it, by the way. We don't actually see the data. We're just supporting them with the infrastructure that is secure and resilient. In the case of the European Sovereign Cloud, in the case of any connectivity disconnect, that cloud can still operate independently. So, however, I will tell you that, if I think about all of the administrations we've worked with over time, and we have a lot of experience doing that, we've been operating these clouds now for over 15 years.
Yeah. So I was speaking to Christian Klein of SAP, and he kind of pushed back on the narrative that Jensen Huang has been trying to sell in Europe, which is if you actually want to catch up and play a role in AI, you do need the data centers. And Christian Klein is saying, no, that's not really where we need to be focusing our capital, because we don't have the demand here. And he was talking about the large language models. On that piece, is Christian Klein right in terms of the particular data centers supporting large language models? What is the need for data centers in Europe right now?
Well, look, again, I'm going to go back to the data because it's super important. I mean, if you see the adoption we're seeing for this technology, right? And I'm talking about 5 businesses every minute in Europe are using this AI technology. It's outpacing the mobile phone uptake of the 2000s. And as I said, it's all companies. And the benefits they're seeing are not only what you would expect with AI, which is productivity, but they're actually seeing revenue increases. And I think that's why they're leaning into this technology in a big time. Now, to enable that, you need cloud. You actually need modern data foundations, actually no data, no AI. And then, of course, you need the data centers to be able to house these servers so that those companies can use both the models, but also be able to fine-tune their own and drive their own inference use cases. And I'll give you an example of what we've done, which makes it easier for customers to do this, right? We have something that we call Amazon Bedrock. I won't get too technical on it, but what it is it's a platform that gives businesses the availability of all the large language models. Now, I can't say all necessarily because we only have a few on, but if you take Claude, the latest Claude is 4.0. That's on Amazon Bedrock. If you take Mistral in France, that's on Amazon Bedrock. Our own Amazon Nova is available through Bedrock. Meta's Llama is available through Bedrock. But Bedrock provides a platform that people can actually use, leverage those models, but your data doesn't leave your environment. And I think that's really important. So yes, there's a huge uptake of usage of this technology across businesses. And for that, you absolutely need cloud and data centers.
Well, for cloud and data centers, you need the energy to power it. Tanuja, we had a conversation, I want to say a few months ago, with the Brookfield head of infrastructure, who was so positive on the AI data center rollout, with the caveat that France is leading because they have the access to the nuclear power to energize it. How does the rest of Europe catch up to the ability that maybe France has the lead in?
It's true. Every single thing we do in our daily lives needs energy and electrification, right? I mean, whether you're hailing a cab or social media or streaming on Netflix or shopping online, all of that needs energy, data, cloud. What we've been very focused on is ensuring that our data centers are extremely energy efficient. So I think what's very important is, yes, they consume energy, but it's important that we're actually constantly looking at ways to drive down the energy consumption and be really, really optimized. And in fact, Accenture published some research recently that says that our AWS data centers are actually 4 times more energy efficient than what is on-premise in the data center. And why is that? Because we are optimizing at every level. So if you take chips, for example, that are in the data center and they consume power, our chips, both on the compute side, which is Graviton, as well as on the training side, are actually way more energy efficient than comparable instances in the past. So, for example, our Trainium 2 chip is 60% more energy efficient, right? Yeah. So we have to do everything we can to actually drive down and optimize energy usage. And then we're also really very focused on carbon-free energy. Right? It's really, really important. All of our infrastructure, by the way, today is matched by renewable energy around the world. So I think that's super, super important. It's not an easy task, but we are constantly looking at ways that we can do it. And in the US, we are actually working on nuclear power as well.
That's a very expensive prospect. I hear you on the energy efficiency story as well, but here in Europe, energy security is an issue, and it gets very expensive very quickly. Just take a look at heating bills in the winter. I'm still very upset about that. Talk to us a little bit about how you approach the forecasting of some of those risks. I hear you on the energy efficiency, but in terms of the supply story, what do you see as potential hurdles to that consumption story?
Well, look, I mean, all of our teams that are building our data centers around the world, and I think there's no compression algorithm for experience. We've been doing it for many, many years. They're constantly looking at ways. So, we have data centers in Spain, we have data centers in Switzerland, we've got them in Frankfurt, we've got them in London here in the UK.
You just named countries that have struggled famously with the grids and the renewable energy there.
We do three things that I think are important. One is we are the largest acquirer of corporate acquirer of renewable energy around the world, Amazon that is. Two, we are constantly also commissioning solar and wind farms, by the way, here in Europe to make sure that we have access to that energy. And three, as I said, constantly looking ways at optimizing the consumption. I think, look, this is a story we have to constantly monitor and keep working on.
Let's talk about a region of the world that maybe doesn't have high energy costs, and that's the Middle East. Trump had a successful tour of the Middle East. It seems like it's becoming a hub or wanting to become a new AI hub. How are you viewing that region in your business?
It's a very exciting region, actually. I personally spend a lot of time in the Middle East. In fact, very recently, we announced the launch of our region. When by region, I mean our data centers in Saudi Arabia. So that will be there actually in 2026. And at the same time, we announced a partnership with a company called Humain, Humain. We are going to launch a first-of-a-kind AI zone with Humain in Saudi Arabia, which provides our bedrock services, as I mentioned earlier, and other solutions to both businesses and government in the KSA region, but also increasingly across the GCC. So very exciting. We have a region in the UAE as well as in Bahrain. And we're seeing some very exciting things both in the government as well on the commercial side.
And you also mentioned issues around AI skills and talent. We know, for instance, at least in Mark Zuckerberg's mind, he's on a massive talent war campaign right now. How are you guys dealing with that?
Yeah, so, I talked about the demand increase on the one hand, and it's great to see that. But there are three probably barriers to accelerate adoption. And I think for Europe, if we want to unleash, almost as we estimate 400 billion in economic value by 2030, there's three things we got to do. One is skills, the second is regulation, and I think the third is funding. On the skills side, right now, every one of our jobs is, obviously impacted by AI. And I think what I would say is it's super, super important for us to make sure that we are training and upskilling all of us, each one of us individually. By the way, I use tools. I'm sure you're using tools here. Tools are being used in content creation and content production. I think it's important, training and upskilling. So we're focused on that, really, really. And I think the mindset that companies need is that we are calling an AI mindset. And an AI mindset is all about rethinking your processes end to end and redeveloping them using AI at the core. And with agentic AI now, which is these autonomous software systems that are going to be able to plan, act, and reason on your behalf, there's a real opportunity to completely refine end-to-end processes, drive productivity, and then reinvest those savings in growing businesses, right? So I think those are some of the things, but training is the biggest issue. I mean, only 25%, by the way, of businesses feel like they've got the digital skills they need to be able to accelerate adoption of this technology.
Where does that leave, then, your hiring plans in the region? Because tech is, in general, tightening in terms of jobs, and we've seen job cuts at some of your competitors like Microsoft. Give us the picture in terms of the hiring story for AWS in EMEA over the next 12 months.
Well, look, I'll say a couple of things. I think normally with any sort of change, there is anxiety that comes with it, right? So, and this is probably one of the biggest transformations we're seeing, maybe beyond the internet, actually, certainly beyond the cloud in terms of its impact across every sector, every process. Historically, when we look back, tech has always actually created more jobs than taken them away. And I don't even know if we know what the jobs of the future are going to be. I don't think we have the crystal ball, actually, to say that. What I do see is that companies are investing in this technology to improve employee efficiency. BT, for example, using coding tools to really drive 12% of the tedious tasks that are really worrying for coders, releasing that, and then redeploying those resources elsewhere. You've got startups launching new businesses that are hiring. We, by the way, if you look at our region across the world, and if I look at the Middle East as an example, emerging growth region, Central Eastern Europe, emerging region, we are absolutely investing in resources there. But at the same time, we recognize that we actually have to change the work we do and change the actual work our employees do and make their lives much more exciting.
12 months now, is your team bigger or smaller than it is now?
It's hard for me to predict because the way we always think about these things is we work backwards from what our customers need, where's the demand, and then we work through our business plans, right? So for me to sit here and say, can I tell you where I will be in 12 months? I don't know, but I will tell you I'm super excited about the impact that this technology will have both on us, but also on our customers and partners.
All right, Tanuj Randeri, Managing Director for EMEA over at Amazon Web Services, giving us a little bit of insight into how the thinking around Amazon. We thank you so much. Coming up on the program, we're going to dive into the latest between the UK and France as they agree to swap migrants in a one-in, one-out deal. We'll have a wrap on the Franco-British Summit, a massive moment for domestic politics right here in the UK. Stick with us. This is Bloomberg.
Why is Baltimore so important to you?
It's our state's largest city. And if your state's largest city is not thriving, your state can't thrive. And that is just a mathematical equation, because the only way this is going to be Maryland's decade is if it's Baltimore's time. And so that's why we did focus on things like being able to extend the Orioles lease and make sure the Orioles could be here for 30 years. It's the reason we focus on things like the Preakness and keeping the Preakness in Maryland for generations to come. While we've invested in the convention center, the reason we focused on housing and getting rid of the vacant housing, the reason we focused on violent crime. And now Baltimore is having amongst the most precipitous drop of anywhere in the country when it comes to homicides and non-fatal shootings and carjackings and auto thefts. So if you can have Baltimore thriving, your state is going to thrive.
So if somebody's watching this and they're not from Maryland, but they want to know a little bit about Maryland, what would you encapsulate in a paragraph or two about what people should know about the state of Maryland?
I would say Maryland really is American miniature. You tell me what you want to do. And no matter where you're standing in the state of Maryland, I can tell you where to have a world-class experience within 2 hours. We're the home of innovation. We're the home of Johns Hopkins University, the home of the NSA, the home of NIST. We have so much to offer in the state of Maryland, and I think it's one of the reasons that people are so excited about the growth trajectory we're on.
What is going to be the consequence for U.S. markets?
We are basically deep in the European earnings season.
Take a look at how we're faring when it comes to Asian markets.
Get your fixed income fix. Watch Bloomberg Real Yield around the world right here on Bloomberg. Context changes everything.
Vietnam's trade deal with the United States includes a 20% tariff rate, but also gave it, quote, first mover advantage in Southeast Asia. Bloomberg Originals has been investigating why Vietnam needed to secure the deal right now. Here's a preview.
A land once devastated by American bombing, now accounts for half of Nike's global shoe production. Hundreds of other American companies and their suppliers have manufacturing bases in Vietnam too. As the Southeast Asian country's annual GDP climbed, exports to the U.S. grew. Now, Vietnam is one of the countries most dependent on American trade.
The United States is Vietnam's largest export market.
Vietnam's massive trade surplus with the U.S. has made it a key target for Donald Trump.
The problem is they charge us 90%. We're going to charge them 46% tariff.
If Vietnam were to lose access to the American market, that would have a profound effect. It would ripple across the economy.
Which is why this was imperative for the Vietnamese government.
President Trump says he's reached a trade deal with Vietnam following weeks of intense diplomacy between the two nations.
Unlike military conflicts, trade wars are at least fought without bloodshed. But they can still do damage. And even with a deal, the economic relationship between the U.S. and Vietnam faces an uncertain future.
Subscribers can see that documentary in full right now at the terminal or the Bloomberg.com. It'll be available, of course, later on the Bloomberg Originals YouTube chat channel. I think with that preview, I'm sure they'll hit this in the documentary, missed is simply this idea that Vietnam does provide a major hub for a lot of retailers. Nike, for example, among many, many others. When there's a question here, and I think one of our opinion writers a couple years ago had this great column about how long it takes to ship a pair of Air Jordans from the likes of Vietnam to the United States, and it was something like 180 days. It was talking about COVID supply chains, but that has only gotten to become more complicated as we talk about the tariff story. And I think that was a really fascinating part of how the trade deals, not just with Vietnam, but with Malaysia, Cambodia, et cetera, shows up in actual inflation, things that we buy every day.
And then you have to take into account how long that might be sitting in a warehouse, and then, by the time it actually makes it to the store shelves and bought by a consumer, how long is that? Because that is going to be very key for how long we're sitting here waiting for this persistent inflation to come from tariffs.
And Vietnam is also a story about how you balance the geopolitical needs of the US, which, of course, Vietnam is an ally in terms of a partner versus China. And the trade story, because, of course, Vietnam has also taken a lot of the factories from China where they've repositioned to be able to ship into the US market. And clearly, the Trump administration have woken up to that and now are trying to target tariffs on Vietnam because of that partner, because of that play around manufacturing. And yet they need Vietnam to be a partner when it comes to a bulwark to some extent against China.
Absolutely. And the currency impact is so crucial in that because some of the other competitors in Southeast Asia, there's a question here, especially from the Trump administration around currency manipulation, et cetera. Vietnam has skirted that label so far. We'll see if that changes as more people get exposure to that currency.
Let's get to more details in terms of the closer relationship between the UK and France now, because we have, of course, had the state visit by the French President Emmanuel Macron here in the UK over this week. Britain and France, as part of that, and at the tail end of that visit, agreeing to exchange migrants as part of a plan to deter illegal crossings by boat. The deal was struck by Keir Starmer and Emmanuel Macron, wrapping up that state visit, of course, from the French president to London this week. For more, let's bring in Bloomberg opinion columnist Lionel Laurent. Lionel, how significant is this? It's seen at least as a domestic win here in the UK for the Prime Minister. We're going to trial this agreement, of course. How is it playing out in France? What does it tell us about the Anglo-French relationship right now?
So I think this is definitely more of a British issue than a French issue. The French perspective, as Macron tried to say when he was in London, is that it's a completely different story here, because here in France, the border is seen to have been externalized from the UK to France. In other words, France is behaving as the kind of border guard for the UK and getting a lot of criticism for it. And as Macron also tried to explain, this idea of kind of taking British money and not doing anything with it is also very unfair, given France is spending far more also on all this border security. So I think the general picture is this is just a more constructive step, because Brexit really poisons the well of this very long and intractable border dispute. And this will be a test of political will, because this kind of agreement seems like it's a logistical thing, seems like it's a legal thing, but in the end, it's political will that will actually make it work, as we've seen with other deals like it, such as EU and Turkey.
Lena, so that's kind of the story on the migrants, but talk to us a little bit about this nuclear cooperation deal that was agreed on. Is this something you see as progress on the continent?
I think it's potentially pretty significant. Both the UK and France are the kind of only nuclear powers in Europe, and making some kind of step towards coordination, even if it's definitely not anything like sharing and not a change to the nuclear doctrine, that's an important signal. It's a signal to Donald Trump because it says that Europeans are going to really step up more when it comes to defense, and it's a signal to Vladimir Putin to say nuclear deterrence is not just going to be decided by Trump and NATO, and countries are getting serious now about investing in the nuclear deterrent, even if we are a long way from a new kind of nuclear umbrella being unfolded over the continent. I see it more as a kind of interesting step towards a new insurance policy when it comes to security.
Bloomberg opinion columnist Lena Laurent, we thank you so much walking us through some of the crucial conversations between the UK and France in this week. As he was speaking, we did see some headlines cross the Bloomberg terminal when it comes to the story around the ECB. Isabel Schnabel, of course, the chief economist there, making some comments around the strength of the euro. I think this is a really fascinating one. She's clearly tuned into the show for the last 2 hours, making some comments in EconoStream, saying that another cut would need material inflational deviation, also saying that the risks to the growth outlook are more balanced, reiterating that the economy is proving resilient. But I think the headline that stuck out to me is that there's the concern around euro strength that would weigh on prices. She calls it exaggerated. So that's going to be a crucial piece of the conversation as we see a lot of central bankers saying euro strength is actually a good thing. Exporters in Europe perhaps worrying just a little bit. With that thought, I should mention it's Friday. Let's do something fun on this Friday going into the weekend, which brings us of what we can look ahead to when it comes to Saturday and Sunday. For me, top of mind, I'm sorry I'm not there, the running of the Bulls over in Spain. Not that, sorry, because I don't run.
Pretty
but
right run.
but I think it would be fun.
You would.
I would run if a bull was chasing me. Yes, this is true. There is, of course, also the Wimbledon finale, the FIFA World Cup finals, lots of soccer in the space, and the Scottish Open, which I think refers to golf and not tennis.
It does. It does indeed. The tennis is in Wimbledon. The golf is in Scotland.
Yeah, but hey, Credit, we got an American in the Wimbledon ladies final to watch tomorrow afternoon, 1:30.
She was seeded like 165 last year.
Yeah.
Brilliant. She's 23, 24 years old or something. That's
First American in the women's final since Serena Williams.
Yeah, that's going to be a great game. Right. It is tourist. Meanwhile, it's tourist high season in New York. So from Wimbledon to New York right now, but things are quieter than usual. Apparently, the city is set to see visitors drop 17% from last year, a loss of 2.5 million people. But if the Big Apple is dimming as a destination, its brand is more powerful than ever in London, while where the New York influence is pervading the food and drink scene on multiple fronts. Bloomberg's food editor, Kate Crader, joins us for more. Kate, what is behind all the New York food and drink talk in London? This is one that's apparently passed me by, but it's a thing.
Really? Well, if you look, I'm excited for you to go eat some pizza, have some steak and some oysters at restaurants.
Yeah.
It's kind of exciting for me because I'm a New Yorker, but there's a pervasive New York food scene happening. Maybe you've seen it some places, even I think Pret. There's these supersized cookies that looks like scones. They're doughy. I think they're delicious. There's all this New York floppy style pizza happening everywhere.
Is that what defines a New York pizza? Is when it flops?
Basically, yeah.
Is it like not the oil? Is it not the dripping oil?
It's definitely, you want some drippy tomato saucy thing on it, but
and it's a slice, not a whole pizza.
It should be a slice. Here, you guys still believe in pies, but you can find some slices at some places. But definitely, if you're going to eat New York style pizza, have some napkins. Maybe a bib, like be careful.
Style.
But it's also, the exciting thing for me also is that there's a New York style pervading dining rooms right now. And it's really fun. You see it in some food. You see it, there's a lot of steaks, martinis. There's seafood platters, like seafood towers. But it's also just a style. It's like a comfortable, people being familiar, people being comfortable. Like the waiters can make conversation with you, sitting at the bar, chatting waiters.
People can take chatting
Exactly. Well, let's see. But it's really encourages walk-ins. There's much more spontaneity. I think Brits actually like to make reservations, and they also like to have a culinary experience.
We are hitting a commercial break, but noted, pizza slices in London. That's where it's at. Stick with us. This is Bloomberg.
It's the most fascinating time for the global economy in years, and our conversations are front and center.
We're stress testing consequential ideas, and investors around the world are scoring them in real time,
helping to translate the policies from Washington into actionable ideas for Wall Street.
It's the morning call you actually want to be a part of.
Separating the signal from the noise,
with some fun along the way.
This is Bloomberg Surveillance.
Up-to-the-minute geopolitical news wherever and whenever it happens. I'm Anne-Marie Hordern in Alberta, Canada, and this is Bloomberg.
Making money isn't about drowning in emotions. It's about understanding what's actually happening. Markets are the best way to glean signal from noise, and that is what we try to do every morning. This is Bloomberg Surveillance.
Technology is embedded in every aspect of our lives.
And laying the foundation for the future.
From finance to defense, AI to entertainment.
And from the road to the stars. Bloomberg brings you the latest stories of the people and companies pushing the tech sector to new frontiers.
And the politics that shape global tech markets.
I'm Caroline Hyde in New York.
And I'm Ed Ludlow in San Francisco.
Watch Bloomberg Tech every weekday.
Only on Bloomberg Television.
From the world of politics to the world of business, Joe Matthew and Kaylee Lines deliver news, insight, and analysis live 2 times a day, every trading day. Balance of Power at 1 and 5 Eastern, only on Bloomberg.
Good morning, this is Bloomberg Daybreak Europe. I'm Tom McKenzie in London. These are the stories that set your agenda.
Taking you from the U.S. market's close to the overnight session in Asia, we'll walk you through what you need to know to kickstart Europe's trading day. Live from our European headquarters, we bring you the day's top market-moving stories, unmatched expert analysis, and on-the-ground reporting from across the continent. Tune in to Daybreak Europe, only on Bloomberg Television. Context changes everything.
President Trump threatens a 35% tariffs on some Canadian goods and raises a prospect of increased levies on most other countries. Meanwhile, Vietnam says it's surprised by Trump's tariff announcement. China's Foreign Minister Wang Yi accuses Washington of abusing tariffs as he meets with Secretary of State Marco Rubio. Plus, the UK economy shrinks for a second straight month as companies and consumers struggle to bounce back from the blow dealt by tariffs and tax hikes. So good morning, everyone. There's quite a lot going on in the markets. It's very clear that the markets are now nervous about this extra offensive on trade from the U.S. President Donald Trump. If you look at U.S. equities, they're set to retreat a little bit from some of the record highs, but we're still at record highs or near enough. So again, S&P futures down 0.5%. That's how we're expecting them to open. Brent crude 68.84. And then the big question is what happens to the UK going forward, given we had this print that was less good than expected, sterling 135.42. Now, the way this is all playing out in the European Union is a little bit of red on the screen because we're expecting also a letter from the President of the United States to Europe. It could come as soon as today. The CAC 40 down some 0.4%, and you're seeing similar losses for the DAX and the FTSE MIB. The FTSE generally propped up, actually, by what we're seeing in commodity prices. So the FTSE is now flat. Now, we all are also finding out that Saudi Arabia has raised its crude output far above its OPEC plus quota last month, joining other producers in a rush to export oil out of the Persian Gulf as Israel went to war with Iran. That's according to the International Energy Agency that's out with a report today. You can see Brent crude currently, as is WTI in New York, gaining some 0.4%. So for the conversations that matter and the insights you need, let's get started.
Newsmakers and market movers. This is The Pulse with Francine Lacqua.
Well, good morning, everyone, and welcome to The Pulse. I'm Francine Lacroix here in London. Now, Bloomberg understands that Vietnam's leadership was caught off guard by Donald Trump's announcement last week of a 20% tariff on Vietnamese goods. Now, sources say the country is still hoping to secure a rate closer to 10 or 15%. Meanwhile, Canada is facing a 35% tariff on goods not covered by an existing trade agreement with the U.S. after receiving a letter from Donald Trump. With us now, Rosalind Matheson, our EMEA News Director, and Klaus Bader, Global Chief Economist at Societe Generale Corporate and Investment Banking. So thank you both for joining us. Raz, you're on every day. Every day we say actually how the president is absolutely not backing down. And actually the rhetoric around trade is getting more aggressive. How are other governments reacting?
Well, it seems to be the case, and as we know with the Vietnam example just now, Trump is saying these letters are deals. He's describing them as deals. In fact, it's the US deciding what tariffs are and imposing them on other countries. And in the case of Vietnam, we could see they went very, very quiet when he announced that he had a deal. They didn't say very much. We couldn't get a lot of confirmation. Now we know behind the scenes, they were obviously saying, hang on, we're surprised by this. We thought we were still negotiating, and they still seem to think that they are. But with Donald Trump again, whatever the numbers are, wherever you're at, everything is still, to some extent, a negotiation. You can see with Canada again overnight. I mean, the numbers have moved around constantly for Canada as well, depending on the week that we're in. Everything remains a negotiation, including for Brazil and others. The question is, he's come for Canada, he's come for Brazil, he's come for countries in Asia, Africa. Where is the EU? We still don't have a deal here. You know, are they getting nervous, despite the fact that Donald Trump has been sounding warmer lately on the EU, saying that they're better to deal with? There's no deal yet. And does that mean that they're worried that he's going to just decide that, I'm going to announce something and therefore kind of try and make it a fact in a way by doing so?
And Klaus, I guess, I mean, there's a concern that actually Donald Trump, then he's threatened to double basically the baseline universal tariff to 20%. But at the same time, he's saying, well, look, the stock market is at a record there behind me. And so what we thought would maybe counterbalance some of the overzealous on trade is not there.
Yeah, I mean, if you really try to follow what tariffs are going to be imposed, you end up with a spinning head. And I think, frankly, what's worthwhile is to go back to first principles. And the more I think about it, the more convinced I am that these tariffs are going to do absolutely nothing to bring either manufacturing output or manufacturing employment back to the United States. The fact is that always, this is really fiscal policy 101, always when you're talking about a fiscal measure, and tariffs are a tool of fiscal policy, what's absolutely key is whether those measures are perceived to be transitory or permanent. Now, you could tell me a lot of things, but I really would love to see the entrepreneur who thinks that the current tariff structure of these threats are going to be permanent. Now, if you can't be sure that they're going to be permanent, are you going to make the massive commitment of building a factory in the United States to produce things that you're currently producing much more cheaply outside the United States, in the United States? I think the answer to that is no. And so what's going to be, I think, that alone is enough to seed the demise of the policy. What I do think the policy is going to be excellent at is raising prices in the United States, which is also not going to make it very popular. I'm not even talking about the lack of excess labor supply in the United States. I've always wondered, well, who's going to do all those jobs? So I think this is just a whole lot of noise. And in the end, the economy that's going to be really harmed is the United States. And look at the consensus forecasts. It's very clear. This is a majority opinion. I think they're right.
Okay, let's also talk about China. China's foreign minister says the United States has abused the tariffs and undermined the free trade system. Wang Yi also expressed his opposition to unilateral tariffs when questioned by Bloomberg's Min Lo.
Minister Wang, what's China's position on tariffs?
Oppose unilateral tariffs.
Are you meeting with Secretary Rubio?
Well, we can now go to Min Lo in Kuala Lumpur at the ASEAN meeting. Min, first of all, great doorstepping. I mean, Wang Yi had some pretty strong words to say about the U.S. Where does it leave the two countries?
Yes, he said that the U.S. has been undermining global trade, and he actually said he believes that ASEAN countries are going to push back against this unilateralism. He had a slew of meetings yesterday with the ASEAN foreign ministers, for instance, and he came out of that room grabbing hold of the hand of the Malaysian foreign minister in front of the media pool. It was clearly a very strategic sort of gesture in front of us to show the close ties between ASEAN and China, and this coming as the two sides are working to upgrade their free trade agreement before the end of the year. He also had this meeting with the Vietnamese foreign minister, which I thought was very interesting because Wang Yi said that China is willing to work with Vietnam to ensure that the legitimate interests of all countries is safeguarded. And this is interesting given the rhetoric that we have been hearing from China, warning that it's prepared to take countermeasures against countries that cut deals with the U.S. that undermine Chinese interests. And yet, even though Vietnam has agreed to those tiered tariff levels, 40% on transshipment, that is really targeting the back door for many Chinese exporters. Still, the tone appears to be quite constructive and positive, and it seems like Wang Yi is really here, vying for influence with Marco Rubio in Southeast Asia. Of course, it's Rubio's first trip to Southeast Asia as well, and he is also getting all these questions, especially from the Malaysian Prime Minister, about lowering tariffs as well.
Min Min, is this just a preliminary summit for when the two presidents meet?
Yes, so Marco Rubio and Wang Yi is actually meeting right now just upstairs. It's still ongoing. It is not clear whether they are in fact laying the groundwork for that potential trip by President Trump to China, because neither Rubio nor Wang Yi really talked about what they were going to discuss, although Rubio did say he's going to raise the issue of Russia. He said China has been doing as much as it can to support Russia without getting caught. That's something that he wants to talk to Wang Yi about, especially ahead of that planned announcement that President Trump is planning to make on Monday regarding potential sanctions on Russia. Of course, the big question is whether China would be implicated in perhaps secondary sanctions for buying, oil and LNG from Russia. Of course, this coming against that backdrop of the trade tensions, but at the same time, Rubio doesn't really have the power to decide on trade issues, right? Scott Bessent has said he's going to meet with his Chinese counterparts in the coming weeks. But again, we're hoping to doorstop the ministers later, and when they come out of the meeting, to see, what the tone was like, whether it was a constructive meeting, and whether there is going to be a potential meeting between Trump and Xi later this year.
Min Min, thank you so much. Min Min Lo there in Kuala Lumpur. Now let's get back to Roz and Klaus. Klaus, we were talking about tariffs, and it was really interesting saying that you think if it's not a one-off, it's something that actually we can look through because they're not going to be in place for a very long time. What are you expecting for the European Union? What kind of letter will they get? Is it going to be at 20%? And do they now have to choose between China and the U.S.?
I don't think that they really need to choose between China and the U.S. Again, I think I'd have to be either a seer or a charlatan if I told you that if I told you what kind of tariffs are going to be imposed. But you said earlier, and I thought that was really hit the nail on the head, which is that Trump is sounding a lot more positive about the EU. I mean, he's in the past said that the EU is even worse than the Chinese, and so there's been definitely a change here. It's clear, tariffs are an incredibly complex tool, and I think Donald Trump is finding that out. You can't just negotiate a trade deal in a couple of weeks. But the hope is that, I think the kind of silence that we're hearing in the background suggests that there is at least a framework agreement. The Europeans, they will accept a 10%, and I think in return, they will give the United States no tariffs at all. Our base case, as long as these tariffs are within a reasonable bound, let's say 10, 15% maybe, and probably some special arrangements, maybe some part quotas for automobiles, that's an important thing. Yeah, and your German companies, they have huge manufacturing plants in the United States. Then I think the EU will probably not retaliate, and that's quite a good place, I think. Think about it. For the U.S. right now, for Trump, they are receiving 10% on all of the imports that come from the EU, and I think the 25% on autos are also in place. Meanwhile, they're not getting any countermeasures. So this is a good place. You don't really want to upset that, do you?
I mean, you don't, but actually we don't really have a formula. I think, you know, President Trump was asked by one of our reporters yesterday, and he said, look, it's bad will, it's numbers, but actually we don't really understand yet how this is decided. Sometimes, Roz, we talked about yesterday, it's domestic politics in Brazil. So what's the framework for this?
Well, that is the question. It is politics. I mean, we're talking about tariffs being a fiscal tool, but they're also very much a political tool, depending, again, on Trump's mood on a given day. He tried to use tariffs against Colombia on migration. Now he's been using them against Brazil on a domestic judicial matter because he's mates with the former leader of Brazil and friends with him. And so, you know, what proportion of the 20% is political and what proportion is actually based on trade reality? I mean, you're threatening tariffs on a country, for Brazil, for example, there's a trade surplus with you. So technically it doesn't really make any sense economically. And so for countries working out how to deal with Donald Trump, it's just quite complicated, because you look at Canada, the former Canadian leader, he tried to be tough, then he tried to placate Donald Trump. None of that seemed to work. Carney, the current leader, is trying some more of a middle ground, and that's not necessarily working either. You need to give Donald Trump the sense of a win without giving too much away, and that's exactly what the EU is trying to do. You manage it in a way that you give him some of the things that he's asking for without damaging yourself too much, but it has to be for Donald Trump to be a bit of a win, and that's how you maybe negotiate with him in all of this.
Yeah, and yesterday we were speaking, for example, about coffee because of that 50%, you know, tariffs on Brazil. It would actually make it cheaper for a European coffee maker to send things from the U.S. because their own roasters in the U.S. would be punished. Klaus, you basically said, look, you expect inflation to go up.
Yeah.
In the U.S. Is it significant, and why have we not seen it yet? It's not translating into the data.
Well, I think, first of all, I think there's good reason. You know, there was a really enormous boost in imports, all this front-loading that's been much discussed. So American warehouses are chock-a-block full with stuff that was imported into the United States before the tariffs hit. So I'm definitely not confident that just because you haven't seen a whole lot of pass-through, you're not going to see it. Besides, you see, the story is actually a little bit more complicated. In December and in January, goods prices ex energy in the United States rose 0.6% a month in 2 months in succession. And at least according to the liaison and the commentary from the Federal Reserve, the principal reason that they heard from businesses was the anticipation of tariffs. Now, the last few months, goods price inflation has been very, very moderate. I think next week's inflation report is not going to bring a whole lot of good news. After a big undershoot and broad-based, you're going to see a broad-based big overshoot of what the Federal Reserve is looking at.
So that would come as soon as next week. So that means repricing.
I think we're going to start. I think we're going to start seeing it now. You know, pinning down when these effects come through by the month is a bit tricky. Yeah. But there are some weird things. For instance, you know, used car prices in the U.S. have been really weak for several months. That's odd, right? If you anticipate that new cars that are imported are going to be slapped with a massive tariff, you would think that used cars become more competitive. So I think that there may very well be a snapback. Is it going to be this month? Is it going to be next month? No. So I think absolutely those higher prices are going to come through. You know, there's the idea that the exporters are going to swallow the tariffs is, of course, laughable. Yeah. There's a little bit of that effect through the exchange rate, maybe, but you see, the textbook has not been fulfilled in reality. Yeah. The currencies that are being hit, or the economies that are being hit, are seeing their currencies actually appreciate rather than depreciate. And so that's not going to happen. And I don't think that importers and distributors' profit margins are wide enough to swallow them. I think most of it is going to end up with the consumer, and they're not going to be happy.
And Russ, what do we know about the EU? I mean, again, the U.S. consumer is going to be a problem for a lot of EU companies. But do we get a letter today, or do we know if the two sides are actually talking, or do you literally just get a letter by email from the President of the United States?
Well, we know they are talking, and we keep hearing it's imminent. But it's a bit like India. We've been hearing that there's a U.S.-India deal, and it's been imminent for a week, and it's not yet emerged. I might just jinxed it and it will come out in half an hour. But we know that there's a feeling that they're getting close. The Europeans do have, as we're saying, a framework. They were willing to take 10%. Are they willing to take 15 or 20%? If that becomes the new baseline for tariffs, that becomes a lot more complicated. So that's a wrinkle they're probably talking about today. EU ambassadors are meeting today. We know that trade ministers are early next week, but the conversation is going on constantly behind the scenes. And so we may get a framework today, but the Europeans probably just want to get something out publicly and at least on the board, even if it's broad, even if there's a lot to be discussed, a la the UK, you get something, then you go away and start having proper detailed negotiations. We can see from the UK just how hard that is. There's a lot we don't know, but at least you have a framework, and that slightly prevents the US or Donald Trump from tinkering at the edges as we go on.
Klaus, very quickly, I mean, are we going to see a recession? You're not pointing to any good news, given how you explained everything. So could we also see a significant slowdown for the U.S. and the rest of the world?
Well, I certainly think that the slowdown is absolutely inevitable. The U.S. economy has been growing around 2 3/4%. We are relatively sanguine about U.S. economic growth prospects, but we think that a slowdown by about 1 percentage point to around 1 3/4%, which would be below potential, is on the cards. I don't think recession unless you get additional shocks. But, again, the whole tariff landscape is so uncertain that you really can't exclude it. But I definitely don't. It is not our base case that the U.S. is going to slip into recession. Big slowdown, yeah. Recession, yeah, probably not.
Okay, Klaus, thank you so much. Ross Matheson there, our EMEA News Director, and Klaus Bader from SocGen CIB. Coming up, EM currencies on their longest losing streak this year. We'll ask why next, and this is Bloomberg.
Bringing you up-to-the-minute geopolitical news whenever and wherever it happens. I'm David Gura in Ottawa, Canada, and this is Bloomberg.
Africa, a region rife with potential for growth and opportunities, but not without its challenges. Bloomberg highlights the biggest stories, interviewing key players, and reporting on the issues impacting the region. Join us as we get to the heart of African business, politics, and economics, and ask the question, what's next? I'm Jennifer Zabasaja, and this is Next Africa.
New episodes every month, only on Bloomberg.
Jumpstart your trading day on Bloomberg Open Interest.
2 hours of single stock stories that are driving the opening bell action. We'll take you to Wall Street, Main Street, the C-suite, and beyond.
These are companies that are growing their market.
The great companies in the U.S. are the companies hitting the cutting edge. That's a different story.
Get the inside track on what's buzzing in markets.
With the players who are shaping the narrative.
If you have bad earnings reports, you're going to get punished.
They're not buying what the industry is selling. Join us on Bloomberg Open Interest. Every trading day, only on Bloomberg.
Key investors, top executives, global innovators. Join me for in-depth conversations with the biggest newsmakers on the day's top stories. Insight with Haslinda Anand, only on Bloomberg.
Welcome back, everyone. Now, an index of emerging market currencies on its longest losing streak this year. Now, EM currencies have fallen for 5 straight days as President Trump's tariff threats derail a rally that had held sway for 3 months. Now, for more on all of this, we're joined by Kamaksha Trivedi, Chief FX and Emerging Market Strategist at Goldman Sachs. Kamaksha, thank you for joining us. I mean, it's probably a welcome relief from your desk because, tariffs are coming left, right, and center with letters. I mean, what's your underlying understanding of what will happen in the next 2 weeks?
More negotiations. I think that's what it seems to be all about. I mean, the actual news in terms of what has changed is simply that the deadline has been pushed back to the, August rather than sort of July. So it seems to me like what is going on here is that There's a desire to reach more deals require more negotiations require more time. So I think there's a reason why, markets are going sideways, FX markets are pretty choppy, because there is not really a whole lot of actual new news here as much as the deadline has been pushed back.
Do markets embolden Donald Trump to go further?
I think there is a fair amount of complacency that, like we saw the rollback or the extension of, tariff deadlines, back in after Liberation Day, like we've seen that again, that some of the most extreme tariff headlines will not come to pass. I think what has also happened is, and then I think this is more genuine, is that the range of uncertainty has shrunk. I mean, if you set aside the Brazil example, if you think back on Liberation Day, the bid-ask spread on tariffs was, between, 10% and 50, 70, depending on what you think about China. Now it feels like the bid-ask spread is somewhere around that 10% level. 10% seems to be the new floor. That's what the UK deal suggested. But even above that, it seems to be a little bit more bounded. And so I think that's part of what markets are responding to, that the uncertainty has come down, and that allows them to make some more progress than before.
But then there's a kind of, I don't know what the upscount is, like the contrary of a discount for BRIC countries. So how much, what does that mean for China? What does that mean? I mean, Brazil, as you say, was domestic politically, but can it be negotiated down?
Look, I think in Brazil, if you look at the details of the letter, I mean, it does seem much more political than about trade. I mean, bear in mind that, Brazil has a trade deficit with respect to the U.S. and has had one for several years. So it really doesn't feel like this one is about trade deficits. That makes it harder to provide trade-related concessions that would, offset some of the tariffs. But equally, I think, at the end of the day, the reality is that Brazil's export exposure to the U.S. is pretty small. And so I think that this is going to be a small hit to GDP if it, goes through in the way that it's been, headlined. And you saw that in the currency as well. Yes, the real sold off, as per your opening segment, but it came back pretty quickly. And given the strength of the real year to date, this is a relatively minor move. It's like the daily volatility of the real.
Yeah, I mean, I was struck today, but, Vietnam surprised by Trump's 20% tariffs. And also, if you put it bluntly, like a lot of these countries would probably love to be able to afford U.S. goods. They just can't. Yeah. So again, I don't know how that gets managed. Do you have favorite currencies that you play into right now?
I mean, I think that, when you think about the broad FX complex, I think there's a sort of, important theme about what's going on in the dollar and the fact that the U.S. is finding it increasingly difficult to attract unhedged capital flows. That's putting pressure on the dollar. So that's kind of one side of it, and I think that's likely to extend going forward. But bear in mind, we are 6 months into a dollar downtrend. When you look at like large dollar depreciations, like the one after the financial crisis, like the one in mid-2000s, they tend to be very rapid 6 months in and then tend to flatten out. You have choppy periods, you have back and forth. So I think we are in that phase now. I think you need a kind of new catalyst to really kind of push the dollar forward. I think one of that is potentially, Fed cuts. If we start to see Fed easing move more centrally into the picture, that could be one. But the other, I think I wouldn't underestimate, is China. CNY is moving. It's moving slowly. It's under a lot of people's radar, but we just recorded the lowest, year-to-date fix in dollar CNY, so the strongest CNY level. I think there's something very tangible going on there. I think if you see that move continue, I think it's going to unlock a lot more upside in Asian currencies, places like the Korean won, places like the Japanese yen, apart from the CNY itself.
But are you expecting Fed cuts this year, or are we going to start inflation creeping up into data even as early as late July, August?
We are expecting 3 cuts this year. I think that, you're right, that I think there's going to be a little bit of a tug of war between the macro data as it comes through. If we see a little bit of that inflation pickup, how quick it is, how significant it is, and then, of course, how transitory or not that is. At the same time as you're seeing a sort of graduate loosening in the labor market. Yes, payrolls were very, pretty strong and stronger than expectations, but probably not as strong as the overall headline suggested. And so I think that, those two things combined, starting with the fact that the policy rate is at a pretty high level, pretty restrictive level, you would argue in some senses, I think it still allows room for some gradual reduction in the policy rate this year.
Kamaksha, is this a one-off? I mean, we're out of time, but actually, are these tariffs here to stay for a long time, or is it really just trying to get money back to the U.S.?
I think even the history of the last set of the Trump tariffs and then how it went to the Biden is that some of these tariffs are here to stay. Particularly the sectoral ones, I think, are hard to roll back. I think those are going to be here to stay for a while.
Yeah, and that changes also inflation expectations. Kamaksha, as always, thank you so much for joining us. Kamaksha Trivedi, their Chief FX and Emerging Market Strategist at Goldman Sachs. Now, coming up after a volatile week for copper, we'll talk to Amy Gower, Metals and Mining Commodity Strategist at Morgan Stanley. That's next, and this is Bloomberg.
Welcome back to the circuit. This time, we're taking you to the frontier.
Do we have a camera, or do we don't want to lose you, Emily, in all of this?
Stargate, put that name down in your books.
What we're undergoing right now is sort of the largest infrastructure build in human history.
To meet the people rewriting the rules of code and culture.
How do you personally grapple with the pace of it all?
It does feel like it's going very fast.
When did you realize, oh my gosh, my life is never going to be the same?
The day I got engaged, I was like, whoa, what have I bitten off here?
Where the future gets real.
How confident are you that AI's promise will outweigh the perils?
I'm not confident.
So the tech companies are lying or fudging.
And a little weird.
What's the point of this?
What is the point of any of this?
Tune into Season 3 of The Circuit with me, Emily Chang, Thursdays at 6 p.m. Eastern on Bloomberg Originals and Bloomberg TV.
Flood of investment agreements.
Deals were once again on display.
The Saudis are open for business.
The cessation of sanctions against Syria.
Another big victory for the Crown Prince, concerned that none of the guardrails may be set up just yet. Headline after headline.
Trust Bloomberg for on-the-ground coverage.
The numbers will be quite substantial.
Up-to-the-minute reporting.
Driven the price of oil down.
And the analysis you need.
He's basically going to vault this region into the same sort of sphere as the US and China.
No one covers geopolitics like Bloomberg.
Middle East and Africa. Vibrant resources and high-yield investment opportunities abound. Join me on Horizons Middle East and Africa for the stories, newsmakers, and insight from this exciting region. Now weekdays, only on Bloomberg.
It's a multi-trillion-dollar industry. We'll show you what's happening in ETFs like no one else. ETF IQ, only on Bloomberg.
Good morning, everyone, and welcome to The Pulse. I'm Francine Lacqua here in London, and these are your top stories. President Trump threatens a 35% tariffs on some Canadian goods and raises a prospect of increased levies on most other countries. Meanwhile, Vietnam says it's surprised by Trump's tariff announcement. China's Foreign Minister Wang Yi accuses Washington of abusing tariffs as he meets with Secretary of State Marco Rubio. Plus, the UK economy shrinks for a second straight month as companies and consumers struggle to bounce back from the blow dealt by tariffs and tax hikes. So it's been a volatile week. That's an understatement for copper after President Trump said he would impose 50% tariffs on copper imports. Now, those plans include semi-finished products, such as materials used in power grids, the military, and data centers. Well, joining us now is Amy Gower, a metals and mining commodity strategist at Morgan Stanley. Amy, thank you so much for joining us. I mean, copper, there were so many questions, first of all, of why copper in the U.S. traded differently to copper in London. But what did you see this week? Like, what have you, learned?
Yeah, so I think some of what's happened is as we would have expected things to play out. So we heard on Tuesday night Trump would plan to put 50% tariffs on copper imports, and US is a net copper importer, so it relies on imports for about half of what it consumes. And so therefore the COMEX price, which is the delivered into US price, should ultimately reflect that tariff. Now at the moment it's moved to about a 30% premium to the international benchmark, and I would say the reason that's happened, why we haven't moved all the way there yet, first of all, the tariffs aren't actually in place yet. They're due to come in on the 1st of August. But second, we have had warning that this was coming. So the Section 232 investigation was launched in February. So what this has done is allowed the US to front load significant volumes. We think they've got about now 6-7 months worth of import coverage sat in the US that can be used first.
So were we expecting actually the president to be so aggressive on copper?
So I think that the tariffs probably were expected broadly by the market, but they came both earlier and higher than expected. The deadline for the Section 232 investigation was late November. I think people generally thought country tariffs would be prioritized. So the timing is a surprise, and then also going straight to 50%. Now that is where we are on aluminium and steel, but we went to 25% first and then 50.
So how does it change actually the copper complex? Again, are things going to be shifted around, or are there countries that will benefit from this?
Yeah, so I think what we should see from here is short term actually for the international benchmark. This is a bit of a negative. So it's benefited so far from this front loading of US demand. We've probably added about 1.5% to global annual demand just from all of this extra buying. And that's been because there's been a profitable trade by doing that. As soon as the tariffs are in place, that trade is over. So we're going to not only lose that buying, we may even see the US buying less than normal because they're going to use up this inventory buffer first. So actually for the LME benchmark, we think this is a bit of a negative. So far it's holding up, but I'd say that's how we would expect that to trade. And then COMEX should gradually move higher. In terms of countries benefiting, it's going to depend who ultimately pays the tariff. So if you've got long-term contracts into the US that you have to deliver against, you may have to be still paying it, and maybe that the consumer pays is not clear at this point.
I mean, where does this leave China? I mean, they're a huge consumer of copper. I know it's gone down because of some of the dynamics, but actually overall, does it shift overall copper demand worldwide?
So China is, probably over half of global copper demand, but they're mainly going to be buying based on that LME benchmark, the international benchmark, which hasn't really moved. In fact, it pulled back a little bit. And what we've seen is the Yangshan premium, which is the China copper import premium, has actually bounced with this. So that's actually suggesting with these small pullbacks, maybe China's even coming in to take a little bit more copper.
I mean, there's a number of metals that we also need to look out for. What's going on with iron ore? There's a lot of these metals that you follow every day that is absolutely necessary for everything in the economy that people don't really realize or talk about as much.
Yeah, so iron ore is the key raw material to make steel. It's been quite range-bound, actually, this year. So we've been trading in sort of $90 to $100 per ton range, which is actually a little bit lower than we've had over the last few years. There's a few things happening there. So one is that there's this broader steel reform going on in China. So there's expectations that China will be looking to ease off steel production through the second half of the year. And China's about 75% of iron ore demand in the seaborne market, so that means less demand for iron ore. But equally, there's a bit of optimism at the moment. So iron ore has actually been bouncing because there's hope that we might get some extra money for property in China, that maybe there'll be some stimulus at some point this year. And we're also just coming off peak seasonal shipments as well, so maybe a little bit less supply from here.
I mean, there's a lot of these. Again, a lot of these metals are also used for the energy transition. That maybe we don't call it ESG anymore, but it's going into a different kind of energy resource. I mean, do all these tariffs actually impact the availability, for example, for a region like Europe that still has targets of how much they want to diversify energy?
Yeah, so I think this energy transition demand is definitely still there. Actually, for many of these metals, it's quite small at the moment still, so it is growing. You know, your biggest sectors are still going to be your construction, your grid, but with all these grid upgrades planned, of course, you know, if we are seeing inflation in global prices, that is going to be starting to come through, particularly for something like cable, where, you know, copper is the main component. In a electric vehicle, copper is going to be one of many, but in something like a cable, copper, you know, an increase in copper prices is going to translate directly through the price.
Gold. I mean, gold, I feel like the limit is the sky, actually, for gold, because we're also seeing a lot of central banks buying gold as a way to diversify away from treasuries.
Yes, so on gold, this has been one of our top pick metals for this year. I think what we're seeing at the moment, which is super interesting, is this really strong inverse correlation with the dollar. And it's actually quite unusual for gold to hold this relationship for so long. And so actually, you know, if we do see this dollar weakening trend continue, then arguably gold can keep moving higher from here. And that's just from a sort of macro view. But again, if we talk about the physical demand, looks like central banks probably on track for another year of this kind of elevated buying that we've seen. And then the other one is the exchange traded funds. So for the last 4 years, they've been net sellers of gold. And then year to date this year, they've really stepped back into the market. So that's all backed by physical gold. That's creating that demand. We'll have to see on jewelry, which is about half of global gold demand. That is more price sensitive. But sometimes what you see is people pause their purchases and then they sort of adjust to the new normal price. So we're kind of waiting to see on that one. But it does look like there is a bit of weakness in that sector.
But I mean, do you see it like actually the role of gold having completely changed? And I know you were one of the ones that were kind of predicting in terms of price, but what kind of price could you expect in the next 12 to 18 months for gold?
Yeah, so look, I think if we keep seeing the dollar weakening, we could be looking up towards the sort of $3,800, $4,000 level if this dollar weakening trajectory continues. And I think, yeah, look, the role has changed. That investment demand has become much more important for gold, and I think for central banks as well. You know, what we see is when they change their behavior, it tends to be sustainable. So in 2011, post the GFC, they went from being sellers to buyers, and then they bought at about the same level for a decade. In 2022, they doubled that level, and we've now seen 3 years probably on track for a fourth year. So I'd say that is here to stay.
So interesting. Amy, thank you so much for joining us today. Amy Gower, their metals and mining commodities strategist at Morgan Stanley. Now, the U.S. President Donald Trump says he'll make a major statement on Russia next week, just as the U.S. ramps up military support for Ukraine by sourcing more weapons through NATO allies. In a phone interview with NBC News, Trump doubled down on his criticism of Vladimir Putin, condemning Russia's ongoing assault on Ukraine. Well, let's bring in Bloomberg's Russia economics and government editor, Greg Sullivan. Greg, good morning. So what can we actually expect President Trump to say, and how could this shape U.S. foreign policy moving forward?
Well, this could be a number of things. In recent weeks, we really have heard a shift in tone from President Trump on Russia. He's seemingly grown increasingly frustrated with Russia over their intransigence in talks and the continued bombardment of Ukrainian cities with drones and missiles. What we could hear from Trump would be more of that continued rhetoric, or even something like the introduction of sanctions on Russia. It could also be potentially an announcement about weapons deliveries to Ukraine as Ukraine seeks to protect itself from these bombardments. But on the other hand, we also had Secretary of State Marco Rubio, who just met with his Russian counterpart, Sergei Lavrov. They discussed Ukraine, among other things, in that discussion, and so it could be something out of that. The key thing to watch will be, is there some kind of concrete announcement, something on sanctions, weapons deliveries, or the talks at hand, or is this just really more rhetoric? And that will be the key to deciding whether this is an actual shift in U.S. policy or whether this is continued frustration with Putin, but not really a real policy change.
Greg, President Trump also threatened the possibility of more sanctions against Russia. So how likely is this?
Well, up until now, we've seen a real reluctance from President Trump to impose sanctions on Moscow. He has said on a number of occasions that that is an option at hand and that he would consider it. But so far, there's been no introduction of sanctions, and we've heard that he's actually quite reluctant to do so. Some in his party, including in the Senate, are really anxious to try to impose new sanctions. There is a Senate legislation for imposing sanctions. It's quite punitive. But if he does decide to impose sanctions, it could come about quickly. He probably would have the backing of Congress. But as of right now, it seems that it's still rhetoric. We don't know if he's actually decided that, yes, now is the moment. That's something we could learn on Monday as well.
Greg, meanwhile, the Ukrainian president attended a conference in Rome and seemed pretty optimistic. What are the main key takeaways?
Yeah, there definitely were some positive sounds from President Volodymyr Zelensky coming out of that conference. Zelensky's been on the hunt for Patriot missile batteries. Those help protect against the drone and missile barrages that Russia has been launching against Ukraine. He seemed pretty confident that those would be coming, and allies seemed to back that up, saying that Patriots would be delivered to Ukraine and that they were on board with supplying Ukraine with that. Trump said that they would be supplied, but that NATO allies would pay for them. So it does seem some movement there in terms of the deliveries. Of course, this is coming against the backdrop of these incredibly large and growing missile and drone barrages that Russia has been launching against it. So Ukraine really looking for ways to try to shield against those increasingly lethal attacks.
Greg, thanks so much. Greg Sullivan there with the very latest, of course, on Russia and Ukraine. Now, Britain and France have agreed to exchange migrants as part of a plan to deter illegal crossing by boat. Now, the deal was struck by the UK Prime Minister, Keir Starmer, and Emmanuel Macron, wrapping up a state visit from the French president to London this week. Let's bring in Lionel Laurent, our Bloomberg opinion columnist. This is a pilot program. What are the chances of it working?
Yes, that's right. But before we even talk about the chance of it working, it has to be signed off. Macron was very clear to say that this would need to be signed off as well by Europe, because this is an EU border, part of a long-standing issue, but Brexit has kind of made it worse. Now, I think the chances of it working, before we even decide what success is, it'll take political will. We've seen this kind of deal happen between the EU and Turkey, for example, and we've seen that what this can do is bring the numbers down, but it does require political will, because when ties between EU and Turkey got strained, the numbers went up again. So there is always this risk of weaponization of migration. So it will depend a lot on the politics. So it has to be signed off legally first, and then politics will take over.
So what else has come from Macron's state visit to the UK?
So for the UK, this really was a lot about migrants, small boats from the front page of the news in the UK. On the French side, it was a bit different. France's goal is really about geopolitics and defense in the age of Trump and with the war in Ukraine. And we saw a lot of emphasis placed on more defense cooperation, even this talk of nuclear coordination, which is a very interesting signal being sent both to Russia and the US in terms of Europeans doing more, and also satellites. The UK agreed to invest in a French satellite company, which is seen as a competitor to Starlink. So we can see these two countries are getting more constructive and working together better, but they clearly have very different priorities when it comes to their relationship.
How important was this visit when it comes to a reset between the UK and France, and actually the UK and Europe, Lionel?
It's important because I think it's just for France as well. If you think about how the relationship between France and Germany is progressing, Germany is clearly rising now as the leader on the continent with the most room to spend on defense, and Merz is now taking more of a leadership role. So I think France is naturally finding more partners, hedging its bets, and I think given the history of France and the UK and their nature as nuclear power and defense-oriented mid-sized countries, they are still interested in keeping that relationship going. So I think it's pretty important, even if not all the scars have healed.
Lionel, thank you so much. Lionel Laurent there, a Bloomberg opinion columnist, and also check out Lionel's weekly newsletter. It's really good. Coming up, the CEO of Europe's most valuable company on whether Europe can compete on the AI world stage. More from our exclusive interview with SAP's Christian Klein. That's next, and this is Bloomberg.
It's the most fascinating time for the global economy in years, and our conversations are front and center.
We're stress testing consequential ideas, and investors around the world are scoring them in real time,
helping to translate the policies from Washington into actionable ideas for Wall Street.
It's the morning call you actually want to be a part of.
Separating the signal from the noise,
with some fun along the way.
This is Bloomberg Surveillance.
Our global headquarters in New York, I'm Danny Berger. Welcome to Bloomberg Brief. Let's set your agenda.
Bloomberg Brief delivers the market news, data, and analysis you need live every weekday only on Bloomberg. Context changes everything.
Technology is embedded in every aspect of our lives.
And laying the foundation for the future.
From finance to defense, AI to entertainment.
And from the road to the stars. Bloomberg brings you the latest stories of the people and companies pushing the tech sector to new frontiers.
And the politics that shape global tech markets.
I'm Caroline Hyde in New York.
And I'm Ed Ludlow in San Francisco.
Watch Bloomberg Tech every weekday.
Only on Bloomberg Television.
Welcome back, everyone. Now let's bring you a roundup of some of the day's big tech stories. And Tesla is planning to expand its robo-taxi service into California and Arizona. Now, Chief Executive Elon Musk expects robo-taxis could launch in the San Francisco Bay Area in a month or two, pending regulatory approval. Now, Tesla has also applied to operate in Arizona's Phoenix area, with a decision expected by the end of July. It follows a recent limited rollout of the robo-taxis in Texas. Then Apple is planning a pipeline of new products for release during the first half of 2026, including a new low-end iPhone, multiple iPads, and upgraded Macs. Now, a budget smartphone dubbed the iPhone 17e will be a follow-up to a $599 model that Apple launched earlier this year. Now, the new products are part of a push to get back to more consistent revenue growth following this year's iPhone launch. And the owner of the Lidl supermarket chain plans to pitch the German government to be the lead developer of a data center central to Europe's artificial intelligence efforts. While Bloomberg has learned that the billionaire Dieter Schwarz will present the plan to spend billions of euros. Now, the move comes as Germany seeks European Union subsidies earmarked for new AI gigafactories. Now, staying with tech, and European tech giant SAP's recent growth has been powered by a pivot to the cloud, with the company leaning heavily into artificial intelligence. Now, a leader in that space, the CEO, Christian Klein, has been speaking to Bloomberg's Tom McKenzie in the latest episode of Bloomberg Tech Europe. Now, he asked whether he thinks Europe has enough data centers.
You need chips and data centers when someone is consuming it. But, there is not, the same demand for these chips in Europe like in the United States, where you have a lot of companies who need chips for training their large language modules, etc. Here, of course, when you now apply AI, develop software, develop, new AI use cases, of course, there will be at a certain point also a higher demand for chips and for data centers. But, now just focusing on the infra layer, on building data centers, I would predict there is for sure not so much demand right now. So you need to come also from the demand layer, from the top, from the software, from the AI layer, where, again, the ways is not decided yet. And then, of course, what that drives is then finally more demand for chips, but in that order, not necessarily just building data centers for the sake of building data centers.
Is the EU AI Act, is it a hindrance to our development of this technology or a catalyst? How do you see the regulatory environment when it comes to AI?
When I'm sometimes, talking in Brussels or in other, councils in Europe, the first topic is always regulation. And I wonder sometimes, can we maybe first talk about competitiveness and opportunities and how we use now AI to make our industries more competitive? And because then, when you are leading there, then you can ask also the question how to regulate. Honestly, I don't see in Europe now so many AI use cases who need now deep regulation so far. Now, regulation, I'm not against it. The problem with regulation and with the AI Act is
you know, I would say Brussels and Brussels come in with the absolutely right intent. They say, you know what, this technology needs to be regulated. I'm not against that, as long as you're regulating, you know, business outcomes, and you also ensure there is a fair competition. I'm absolutely in for that. The problem here in Europe is they're having all the right strategic intent, but then they are putting this in place. But the member states, they just keep what they have, and then you're just adding another layer. You know, because then you have AI policies all over the place, and then they're overlapping, and the one data protection officer says that, the other says that. You know, it's like going to 5 doctors and they tell you 5 times a different thing. And now you imagine you are a startup and you want to scale your technology, and in every country you are going in Europe, you know, you hear a different story on how to adhere to any kind of AI act.
Well, you can catch more from Tom's interview with the SAP Chief Executive on this month's episode of Bloomberg Tech Europe Online. Tom, with us now, also talking about food and drinks on the sidelines. But Tom, back to tech.
Yeah.
How well positions are SAP going forward?
Before I get to that point, I mean, just going back, 2020 is when he came sole CEO, Christian Klein, and the stock, he pulled the guidance, the 5-year guidance. The stock dropped in 2020 by 30%. SAP stock is since up about 170%. So he's seen this turnaround, and part of that is because they switched away from licenses on-premise for their customers to in-the-cloud agreements, and they've been able to add value and add on to that. Going forward, the question is, that process in terms of moving from on-premise licenses to the cloud, that kind of wraps up in 2027. So there are big question marks about where the growth comes from after that. Christian Klein told me he sees there's going to be innovation. He's lent into AI, and he thinks that's going to propel the stock and the growth going forward. But I think it remains a pertinent question. And just for the context, like SAP is basically the nerve center for about 90% of Fortune 500 companies. The nerve center. It provides the software that manages HR, logistics, finance. That is how important this company is.
Quickly, Jobs?
He has spoken to me about jobs, and he says we are underappreciating the impact it's going to have on the labour market, and that is going to be part of the next episode. We're going to focus on how AI impacts jobs in the labour market. Christian Klein, a pretty clarion call, saying we need to wake up and we need to retrain and educate people about how to adjust to an AI-changed labour market.
Great. Tom, thank you so much. Stick around because we're talking food and drink next. But please, everyone should catch the next episode of Bloomberg Tech Europe. We will look at how AI is changing the labor force. Catch it on August 15th. Now, it's tourist high season in New York right now, but things are quieter than usual. The city set to see visitors drop 17% from last year, a loss of 2.5 million people. But if the Big Apple is dipping as a destination, its brand is more powerful than ever in London, where the New York influence is pervading the food and drink scene on multiple fronts. Well, Bloomberg's food editor, Kate Crater, joins us with the very latest. We're keeping Tom because he has a couple of things to say about Martini Rosso. Kate, so good to speak to you. I've been waiting to understand where we should go here in London for the weekend. I mean, why all this talk about New York food in London?
It's a fascinating time. I think traditionally Brits are not so spontaneous when they go out to eat, and they like to make reservations, and they like to have a culinary experience. And now here we come from New York, giving you all these things that you might not have experienced to its full extent, including pizza. There's great bagels. There's totally bagels that are worth going to eat. There's monster cookies, but especially at restaurants now, you see this really cool New York influence, and it manifests as like friendly waiters who want to, I mean, friendly maybe not, but who want to have a conversation, semi-friendly waiters. And there's steaks, and there's even cheeseburgers on prime menus, prime restaurant menus that you would never have seen before.
I mean, Tom loves a New York dining experience.
Yeah.
I would say we call them bagels in East London, by the way, bagels. We have a long tradition in East London of those bagels. But you were talking about the sloppy floppy pizza, and that's the difference. And I want to get the Italians' take on sloppy floppy pizza.
Uh-oh, here we go.
You're like killing me with sloppy floppy pizza. I mean, I was also told that the best pizza is in Japan, which also made me die inside, but then I tried it, and they were probably right. So what's the New York dining experience like? Is it friendly? Or is it just the dishes?
Well, it's sort of a vibe. It's an energy. I do think that Brits go out to eat to have food that they don't usually make at home. You know, they want to have something that will feel like, oh, this feels special. And in New York, we like to go out to have a party. You know, we entertain in restaurants. Our houses are small, our dining rooms are non-existent, and so restaurants are where we can sort of entertain. And that energy has now come to London. So you feel it if you walk in. There's a buzz. It's just like conviviality. It's really it feels like a different energy, and I think it's contagious. I think you'll see more and more of it.
I love that. It's a vibe.
It's a vibe.
So the summer drink is?
Well, it's a martini, and here we go. There's history, and it is a bit hazy, probably because too many drinks, but it's supposedly originated at the Knickerbocker Hotel in New York City.
So the martini could be officially from New York City.
That you could say that. You could say that. Some would say that. I know. I'm not saying you don't make great martinis here, maybe even better than New York City, but there is a history. New York City goes way back with martinis.
Yeah, 007 may have something to say about it. The old-fashioned is probably where I'd lean to. I'm not sure. It's more of a winter drink, though, isn't it, an old-fashioned?
Yeah, that's pretty alcohol. I mean, so is martini, but martini just feels like sparkling and light, and everyone does it so well. So that is sort of the drink of the summer. But there's also a really cool pop-up called Dante at Claridge's Hotel, and their drink is Garibaldi, I think. It's made with Campari and fluffy orange juice, which is like airy, beautiful orange juice, and like who doesn't want to drink that right now?
But this is the vibe. This is definitely the Pulse vibe on this Friday morning. Our food editor, Kate Crater, thank you so much, as ever, and Tom McKenzie. Up next, a Bloomberg Brief, and this is Bloomberg.
Why do the biggest names in business choose Bloomberg Television?
That's a great question.
It's a very good question.
Interesting question.
Good question.
Great question.
I so appreciate that question.
You certainly ask interesting questions.
Bloomberg Television. Top experts, great questions.
How much does the geopolitical volatility emanating from the United States perhaps undermine the bull case for Mexico? Is that a scenario you've plotted out?
Structurally speaking, we do still have a very positive view in Mexico. On the macro side, it is a very attractive investment geography for the U.S. Mexico is hugely competitive in terms of costs. The wages in Mexico are much more competitive than the wages in China. So why would the U.S. companies not take advantage of that?
And this structural cost advantage is going to lead Mexico to continue to contribute to the growth of U.S. as well. The value chains, the supply chains are so integrated that Mexico has to play a continuing role in the further development of the U.S. And U.S. is growing very healthily, very nicely. It will benefit Mexico. This way or that way, it will benefit Mexico.
Mexico for BBVA is, a source of resiliency of earnings, and it generates and complements the diversification that we have from the footprint. But there's another topic that is very important, which sometimes we don't focus a lot about, and why we're so convinced that Mexico is going to continue to do well, which is the leverage in the country. Because the leverage in the country is only 33%. And when you've seen Mexico grow and BBVA grow in Mexico, structurally speaking, the leverage is so low that just a little bit of growth in the leverage is going to be able to support that bull case in Mexico. So that's why we're structurally positive in Mexico.
Good morning. This is Bloomberg Daybreak Europe. I'm Tom McKenzie in London. These are the stories that set your agenda.
Taking you from the U.S. markets close to the overnight session in Asia, we'll walk you through what you need to know to kickstart Europe's trading day. Live from our European headquarters, we bring you the day's top market-moving stories, unmatched expert analysis, and on-the-ground reporting from across the continent. Tune in to Daybreak Europe, only on Bloomberg Television. Context changes everything.
At a time when policy in Washington is driving Wall Street, we draw a distinction between the rhetoric and the action, bringing you market-moving guests and original reporting. This is Bloomberg Surveillance.
It is 5 a.m. in New York City. Good morning. I'm Lizzie Burden with your Bloomberg Brief in for Danny Berger. Here's what you need to know. More tariff tension. President Trump threatens a 35% tariff on Canada, along with blanket levies of 15 to 20%. Retreating from a record, U.S. equity futures slipping as the president ramps up his trade agenda. and preparing for an announcement. President Trump plans to make a major statement on Russia on Monday as he mulls sanctions on the country. Well, the game of chicken continues. You had the S&P hitting another fresh record yesterday, thanks to partly those Delta earnings better than expected. But the president caught wind of that, and he's escalated again when it comes to trade. The tariffs on Canada, but also raising that global tariff. Now, yes, we've got Wall Street futures lower this morning. We're down 0.5% on S&P E-minis. But how long is this negativity going to last? We heard from JP Morgan's Jamie Dimon saying this market is complacent. So how long before it's egging the president on again? Take a look at your Treasury market as well. Yesterday we had yields up higher across most of the curve. That 30-year bond auction going off pretty much without a hitch, despite the tariff concerns, despite the concerns about the deficit. And when we look at euro dollar, we're down again today, down at 116, because on the flip side, the dollar is reprising its role as a safe haven. How long does that last? Keeps on happening this week. Let's get to Joe Easton. He's got a few of the pre-market movers for us. Joe, what are you watching?
Morning, Lizzie. So we've got a big jump in Levi Strauss following the company's earnings report after the close of trading yesterday, beating expectations, and analysts saying there is further to run in terms of where the earnings are going to go. This is all about the head-to-toe denim fashion, which I always thought was a bit of a faux pas, double denim. But what do I know about fashion? It is doing well for Levi, boosting that stock. We're up 7% today. Then in terms of drone stocks, these ones are also in focus, getting a bit of a boost today as Trump and Hesketh look to ramp up production of drones and usage, cutting back regulations on the sector, making them more popular. So we're seeing boosts for Red Cat and also Kratos, a couple we had pulled out today. Then finally, one more to bring you back here in Europe and back in the apparel space. Weakness in the Gucci owner Kering as analysts at both Goldman Sachs and Bank of America issue warnings on the luxury goods sector. BofA saying it's worried about the outlook for earnings in luxury. And as usual, check out the Before the Bell opening wrap for a summary of all these news movers and more, Lizzie.
Joe, trust you to bring up a Canadian tuxedo on a day when Canadian tariffs are in focus.
It's on brand. It's, it's in vogue at the moment, Canada.
Thanks for not wearing it today, though. Joe, we'll see you in half an hour. Now, in just moments, we're going to be speaking to Henry Allen of Deutsche Bank on his read on the risk to markets. And then we'll be speaking to Lindsay Newman of G0 Media to talk about the current geopolitical risk landscape. But first, let's focus on these markets. The S&P 500 hitting another fresh record at yesterday's close, despite investors remaining cautious over President Trump's trade agenda. Joining us now is Henry Allen, macro strategist over at Deutsche. Morning, Henry. I don't know what you make of this, but JP Morgan's Jamie Dimon says this market is complacent. Maybe not this morning, but in general, as you look at all of these fresh records, is he right on the S&P?
I would push back against that slightly, actually, because, yes, markets are facing an array of risks this year, whether that's tariffs, fiscal policy, geopolitics. But actually, if you look at the macro fundamentals, they remain in a pretty good place. Yes, of course, we had Liberation Day, and there were those widespread fears that the US might be about to plummet into recession. But then actually, if you look at the data since then, we've had 3 months of payrolls, and all have been in the 100 to 150,000 zone, so no sign of a recession at all. Indeed, that resilience has been pretty remarkable. So on one level, in terms of the economic fundamentals, it's justified. And then if you look at the fact that policymakers have repeatedly shown that every time there's market turmoil, they will dial things back, and we've seen that with Trump consistently in both his first and his second terms, then I think there's a fully justified reason why markets are trading at these levels.
So basically markets will be the guardrails on the president, I feel, is your argument here. But look, Dimon's also warning that the inflation hit is coming. It may not be here yet, but it is coming. And he says that the Fed is going to hike. There's a chance of that by 40 to 50% hike, not cut. Henry, what's it going to take to trigger that scenario when it comes to the effective tariff rate chosen by the president?
I think there's a pretty high bar for the Fed to hike in this sort of environment for several reasons. One of which is that they have, of course, said that their aim is to cut for the time being. Indeed, they still penciled in 2 rate cuts in their dot plot by the end of the year. So the first step, if they were to become more hawkish, wouldn't be to hike, it would just be to hold policy for longer. And then, of course, at the same time, we need to remember that there is an increasing amount of political pressure on the Fed not to hike. And they know that if they were to hike, then that would only increase that pressure and incur Donald Trump's wrath. So, you know, from a political standpoint and from an economic standpoint, it's difficult to imagine that inflation gets to a point where they would want to be hiking rates, at least in the near term, particularly when you account for the fact that several Fed speakers have said that they still think policy is in slightly restrictive territory.
So speaking of that political pressure on the Fed to cut, I was speaking to Frank Munkham yesterday, and he said that ironically, that makes the bar higher for the economic evidence to justify the Fed cutting. Do you agree with that?
I do, actually, because from both an economic and a market standpoint, the Fed will want to prove their independence. They don't want to seem as though they're like the central bankers of decades past who caved into political pressure. And yes, that might have been a brief short-term boost for growth in the short term, but in the long term, that actually made things worse, particularly with inflation getting out of control. That's been the mistake of central banks at several points in history. Indeed, it's why politicians actually gave central banks independence across many countries, because there was a recognition that when politicians interfered in interest rates, they tended to set them too low.
And so there's a higher bar for the economic evidence, but on top of that, we've had the deadline delayed by 3 weeks for tariffs to August 1st. It's going to take even longer, surely, to not just see the inflationary impact of tariffs, but settle the debate on the FOMC about whether this is transitory or persistent. Surely that pushes back when the Fed is going to cut from September.
Well, I think it will hinge on a couple of things. I think, firstly, this coming week's CPI print from the US is going to be really important, because if the inflationary impact of the tariffs does start to show, then I think it's in this print that we'd start to see it. Because, of course, even though Trump did push back the reciprocal tariffs by 90 days, that 10% baseline was still in place throughout that period since April. So if we're going to see the impact of the inflation on the data, it's actually this next week's report where we'd start to see that. So if we see inflation ticking up, then I think that certainly raises the bar for a cut anytime soon. And then I think the other factor we've, of course, got all on our minds at the moment is what does happen on August 1st, because yes, Trump has said that's the new deadline, but then we've seen U-turn to the administration before. We saw, after the original Liberation Day on April 2nd, Trump said, my policies will never change, and it was only 5 days later that he then executed the 90-day extension. So it would be entirely in keeping with what we've seen so far if we were to get another extension. I don't think that's guaranteed, given how many extensions there have been already, and we have indeed been surprised in both directions. But clearly, I think that's very much in doubt right until the final hours. We saw back in February, actually, when Trump threatened 25% tariffs on Canada and Mexico, those were postponed with just hours to spare. So I think we won't have a good sense of that until August 1st itself.
But Henry, you've noted that we're approaching that time of year when crises do blow up. You reminded me in your notes that this is the sort of time of year when you had the yen carry trade unwinding last year. Liquidity is thin. What sort of event would trigger a similar sort of crisis this year?
Well, I think there's a few candidates. I mean, one, of course, is that August 1st deadline on the tariffs. Another is if the inflation print comes in hot and then markets price out the rate cuts. I think fiscal fears are very prominent as well right now. We saw that in the UK last week when Rachel Reeves' position looked under threat, and in particular, markets weren't so concerned about Rachel Reeves. What they were concerned about was this idea that a new Labour Chancellor might ease the fiscal rules, which basically is code for borrow more money, and markets, particularly bond markets, weren't a fan of more issuance and higher national debt. So if there were some moment like that again, it could be in any country. Indeed, we've seen a lot of fears in the US, France, Germany, and other places with long-end yields pushing higher, then I think some kind of fiscal event like that could cause real difficulties if something transpired over the summer.
And just finally, Henry, you're looking at euro-dollar down about 0.8% so far this week, the dollar up again in these uncertain times. Have we gone a bit too far with the dollar weakness narrative?
I think to some extent it might be a bit overplayed in the short term, but I am sympathetic to the idea that the dollar will likely continue weakening, because the problem that the US has at the moment is there's just this chronic policy uncertainty that isn't going away. With the tariffs, we're kind of at the point where it's like we're on season 27 of some long-running TV series, and if you haven't been following right since the start, then you've kind of lost the plot by now. And as long as this uncertainty keeps persisting, then I think that's going to raise doubts about the stability and credibility of US policymaking. And that may not be an instant thing, that may be a slow thing that happens over time. But as it does, then I think that is going to take some of the support away from the dollar. I don't think that's going to be a huge move. I don't think the status of the reserve currency is coming under threat, but certainly do I think more weaknesses in the pipeline? Yes, I do.
Really not a box set I want to rewatch, Henry. Henry Allen of Deutsche Bank, thanks so much for ending the week with us. I hope you have a great weekend. Now, to other stories trending on the terminal this morning. The UK economy shrank for a second straight month as companies and consumers struggled to bounce back from US tariffs and tax increases. GDP declined 0.1% in May, according to the Office for National Statistics, and Chancellor of the Exchequer Rachel Reeves said that the latest figures were disappointing. Elsewhere, Brazilian President Lula da Silva insisted that Brazil can survive without trade with the US and will look to other partners to replace it. This comes after President Trump threatened 50% tariffs against the nation. The US is Brazil's second largest trading partner, following only China. And New York City Mayor Eric Adams raised more than $1 million for his re-election effort in a single night at a fundraiser in Manhattan. His campaign has gotten a boost from donors and business leaders opposed to Democratic nominee Zoran Mamdani. Michael R. Bloomberg, the founder, of course, and majority owner of Bloomberg News parent Bloomberg LP, has endorsed Andrew Cuomo. Well, coming up on the programme, Trump doubles down on his tariff regime. We're going to dissect the latest salvos next. This is Bloomberg.
Business Week Daily.
We got to talk crypto.
From the magazine that helps global leaders stay ahead.
What's the conversation around your company?
Bringing you insight on the people, companies, and trends shaping today's complex economy.
Planning very big things.
A new level of premium.
Plus global business, finance, and tech news as it happens.
The floodgates of innovation are going to open up.
You can't fake passion. You either are or you aren't.
Bloomberg Business Week Daily, only on Bloomberg.
What is going to be the consequence for U.S. markets? We are basically deep in the European earnings season.
Take a look at how we're faring when it comes to Asian markets.
Bringing you up-to-the-minute geopolitical news whenever and wherever it happens. I'm David Gura in Alberta, Canada, and this is Bloomberg.
Jumpstart your trading day on Bloomberg Open Interest.
2 hours of single stock stories that are driving the opening bell action.
We'll take you to Wall Street, Main Street, the C-suite, and beyond.
These are companies that are growing their market.
The great companies in the U.S. are the companies hitting the cutting edge. That's a different story.
Get the inside track on what's buzzing in markets.
With the players who are shaping the narrative.
If you have bad earnings reports, you're going to get punished.
They're not buying what the industry is selling. Join us on Bloomberg Open Interest. Every trading day, only on Bloomberg.
This is Bloomberg Brief. I'm Lizzie Burden in New York. Now, this week has been dominated by tariffs, and President Trump's added further fuel to the trade war fire by threatening a 35% tariff on Canada, as well as floating the prospect that he may raise rates even higher. Now, let's bring in, for the latest, Bloomberg's Kasia Klimasinska in D.C. and Min Min Lo on the ground for us in Kuala Lumpur. So, Kasia, I'm going to start with you. We've got this Canada tariff threat, 35%, but how much does USMCA actually buffer the impact of that?
Good morning. Indeed, here in DC, we hear about new tariffs pretty much every day. And yesterday, President Trump announced this new 35% tariff on Canada. But indeed, it's only on goods that are not included in the trade deal between the U.S., Canada, and Mexico, the USMCA trade deal. And also, some energy goods are excluded. So there might not be a big impact from this tariff. And anyway, it doesn't kick in until August 1st. But of course, the number is significant, and it's coming against one of the key trading partners here for the U.S.
And meanwhile, Min, U.S. Secretary of State Marco Rubio has been meeting his Chinese counterpart Wang Yi on the sidelines of the ASEAN talks in Malaysia, where you are, where tariffs are really in sharp focus. Of course, it's their first face-to-face meeting since Trump got back into office, and I just wonder what the readout was from that meeting.
Yeah, we just saw Foreign Minister Wang Yi actually walk out of that meeting room about slightly over half an hour ago. We don't have any readouts from either side yet, but when Wang Yi walked out, we were shouting a number of questions at him. He didn't take any questions from the press. He nodded and smiled at us and walked straight out. We were not allowed to follow him out. The security was kind of blocking us. So no information yet. I guess the only point of observation that I have now is the two men met for almost exactly an hour, which tells you that, perhaps that talk wasn't so exuberant that they would want to, overrun the timing allotted. It was pretty much, just making use of whatever time they have, very on time, and then they left. We know that Marco Rubio mentioned ahead of this meeting that he was planning to raise the issue of Russia with Wang Yi. He said China has been offering as much help as it can to Russia without getting caught, and this is something that the U.S. takes issue with China on. And this coming ahead of President Trump's announcement that he plans to make on Monday, possibly something about sanctions on Russia. Of course, the big question is whether or not there will be secondary sanctions on countries like China that has been buying LNG and oil from Russia. And of course, the other big question is the question of whether President Trump will be visiting China anytime soon. Marco Rubio didn't really say whether that was on the agenda. That's something we really want to find out, whether they talked about that, how much progress they had in laying the groundwork for that.
Okay, and Kasia, meanwhile, we've got Vietnam actually raising its concerns about the deal that Trump says was agreed with Vietnam, that it agreed, he says, to this 20% tariff, but it says it wants a lower rate. Is it actually likely to come down that rate, given that he's now raised the global tariff to 15 to 20%?
Indeed. So initially, Vietnam was one of the very few countries that managed to secure some sort of an agreement with the U.S. But now, Vietnam saw that President Trump is also mulling a 15 to 20% blanket tariff, so on all countries that didn't reach any sort of an agreement. So obviously, Vietnam wants to come back to the table. But remember, the U.S. is still negotiating with almost 200 countries. And President Trump has now said several times that he is kind of losing patience, that it's too much, that he will just send around those letters and set the tariff rate. So even if Vietnam wants to talk, I'm not sure what the outcome will be. But again, there is still plenty of time. President Trump set this new August 1st deadline. He has moved those deadlines several times before.
And Kasia, if the point of cranking up tariff deadlines before August 1st, even if that deadline moves again, is to try and force other countries into trade deals, where do we stand at the end of the week in terms of who's most likely to be next to sign a deal?
That's a very good question. I think the EU is out there, cruelly still negotiating. I think India is also there. I believe that Secretary of Treasury and Secretary of Commerce, Howard Lutnick, will travel to Asia, to Japan next week. So clearly, Japan is on their mind.
And Min, you talked about some of the other geopolitical issues that have been raised between Rubio and his Chinese counterpart here. Russia, of course, in focus. How close does it look like we may be to a Ukraine ceasefire, given the context of the discussions that are happening where you are?
The U.S. Secretary of State Marco Rubio also
that is
met
something
his...
that...
Apologies, Min, it would be lovely to hear what's going on there in the perspective from Kuala Lumpur.
Yes, Well, the Ukraine war has been going on for quite a while, and I think, China has been very careful about avoiding additional sanctions by not sending additional arms. They have also said that they are cracking down on those dual-use equipment that are being sent to Russia. But, Rubio had a meeting with Sergei Lavrov earlier this morning as well, and he came with a warning that more sanctions could be headed for Russia. The U.S. is introducing, or at least the Senate has been introducing a bill that could potentially sanction countries that buy Russian petroleum, LNG, and oil products. So that is something that I'm sure China would be very concerned about if the threat is going to hit them directly. But, there are so many other issues between U.S. and China to talk about, not least of which, of course, is the trade tensions, although that is where Marco Rubio doesn't really have a lot of power. Scott Bessent has said he's going to speak with his, or meet with his Chinese counterparts in the coming weeks. But other issues, including the Taiwan issue, which is always a red line that China has taken up with the U.S. And there is also the South China Sea issue, the export controls of high-tech equipment, a lot of these things. But again, it's the first time that the two men are sitting down to meet. The fact that they are meeting at all is a good sign that at least relations is perhaps warming up a little bit, because the two men had a chance to meet in February at the sidelines of the UN Security Council meeting, but they didn't take that opportunity then. So the fact that it's happening at all is quite a breakthrough. But as to whether or not there is any forward movement on specific issues, I think that's a very high bar. We'll have to see what comes out from the readouts later.
Yeah, a significant meeting, but what the market really wants is that Trump-Xi meeting, isn't it? But Min Lo, we wait for that. And Kasia Klimasinska, thank you both so much for that team coverage. Coming up on the programme, a look at what else is making headlines around the world. This is Bloomberg.
AI should be for everybody, from leaders to the working on floor. And we can save 90% of time, 50% of workforce. AI is core in centers of change. And therefore, we invest heavily to AI. Actually, we started more than 10 years ago because we think the machine in the past helped our hand and legs. Now the machine helps us in brain.
Are you betting all your money in this right now?
When the OpenAI appeared, immediately I asked whole corporations study how will you bring generative AI to their job.
Making money isn't about drowning in emotions. It's about understanding what's actually happening. Markets are the best way to glean signal from noise, and that is what we try to do every morning. This is Bloomberg Surveillance.
The flood of investment agreements.
Deals were once again on display.
The Saudis are open for business.
The cessation of sanctions against Syria.
Another big victory for the Crown Prince, concerned that none of the guardrails may be set up just yet.
Headline after headline.
Trust Bloomberg for on-the-ground coverage.
The numbers will be quite substantial.
Up-to-the-minute reporting.
Driven the price of oil down.
And the analysis you need.
He's basically going to vault this region into the same sort of sphere as the US and China.
No one covers geopolitics like Bloomberg.
This is Bloomberg Brief. I'm Lizzie Burden in New York. Let's look at your front pages now. A look at what's making headlines around the world. First up, the New York Times. Kerr County, Texas had flagged the need for a flood alarm months before the devastating tragedy, it turns out. A report by FEMA in October stated that it was likely the county would experience a flood event in the next year that could result in, quote, increased damage, injuries, or loss of life, and officials noted that a flood warning system could be a solution, but none had been installed. Next up, let's look at the Wall Street Journal. They splash on a report that the investigation into last month's Air India crash is focusing on the actions of the jet's pilots and doesn't point to a problem with the Boeing 787 Dreamliner so far. Now, the preliminary findings indicate that switches controlling fuel flow to the engines were turned off, leading to an apparent loss of thrust shortly after takeoff. Family members of both pilots declined to comment to the Journal. And on the front of the Financial Times, the US State Department has notified its staff that it's going to fire hundreds of US-based employees in the coming days following the Supreme Court's decision this week. The Trump administration's plan would eliminate about 15% of the department's workforce. This is according to the department spokesperson. And the reduction is part of a wider effort by the White House to eliminate tens of thousands of jobs across government agencies. So those are your front pages. Coming up, we're going to digest the risk landscape in geopolitics with Lindsay Newman. That's next. This is Bloomberg.
There is a nice confluence between the long-term investor and what we're trying to do. We have an operating principle that's in our handbook, take the long view. When we went public, we put a timeline up on the screen for the whole company in an all-hands meeting. And that timeline went from founding to 100 years out. And the IPO was one dot in 1 year on that timeline. And we tried to orient the employees to, this is a wonderful event, this IPO, but it's a moment in time on a very long journey.
This is a company that you want to exist in 100 years.
We do.
Wall Street doesn't think in...
No, they think in like hours. Yeah. And what I've learned of Wall Street, and particularly Wall Street investors, when they say they are long-term investors, that means they'll keep your stock for like a month. There has been one instance where I did something that was just for short-term stock, and I felt so bad about it that I don't think I'll do it again.
What was that?
There was one quarter, a few quarters ago, we were not going to beat the quarter. We were going to probably just hit it. And so far, we beat every quarter. So we were all like, wait, what? Our perfect record. We're like a 4.0 student that is going to get a B for the first time. This is not good. And I decided that for a short period of time, at the end of a lesson in our app, we would show 2 ads instead of 1. Turns out that that by itself was good enough to beat the quarter, but it's bad for the product. It's not good. After that, I am never doing that again.
Why do the biggest names in business choose Bloomberg Television?
That's a great question.
It's a very good question.
Interesting question.
Good question. Great question.
I so appreciate that question.
You certainly ask interesting questions.
Bloomberg Television. Top experts, great questions. U.S. jobs numbers are released. Bloomberg has the report under surveillance with crucial data and expert analysis at terminal speed. Nobody covers Jobs Day like Bloomberg.
It's 5:30 a.m. in New York City. Good morning. I'm Lizzie Burden with your Bloomberg Brief, standing in for Danny Berger. Here's what you need to know. More tariff tension. President Trump threatens a 35% tariff on Canada, along with blanket levies of 15 to 20%. Retreating from a record, US equity futures slipping as the president ramps up his trade agenda. And prepping for an announcement, President Trump plans to make a major statement on Russia on Monday as he mulls sanctions on that country. Well, good morning to you if you're just joining us. And it looks like this market just cannot resist egging on the president. We had the S&P hitting another record high yesterday, helped by those Delta earnings. And then the president saw that and slapped even higher tariffs on Canada of 35% and the rest of the world. So, look, now Wall Street futures are inching lower again as we head towards the open. But how long before stocks get back on their feet? We had JP Morgan's JB Diamond saying that this market is complacent. If you look over to your Treasury space, we've got yields higher across the curve today again for all the concerns about the deficit, about tariffs. You had that 30-year bond auction going off without a hitch yesterday. And take a look at euro dollar. It's on the back foot again today. The dollar up again. So the greenback taking on its role again as a safe haven in these uncertain times. It seems to be a pattern, but we'll discuss in just a moment. That's your broader markets, but let's look at some of the individual stocks to watch with Joe Easton. Hey, Joe.
Hey, Lizzie. So we're seeing some strength in Levi Strauss today after the Levi Jean makers earnings last night, beating expectations, and analysts saying actually there's more to run in terms of where the outlook is going for the company. Now, the company is touting the double denim trend, which I always thought was a bit of a fashion faux pas, but kind of showing how behind I am on that. It's the head-to-toe denim trend boosting Levi's, and the stock up 7%. At the moment. Then we've also got drone stocks in focus. Trump and Hesketh looking to deregulate the sector and make them more widespread in terms of in different sectors in the US. And we're seeing a boost in Redcat up 14%, Kratos gaining 4%, and AeroVironment as well. Both of those getting a boost. Then moving back to fashion here in Europe, weakness in luxury goods stocks today, particularly Kering. The Gucci owner set to see another decline in earnings, according to analysts at Goldman Sachs. Bank of America also out with a note today saying they're very worried about the outlook for luxury goods stocks. So we're seeing all of them declining here in Europe. Keep an eye on those as the trading progresses today, Lizzie.
All right, Joe. I think you could pull off double denim. It looks good with a tie, in my opinion.
I'll give it a go next week. Stocks to watch.
I'll hold you to it. Joe Easton, thanks for all your work this week, Joe, with our stocks to watch. Now, on the broader markets, let's turn to Noor Al-Ali, Bloomberg's Markets Live editor and strategist, because, Noor, I mentioned about these dollar moves. It looks like a safe haven again today. Should we read into this pattern?
I'm afraid not, Lizzie. Look, I mean, if you really try to zoom out in the past few days, you'll actually see that complacency that you've talked about, that Jamie Dimon's talked about, even showing up in the dollar, really just trading a little change, even though if it's up a little bit today, you know, a lot of those moves, even if as we see the dollar boost itself in recent sessions, in reality, though, that risk-off move that we've been seeing, more realistically so, traders and investors are hedging against further downside. There's also some, you know, if you look at the analysis, the dollar now falls twice as much or, you know, more often than with stocks than it did before. So that really points to the fact that it's trading more as a risk asset and really a source of that volatility than a hedge.
And just talk to us about Bitcoin as well, Noor, because is it going to go higher from here?
Look, I've done some analysis in the past few sessions. What's interesting about this rally, obviously there's a lot of policy support coming in from the White House. You know, those campaign promises that we heard from Trump for the bulls are finally coming to fruition, and that's something that's boosting Bitcoin to records that we've seen, that we haven't seen before. If you look at open interest, while it's soaring, it hasn't reached that peak that we saw back in December, because the moment that open interest peaks, as we saw in December, that's when it tends to fall back, and that's when we see a pullback, at least in Bitcoin. For now, though, you are seeing soaring demand in ETFs, you are seeing open interest rise, you're seeing that institutional backing really come into cryptocurrencies, not just boosting Bitcoin, but also altcoins. So this rally seems to be the only thing that's moving markets at the moment in a broader sea of complacency, as we've just discussed.
All right, Bloomberg's Noor Al-Ali, we thank you so much for that update on the markets. But I want to take a step back from the markets and survey the current risks when it comes to trade and geopolitics as well. Lindsay Newman, who is geopolitical risk expert and columnist for G0 Media, I'm pleased to say, joins me now. Morning, Lindsay. We were just talking to Noor there about the S&P hitting this fresh record yesterday. Jamie Dimon saying that the stock market is complacent. But I wonder whether that complacency is emboldening the president to prove that he doesn't always chicken out.
Absolutely. Thank you so much for having me on, Lizzie. Look, we know that the Trump administration this time around is ambitious. I've been saying this for months. This is not your Trump 1.0 foreign policy. There's no stone that's being left uncovered. We've had a lot of irons in the fire. If we were talking not even a month ago, we would be really focusing on Israel and Iran. Last week, we would be talking about the big, beautiful bill. But this week, it's all about Ukraine and really about the global trade agenda. As you say, there's a talk everywhere about uncertainty that was being phrased as radical uncertainty. The U.S., the greatest export coming from the U.S. right now, the most notable export coming from the U.S. right now is political risk. The president likes to call this keeping the U.S. in the driver's seat. And what that means for global stakeholders is they're not really sure what's coming next. They're quite nervous about it. They're hoping that they can just ride the waves and that the waves aren't too big. And when they come their way, they can quickly exit the strategy. But that's cold comfort when we're talking about an effort to reorganize the global financial system, the global trading system, and really big questions around security.
Well, just as we're speaking, Lindsay, Marco Rubio, the Secretary of State, of course, is speaking in Kuala Lumpur. So we've got some pictures here of this address that he's giving. Of course, as we were just discussing with Min Min Lo, this is the first time that he's meeting his Chinese counterpart this second Trump administration. So we'll keep listening into that while we're talking, Lindsay. And let's just focus in on one particular tariff that we've heard about this week, and that's copper. Because as we look at the US domestic capacity for copper production, it really is years away from being able to stand on its own feet. So when you talk about uncertainty, do you think that actually it's inevitable that Trump is going to chicken out when it comes to these 50% copper tariffs?
What Trump is looking to see here happen is by putting these numbers out, putting a proposal of 50% tariffs on copper, overnight raising the possibility of the global tariff rate from 10% to 15 to 20%. You know, the numbers matter. But what Trump is really doing here is putting forward an anchoring position. He's naming his price. He's saying, this is my ideal target, 50%. Whether we land there or not is not necessarily the objective. The objective is to change the conversation and therefore as a forcing function to change behavior. We've seen this in the long run with, for example, NATO security spend, right? 2% was a target that he put out there years ago. Everybody in Europe thought, how are we going to reach that? Now we've committed to 5%. We see the same thing with Canada tariffs. It's caused Canada to rescind the digital service tax. They've sort of been a victim of their own success there because now Trump is threatening 35% tariffs on Canada overnight. These 50% tariffs on copper are because Trump knows that copper is key to the future of electrification of cars. It's a key mineral for the future of energy electrification and modernization. It's going to be coupled with further efforts to deregulate, to increase domestic mining on copper. That's a long game that he's been aware of and talking about for multiple administrations here. Yeah. But it's not about the 50% number. It's about changing the conversation.
Well, you mentioned the digital services tax. Do you think that Mark Carney is having a bit of regret now that he's thinking, oh, I gave Trump an inch and now he wants to take a mile? He's upped those tariffs again. Maybe do you think Trump wants some ground given on USMCA?
Mark Carney must be thinking, how do we get it right here? Justin Trudeau tried cooperation and then he tried confrontation. Mark Carney now is the incoming PM with a mandate coming in, has tried to be cooperative towards Trump, tried to be collegial and lean into the fact that they are very close allies, that the trading relationship is key to both markets. He must know, though, that Trump has the USMCA renegotiations in mind. And again, it's about the 35% number was a target that was put out. out there. It will have the effect of chilling the headlines and chilling the Canadian political apparatus at the moment, but it's not going to be the landing point. It's about shifting the perspective and changing the behavior that will come from it.
And Lindsay, we've just heard from Rubio there saying that the odds are high for a Trump-Xi meeting, that they've got a very positive relationship between the two of them. When do you expect that? How optimistic are you about the next step in this relationship that we've seen progressing in Geneva and London and now in Malaysia as well?
There are certainly positive indicators about the reopening of channels of conversation, of dialogue between the sides, but we have to be cautious about this. Both sides are being quite thoughtful and careful now about economic security as national security. We know, for example, in response to the high tariffs that have been imposed against China, China has responded by export restrictions on rare earths, which are going to be a huge choke point for a number of supply chains of importance in the future, now and in the future. So it's a cautious optimism, but this is a long-term strategic, we used to use the phrase for years, strategic competition. These dynamics have not abated.
And meanwhile, the president says that he plans to make a major statement when it comes to Russia on Monday. He's expecting the Senate to pass these sanctions. Do you expect the president to use these sanctions?
Yeah, so we know that Donald Trump had hoped to bring a conclusion to the war in Ukraine very quickly. He'd initially said day one, then over time had moved that timeline to 6 months. We're at 6 months, and the administration must be privately frustrated, and we're seeing this spill over into the public. They're realizing how sort of intractable the conflict is, what the limits of relational diplomacy, relational foreign policy is. I do expect that this big announcement will be based around the potential legislation in Congress, congressional action of a sanctions bill. And it's not so much about whether they will be applied, it's whether they will be applied and then implemented. And that's been a big question, how much this administration has sort of loosened the reins on implementation and constricting Russia's movement and ability to retain revenue around its energy markets and energy resources. And that will be the key lever that the administration will look to pull.
Well, yeah, the president must be incredibly frustrated that his goals of peace haven't been met yet. He says as well that a Gaza ceasefire is close. What's likely to come first, do you think? Peace in Ukraine or peace in Gaza?
We know that Trump has his eye on that Nobel Peace Prize. It's a long-standing ambition of his. He says his greatest legacy is going to be as peacemaker. So, he's looking all around the landscape, and he sees that Russia has, again, the Ukraine conflict is quite intractable. If I were a betting lady, which I'm not, I'm a political risk analyst, but if I was a betting lady and looking into a crystal ball, I would think that the dynamics are closer on Gaza. The conversation is quite active. We know that there's a potential for another 60-day ceasefire. And the dynamics in the Middle East have just dramatically changed in the last year. We have a change in regime in Syria, a weakened Iran. Most of Iran's proxies have been quite degraded, although we've seen some recent action, again, by the Houthis in and around the Red Sea. So those dynamics feel like they could be more easily resolved, but it's an incredibly difficult conflict over there as well.
Well, Lindsay, you're talking to betting markets, so your analysis is always appreciated. Lindsay Newman of G0 Media, we thank you. Have a great weekend. Now, to other top stories trending on the terminal this morning. The UK economy shrank for a second straight month as companies and consumers struggled to bounce back from these US tariffs and UK tax increases. GDP declined 0.1% in May, according to the Office for National Statistics. Chancellor of the Exchequer Rachel Reeves said that the latest figures were indeed disappointing. Elsewhere, Brazil President Lula da Silva insisted that his country can survive without trade with the US and will look to other partners to replace it. This comes after President Trump threatened 50% tariffs against the nation. The US is Brazil's second largest trading partner, following only China. And here in New York City, Mayor Eric Adams raised more than $1 million for his re-election effort in a single night at a fundraiser in Manhattan. His campaign's gotten a boost from donors and business leaders opposed to the Democratic nominee Zohran Mamdani. Michael R. Bloomberg, of course, the founder and majority owner of Bloomberg LP, has endorsed Andrew Cuomo for mayor. Well, coming up on the programme, Tesla targets new states for its robo-taxi expansion. Details on where it's heading next. This is Bloomberg.
technology is embedded in every aspect of our lives.
And laying the foundation for the future.
From finance to defense, AI to entertainment.
And from the road to the stars. Bloomberg brings you the latest stories of the people and companies pushing the tech sector to new frontiers.
And the politics that shape global tech markets.
I'm Caroline Hyde in New York.
And I'm Ed Ludlow in San Francisco.
Watch Bloomberg Tech every weekday.
Only on Bloomberg Television.
As Bloomberg's global financial correspondent, I get to meet the people shaping the way money flows around the world. And I want to bring you with me.
Now we're playing.
Yep, now we're playing. First and foremost, I am a capitalist. The capitalist system is the best system in the world. There isn't another one that works as well.
Citigroup moves $4 trillion a day.
5.
Wall Street used to be a place.
I love all these new Wall Streets. Y'all Street, Wall Street South.
Now it's more of an idea.
The optimism here is infectious.
You think our New Yorkers are negative?
Yes.
Anything that trains people to understand probabilities and just think through things with a greater degree of nuance is a service to humanity.
I hope you survived the day.
I did. It was a busy day.
Listen carefully. Can you hear the rhythm in the markets? Not just in the syncopations triggered by inflation, but in the preludes leading to global elections, in the dissonance that moves the Nikkei, and the rising course conducted by AI. There's music in the markets, and if you want to learn to listen for it, we'll show you how.
This is Bloomberg Brief. I'm Lizzie Verdon in New York. Now, Tesla is planning a robo-taxi expansion, aiming to bring driverless cars to California and Arizona on the heels of last month's rollout in Austin. Of course, Grok 4 dropped earlier in the week, so let's ask Matt Bloxham, senior analyst for Bloomberg Intelligence, whether Elon is firmly back in the driver's seat. Matt, what do you reckon?
Yeah, I mean, I think he's definitely in the driver's seat. I guess the question whether he ever left it, but I think the question for shareholders right now is whether he's definitely got both eyes firmly on the road ahead for Tesla and not distracted by, other projects, not least SpaceX and his political ambitions. Obviously, we've heard some pressure recently from shareholders that the board needs to kind of apply more pressure to Elon to be much more focused on Tesla. And there's even been some suggestions that maybe it's time for him to step down as CEO. And obviously, that's worked quite well for SpaceX. So, yeah, definitely you can see his influence coming very much back to Tesla, and they're really diversifying away from just the cars into robo-taxis and beyond. So I think there's going to be a lot of interesting announcements in the coming months to do with Tesla as he kind of gets back into that kind of regular mode of operation.
Yeah, a pretty bumpy ride for the stock price so far this year. And similarly, you've had pretty spotty demand for Apple over the past 2 years. And we know that they're planning this ambitious pipeline of new products for release in the first half of next year. Do you think that these models are really going to be all that different, Matt?
I think that certainly the lineup they've got for next year, which is kind of low-end iPad and the cheap iPhone, the 17e, maybe not that different, more incremental product developments. Obviously, I think that the big focus is really on the full launch, which is really the spotlight for the new iPhone 17, which I think is going to be a bit more of a significant launch. And there's talk of the iPhone Air, a kind of very thin version of the product. So I think to some degree, they want to sensibly phase their products and really kind of give the iPhone 17 enough kind of its own space, if you like, to kind of really drive sales in the near term and then balance that out with other products into next year. And also we've got the whole tariff situation, which continues to be very uncertain. And I think with some of these products, there's perhaps a question mark for them about where can they price these or whether should they price these, depending on how much the tariffs end up being and when they kick in. So I think there's certainly some uncertainty there for Apple in terms of their pricing strategy for some of these products in the next 12 months.
Yeah, it could be difficult if that coincides next year. Matt Bloxham of Bloomberg Intelligence, good to see you. We thank you for that analysis. Now, fewer tourists are expected in New York than last year, this summer, which many have been attributing to President Trump's trade war and his aggressive immigration policies. But steaks, burgers and martinis, the New York influence, is pervading London, which is good news for me because I'm going to really miss it when I go home next week. But joining me now is Bloomberg's food editor, Kate Crader, to tell us why this has been happening. Kate, are there a couple of dishes that epitomise a New York City menu that Londoners are liking?
It's a really good question, Lizzie. There's, you think steaks, oysters, martinis, which we can talk about separately, whether that's actually a New York product or not. But cheeseburgers, one big thing you can see now on prime restaurant menus is cheeseburgers, and that is definitely not something you would have seen on a London menu in any time in the recent past.
And as I learned over a fabulous lunch with Tom Keane yesterday, Kate, it's not all about the food. What else makes for a New York dining experience? Because I know the service can be fabulous.
It's a really good question also. It's got to do with energy. When you go a New York restaurant, there's a lot of spontaneity. They like walk-ins. They, waiters will talk to you and have a conversation. In the UK, people traditionally have gone out to have a culinary experience. They want to eat something they couldn't make at home. The kind of New York food that you're seeing a lot of now is really accessible. I mean, of course, you can make a roast chicken. Of course, you can make a cheeseburger at home. But here you get to have it, and you get to have a conversation. You feel like you're entertaining. It's a bit of a party, or it's a party atmosphere, and that's exactly the energy you're talking about.
Kate, there may have been martinis at lunch. I've got a question for you. Did it really originate in New York City, the martini, or is Tom Keane telling me porkies?
I will never speak back to Tom Keane. There's the history around it is a bit fuzzy, but supposedly it was created at the Knickerbocker Hotel, which is a New York hotel. It definitely, they're very, very well made here, as anyone who wants to say James Bond will attest to. But the history does supposedly go back to New York, and there's so many martinis here now. You'll see them when you come back.
All right, Bloomberg's food editor, Kate Crader, thank you so much. I was going to ask you for your restaurant recommendations for the weekend, but the production team reminds me there's no need. All I need to do is check out Dine Go on the terminal for Kate's recommendations, wherever I am and wherever you are around the world. Now, let's take a look at other stories. We'll do that in just a moment, but this, for now, is Bloomberg.
It's the most fascinating time for the global economy in years, and our conversations are front and center.
We're stress testing consequential ideas, and investors around the world are scoring them in real time, helping to translate the policies from Washington into actionable ideas for Wall Street.
It's the morning call you actually want to be a part of.
Separating the signal from the noise, with some fun along the way.
This is Bloomberg Surveillance. Up-to-the-minute news whenever and wherever it happens. I'm Matt Miller, the Circuit de la Sarthe in Le Mans, and this is Bloomberg.
Good morning. This is Bloomberg Surveillance.
Welcome back to the opening trade. Watch Bloomberg Tech. This is the Asia Trade.
This is Wall Street Week. Welcome to Balance of Power.
This is Bloomberg Television. Tune in to Bloomberg Business Week Daily.
We got to talk crypto.
From the magazine that helps global leaders stay ahead.
What's the conversation around your company?
Bringing you insight on the people, companies, and trends shaping today's complex economy.
Planning very big things.
A new level of premium.
Plus global business, finance, and tech news as it happens.
The floodgates of innovation are going to open up.
You can't fake passion. You either are or you aren't.
Bloomberg Business Week Daily, only on Bloomberg.
Up-to-the-minute geopolitical news wherever and whenever it happens. I'm Anne-Marie Hordern in Buenos Aires, Argentina, and this is Bloomberg.
Let's take a look at what else is ahead today. The president is going to be meeting with first responders and families who've been affected by the floods in Texas. And then at 1 p.m. Eastern Time, we're going to get fresh remarks from Chicago Fed President Austin Goolsbee. Also at 2 p.m., we'll get the latest figures on the federal budget balance. So plenty to be watching out for on the calendar there. But in terms of your micro movers, just take a look at these. So we've got Levi Strauss on the board here, up 8.4%. That stock surging after boosting its full-year revenue guidance. We're also keeping in mind drone stocks this morning. And for the other two market movers this morning, Red Cat rising over 10% in the pre-market. So keep an eye on all of these throughout the day. But that's it for your Bloomberg Brief. Surveillance is ahead. It's been a pleasure being with you all week. And Danny Berger will be back with you on Monday. This is Bloomberg.
How much does the geopolitical volatility emanating from the United States perhaps undermine the bull case for Mexico? Is that a scenario you've plotted out?
Structurally speaking, we do still have a very positive view in Mexico. On the macro side, it is a very attractive investment geography for the U.S. Mexico is hugely competitive in terms of costs. The wages in Mexico are much more competitive than the wages in China. So why would the U.S. companies not take advantage of that?
And this structural cost advantage is going to lead Mexico to continue to contribute to the growth of U.S. as well. The value chains, the supply chains are so integrated that Mexico has to play a continuing role in the further development of the U.S. And U.S. is growing very healthily, very nicely. It will benefit Mexico this way or that way. It will benefit Mexico.
Mexico for VVA is, a source of resiliency of earnings, and it generates and complements the diversification that we have from the footprint. But there's another topic that is very important, which sometimes we don't focus a lot about, and why we're so convinced that Mexico is going to continue to do well, which is the leverage in the country. Because the leverage in the country is only 33%. And when you've seen Mexico grow and BBVA grow in Mexico, structurally speaking, the leverage is so low that just a little bit of growth in the leverage is going to be able to support that bull case in Mexico. So that's why we're structurally positive in Mexico.
Key investors, top executives, global innovators. Join me for in-depth conversations with the biggest newsmakers on the day's top stories. Insight with Haslinda Onen, only on Bloomberg.
Get your fixed income fix. Watch Bloomberg Real Yield around the world right here on Bloomberg. Context changes everything.
What started out as just a relief rally is starting to become something real.
The markets are adjusting. There's no panic so far.
If you're looking at what's been working in markets the last couple of years, it's quality stocks.
The market is pricing in a friendly sort of mix of growth, inflation, and policy.
Equities and risk are discounting the here and now.
This is Bloomberg Surveillance with Jonathan Farrow, Lisa Abramowitz, and Anne-Marie Hordern.
Live from New York City this morning. Good morning, good morning. For our audience worldwide, Bloomberg Surveillance starts right now. Coming into Friday, the president emboldened. President Donald Trump encouraged by equities sitting at all-time highs as the White House eyes blanket tariffs of 15 to 20% on many trading partners. The JP Morgan boss, Jamie Dimon, is warning of complacency in financial markets. A little bit of tension heading into the weekend.
A big game of chicken between the president and the markets at a time where President Trump, in a conversation with NBC News, said, I think the tariffs have been very well received. The stock market hit a new high today. If the stock market is reflecting how well there is in the markets, these tariffs are being priced in, then what kind of risk off do you need to get the president's attention at a time when many people are looking past it? And the stock market is not the economy. It is composed of a lot of big tech stocks.
This is such an important distinction going into August 1st. The president takes a look at record highs on the S&P 500 and sees it not as a dismissal of his policies, but as an endorsement of his policies. That's a major difference.
And right now, there is a question of whether there is going to be some sort of break that's going to get the president's attention, or whether ultimately he's looking at a measure that is imperfect when it comes to exactly how the tariffs are going to be received by the economy. This is a huge tension at a time where people have continued to say the president backs down at the last minute. Will he back down if the market's complacency is giving him the green light?
So we'll be talking about those comments from JP Morgan's Jamie Dimon throughout this morning. There are many, including this line. I have a lot of friends who are Democrats and they're idiots. We can build on that later on in the hour. Also on the complacency line, there's a big difference again. I would say some division in the C-suite between what Jamie Dimon of JP Morgan is saying about the risks around the economy and what we heard from Ed Bastian of Delta Airlines just yesterday.
And this goes to the K-shaped economy, and we're going to be talking a lot about this. There is a cohort of individuals emboldened by what we're seeing in the equity markets, helping their wealth effect to really boom, and also seeing their earnings go up at a disproportionate pace, according to what Neil Richardson is saying. They're the wealthier individuals, and they're continuing to spend, and they're continuing to spend on premium offerings at a lot of the airlines. And then you have the lower income consumers that are struggling. How do you deal with that when you look at the aggregate data showing a totally benign backdrop? And this is this is the conversation. How do you measure what is becoming an increasingly bifurcated economy, both from a corporate sector with the bigs and the smalls, as well as the economic sector within the consumer economy?
A record high in the equity market coming into Friday. We're pulling back this morning by 0.7% on the S&P. Coming up this hour, we'll catch up with John Stolfus of Oppenheimer with stocks back close to all-time highs. Sami Sith of Raymond James on the airlines following Delta's bullish forecast, and Ed Al-Husseini of Columbia Threadneedle on the chances of a July Fed rate cut. We begin this hour with stocks lower as President Trump ramps up tariff threats. John Stolfus of Oppenheimer writing, our intermediate and longer-term outlook remains decidedly bullish. We believe U.S. economic fundamentals remain on solid footing. John joins us now for more. John, good morning.
Good morning, John.
So pick your favorite CEO right now. Jamie Dimon says it's complacency. Ed Bastian says we've got stability. Which one is it?
Somewhere in between. How's that?
That works.
It's bifurcated, and I think what we notice is related to market capitalization, style, as well as when you consider the sectors. There will be very big differences if the tariffs come out at the higher level among companies. Some will have great workarounds, some will be unscathed, and some will likely get hit. So it looks like a stock picker's market here, or even an index. You know, it could be better ultimately for technology and materials, for example, on expectations of what is to come beyond.
Let's talk about earnings. Max Kettner of HSBC, just in the past day, writing this, buy more. We increase our overweight to equities further and prefer the United States the most. Risk assets are set to remain supported with lower sensitivity to tariffs going into Q2 reporting season. Following Delta, did that bar come up Just a little bit.
Yeah, I think the bar does come up a little bit when we look forward beyond. The later we get into Q2, I think, is when we begin to see perhaps some effect, at least in anticipation of what's coming forth. But our viewpoint has been for a long time that where we are today, it's be overweight U.S. We've been that way for years. We are moderately exposed. What we say is meaningfully exposed to the international, both developed and emerging. But we think it's the U.S. We don't think it's the end of U.S. exceptionalism. That's related to innovation, and also within, in terms of policy, is always a question if we consider the last 4 years and where we are currently.
President Trump yesterday, I just want to pick up on the comments that he made yesterday evening when he said, I think the tariffs have been very well received. The stock market hit a new high today. Does his getting a green light from the stock market make you feel good or nervous?
I think it makes me feel good in that I think the market is giving this some time. It's giving some consideration. We already had the great nervousness of April 2nd, and it had already begun in February, on February 19th, when the market began to move lower, and then it accelerated, hit a bottom on April 8th, and it's pretty much rallied since.
Okay, so then you reject Michael Hartnett of Bank of America, who said in a note this morning that really the complacency that Jamie Dimon was talking about has to do with stock traders' belief that Trump always chickens out, that ultimately he will back down and the rates that he's been putting out will be substantially lower. Do you think that that is true, or do you think that this market is adequately pricing in the rates as we've been hearing as they've been trickling out over the past few days?
I think thus far the market has been adequately pricing in the risks if it considers Scott Bessent's influence at the White House. And also, I don't think that where we are today is that it's not so much the taco business. It's much more that I think that Trump is sensitive to where the equity market moves. Believe me, I'm not an apologist for Trump. I wasn't an apologist for Biden either. It's just, if you look at it as a strategist, what's moving the markets is the market would appear to say there's enough workarounds that we have moving here, enough within the sectors, within the market capitalizations, within style. There's enough to take us higher. And where we are today is really a realization, I think, that an economy that is $28 trillion to $30 trillion a year, the U.S. economy, is likely somewhat bigger than policy until you get to a certain level. Now, we have to wait. If we go back to those April 2nd and we settle on those tariffs, that could be problematic. But if we see negotiations continue, and, you know, on this whole tariff business, I'm not thrilled about tariffs at all. But what I think about tariffs is to bring people to the table. What it reflects is that the U.S. has the biggest consumer in the world, essentially, the U.S. consumer, versus overcapacity in manufacturing throughout the world, which has been built for the last 40, 30, 20, 10, 5 years, most of which has a destination to the U.S. and is hard to replace because of the per capita income of the U.S. consumer, whether it's a small consumer or a big luxury consumer. The U.S. beyond the billionaire class is global, and they compete for the latest Rolls Royce with the ostrich seats, you know. But otherwise, when you look at the Ferraris, you know. But when it comes to like the pencil sharpeners, the lunch boxes, whatever it is, the U.S. has the consumer that'll pay more. China can say they'll say, okay, you won't buy it, we'll sell it to the emerging markets. It's going to be tough. The emerging markets don't have the per capita income to replace the U.S. buyer. And when it comes to other countries, especially in Europe, they have so much cost of socialism built into their businesses that the hurdles they have to overcome. Their consumer isn't as big as ours.
John, this president wants rate cuts. Yep. Does this market need them?
I don't think it does. You know, I'm a big fan of Jerome Powell. I think he's done a great job. 11 cuts, 9 pauses. I'm sorry, 11 hikes, 9 pauses, and then 3 cuts. So far, no recession. Remarkable with inflation as sticky as it has been, and the target.
Is that genius or luck?
I think it's a combination of both. Again, I think it's never clearly bifurcated. It's like on this kind of thing, it's a mix. It just is. But I do believe that he's looking for his legacy is not to be remembered as the predecessor of Paul Volcker is remembered.
So, is there anything going forward? If the Fed doesn't cut rates, you're not phased. If the rates that we're seeing in terms of tariffs go on, you're not totally phased. What would phase you heading into the end of the year at a time where a growing number of people are saying valuations are pretty high, a lot of expectations right now are baked in?
Yeah, I would say, it's if we see tariffs come in at those rates that are as high as they were on April 2nd, I think the market would have a real reaction.
But up until then,
even if it's 35, then, and I also think the Fed has room to cut. And I think the Fed is willing to cut. I think they're going to cut 2 or 3 times this year. I don't think it's what the highly leveraged crowd wants to see, but I think it's somewhere between 75 bips and 100 bips. Another down payment from the Fed saying the hike cycle is ending, but don't expect it. We're not going back to 1 7/8 mortgages. This is more normalized interest rates where we're headed.
Hey, John, it's good to see you. Thanks for dropping by.
Great seeing you.
Thank you, sir. John Stolfus there of Oppenheimer. On the Federal Reserve, it depends who you ask. If you ask Governor Waller, getting a very clear answer now, even with the recent labour market data, I think we're just too tight and could consider cutting the policy rate in July, then going on to say it's not political.
Yeah, saying that what he's looking at right now is the fact that tariff and the effect will not be a long term. It will be short-lived. I still can't. So I'm trying to sort of do the in-between, the short-lived.
I just go with what's natural. Short-lived just feels right to me.
I would agree with you, but I think that he's looking through this and seeing it as short-lived, and other people are not so certain. Mary Daly, who is on this show, actually repeating that and reiterating some of that belief, and also seeing maybe 2 rate cuts this year.
Might see some dissent in a few weeks' time at that Federal Reserve meeting. We'll see. If you are just joining us, welcome to the programme. All-time highs at the close in yesterday's session. We pulled back this morning by 0.6% on the S&P. With an update on stories elsewhere this morning. With your Bloomberg brief, here's Lizzie Burden. Hey, Lizzie.
Hey, John. President Trump is threatening a 35% tariff on some Canadian goods. The tariff is an increase from the current 25% level and would take effect August 1st. It'd be imposed on US imports from Canada that aren't shipped under the terms of the US-Mexico-Canada agreement. Trump also told NBC News that he's eyeing blanket tariffs of 15 to 20% on most trading partners. Elsewhere, Apple is planning a release of a line of new products during the first half of next year, including a new low-end iPhone, multiple iPads, and upgraded Macs. A budget smartphone dubbed the iPhone 17e will be a follow-up to a $599 model that Apple launched earlier this year. And London's Heathrow Airport plans to invest over $13 billion over the next 5 years to upgrade its terminals and its services after the UK hub slipped in global airport rankings. The project would increase the number of passengers per year by 10 million, a 12% jump in capacity. And that should be my brief, John.
Hey, Lizzie, thank you. More from Lizzie in about 30 minutes' time. Up next on the programme, the President emboldened.
The open question that maybe we're getting a little bit of an answer to is if you get enough resilience in economic data and the stock market trading at all-time highs, does that beholden the administration to sort of press forward with tariffs?
Up next on the programme, John Lieber of Eurasia Group, live from New York City this morning. Good morning.
TradeMasters in New York. I'm Danny Berger. Welcome to Bloomberg Brief. Let's set your agenda.
Bloomberg Brief delivers the market news, data, and analysis you need live every weekday only on Bloomberg. Context changes everything.
Jumpstart your trading day on Bloomberg Open Interest.
2 hours of single stock stories that are driving the opening bell action. We'll take you to Wall Street, Main Street, the C-suite, and beyond.
These are companies that are growing their market.
The great companies in the U.S. are the companies hitting the cutting edge. That's a different story.
Get the inside track on what's buzzing in markets.
With the players who are shaping the narrative.
If you have bad earnings reports, you're going to get punished.
They're not buying what the industry is selling. Join us on Bloomberg Open Interest every trading day, only on Bloomberg.
Asia is at the forefront of some of the world's biggest stories.
And we're here, where the action starts in Sydney.
And in Tokyo, get ahead as the global trading day begins.
The Asia Trade, weekdays only on Bloomberg.
Things have been super volatile this year. Two-day winning streak on the S&P 500 into Friday, all-time highs. We pulled back again. We're down by 0.6% at the close on Thursday, though. Positive on the week by 0.02%. And if we close out the week in positive territory, the first three-week winning streak of 2025 so far. Isn't that unbelievable?
It is unbelievable because it feels like we've really kind of plumbed the depths of gloom and doom, and at the same time there's been this buoy, and it has come in the form of big tech, and that continues today.
Pulling back just a touch this morning by 0.6%. Under surveillance, the president emboldened.
The open question that maybe we're getting a little bit of an answer to is if you get enough resilience in economic data, labor market data, you don't start to see a move higher with any, meaningful magnitude in the inflation data and the stock market trading at all-time highs. Does that beholden the administration to sort of press forward with tariffs?
Here's the latest this morning. Stocks at all-time highs, emboldening the president to move forward with his tariff agenda. Trump telling NBC, quote, "I think the tariffs have been very well received." The stock market hit a new high today. Trump said he's now eyeing blanket tariffs of 15 to 20% on many trading partners. Bloomberg's Tyler Kendall joins us now from D.C. with more. Morning, Tyler.
Yeah, hey, John, good morning. Really, these latest moves signal no retreat from President Trump when it comes to the future of his tariff plans. And we have to look holistically at how these plans have really evolved over the last week. We now have President Trump upping his threat when it comes to the blanket tariffs. As you mentioned, they're up from 10%. That would be a significant difference, considering that we've seen outlined in the tariff letters sent so far that most of these rates are hovering around there, or at least just slightly higher. The second part from this week that we learned was President Trump holding firm that August 1st deadline is really the end deadline for these countries to negotiate, and then combine that with the future of sector-specific tariffs. Now, of course, the big escalation that we did get overnight was President Trump now threatening this 35% tariff on Canada. An official does tell Bloomberg News that USMCA exclusion is expected to remain in place. That's going to be absolutely critical moving forward here, since the bulk of U.S. imports from Canada are USMCA compliant. Data shows us that actually these sorts of imports have surged since the original tariffs went into place and were a threat back in February and March. They now make up about 60% of the goods that cross into the U.S. from the Canadian border. But still, John, this is not welcome news for the Canadian Prime Minister, Mark Carney, who's been trying to leverage his personal relationship to negotiate with this White House. In a post on X last night, he said he would continue to work towards that August 1st deadline. But at this point, there are so many concessions that the White House wants. We're going to have to see if they're able to strike a deal.
Tyler, just before you go, the focus not just on trade, also on sanctions. We understand the president basically pre-announcing a big statement still to come on Monday. What are we expecting?
Yeah, so John, basically this is going to be centered on a bill that is working its way through the U.S. Senate, led by Senator Lindsey Graham, that would ramp up sanctions against Russia. It comes as this White House has really expressed frustration in particular about trying to work towards a ceasefire when it comes to Ukraine. We have heard a shift in rhetoric from this president. In fact, when it comes to pledging more weapon supplies to Ukraine after there was a recent halt in those stockpiles, as the Pentagon said it was looking at its own defense industrial base and how it could replenish replenish our weapons at home before sending them abroad. It's something that we're watching very closely and could have some big implications for getting Russian President Vladimir Putin to the negotiating table.
Tyler Kendall with the latest in DC. Tyler, thank you. This president can be encouraged to change his mind, and it seems on Russia, his mind has changed.
It seems as though he has been shocked by the discussions that he had with Vladimir Putin, and then several hours later, the assault that was foisted upon Kiev. I wonder, though, whether he'll pull the trigger. He was saying he would like Lindsey Graham to pass this bill and that it's up to him whether or not he's going to use it. It sort of leaves open the ambiguity that maybe he would back away at the last minute.
Equities this morning, elsewhere pulling back. We're pulling back from all-time highs on this quote from the president, an expensive one. Speaking to NBC, I think the tariffs have been very well received. The stock market just hit a new record high. Joining us now to discuss is John Lieber of Eurasia Group. John, welcome to the program, sir. August 1st, big deadline, another extension. What is stopping this president from following through?
Very little. I mean, so far, it looks like these tariffs are a rousing success. Everybody, including us, thought that this would be quite bad for the U.S. economy. And you're just not seeing the shoe drop yet. Inflation's not so bad. Growth has been pretty resilient. You can quibble about some of the jobs report that just came out this month, but it looks like these tariffs are working. And I think importantly, nobody's really retaliated. So the Canadians haven't retaliated against him in a serious way. The Europeans have sort of backed off. The only country that did retaliate was China, and that got out of hand quite quickly. And that's led to what seems to be a pretty quiet truce that has taken them out of the crossfire, unlike all these other major trading partners, including Japan, South Korea. And as long as that continues to be the case, I think the president is getting the message loud and clear that, like your previous guest said, the economy can absorb a lot of these high tariff levels without a huge downturn. And I think that means he's going to keep going.
John, there's a message that you put in there that I thought was really interesting, that you thought that ultimately these tariffs are working. Working to do what? To raise revenue? Working to extract concessions from trading partners? What has been the goal?
It's making America great again, right? I mean, I think this is an exercise, in some level, this is an exercise of power. This is what Trump campaigned on, and this is what he wants to do. Now, the reshoring and the reindustrialization will probably take some time, of course, if that is going to happen. But I think that they're working in that the president can put them in place without any negative consequences, and the economy is doing great. So, you know, if you think about it, the president's perspective and the White House perspective, this is a rebalancing of stuff that was broken in the U.S. economy for decades, and it was broken by previous leaders. And now Trump's coming in to rebalance it. And in that rebalancing that we've all been saying is going to be terrible for the outlook, it hasn't been that bad yet. So in that sense, I think that the rebalancing is starting to work in his mind, and he's going to keep going.
In his mind, it's not necessarily affecting the polls that much. You're still seeing a lot of popular support to not put tariffs on, and there has been a deterioration in the president's approval rating. At what point will that offer up some sort of check? Does that matter at all? Or is this a president that isn't going to run again, so ultimately those polls don't matter?
Yeah, I think that's right. Well, I think the polls do matter, but the basis is that he's got this very strong base of support in the Republican Party. His approval rating is still above where it was for basically the entirety of his first term. And because of that, it suggests to him that he's doing okay. So I think that he's losing support, but it's with voters he doesn't necessarily care about, and he certainly doesn't need, because he's not going to run again.
I think it's a great test going into the midterms next year for the Democrats, for the other party, John, because the tariffs that the president introduced in his first term were criticized by the party on the other side, and then they kept them. And I just wonder, John, will anyone actually campaign on removing them if they get into power?
Yeah, I think it's really hard for the Democrats, as you just mentioned. I mean, I think basically on some level, they've been supportive of this kind of trade protectionist policy for decades now. And the reason for that is this is what the labor unions wanted. And now Donald Trump has sort of come in and stolen their base of labor union supporters. He's taken their policy and taken it to the extreme. And they're not really yet finding a way to articulate the case against that. And part of the reason is this economic resilience. Now, if there is an economic slowdown, if you do start to see job losses, layoffs, you get some bad job reports, that's good news for the Democrats. And they'll certainly lean into that and attribute it to the chaos caused by Donald Trump. But I think they're going to have a hard time campaigning specifically against these tariffs. And it's why any tariff wall he ends up building probably endures past his administration.
The data so far has been pretty decent. John, appreciate your time, sir. John Lieber there of Eurasia Group. The jury, arguably, though, still out. You hear a lot of people, many economists saying these companies built up a lot of pre-tariff inventory. They've been working through them. We still don't know what the pricing strategy is going to be in the months to come.
Just to build on that, a lot of these tariffs don't go into effect until August 1st. If you don't necessarily have the real tariff rates coming to the fore, how can you even gauge the impact in the data that we get next week, next Tuesday with CPI and then Wednesday with PPI? The Fed's Musalem yesterday talking about this and saying that he did expect tariffs to hit inflation beginning in the June data, but that it would build through the rest of the year. And this is what we hear from an increasing number of economists. Who is going to pay for those? And ultimately, that, I think, is a really key question. Can we judge already the ramifications from these tariffs?
Well, cheap guys, down in Washington, it's pretty simple. If you are a Republican, you will say the exporter will pay. And if you are a Democrat, you will say the consumer will have to pay for this. I think we have to be super open-minded because we can pick evidence elsewhere that suggests it might be the exporter, Japanese auto suppliers, the auto market over there, for instance. We've seen prices drop as they export into the United States. We can also find examples where the consumer has to shoulder a lot of this as well. And we're going to see a lot more of that. You can cherry pick the data here, there, and any way you want. Ultimately, we've got to be very open-minded about what the next few months and the next several years brings.
And that's what we've seen in earnings as well, that profit margins might come in just a bit. They might pass a little bit on to consumers. They might see it absorbed a little bit by some of the suppliers. It's going to mitigate the hit in terms of how inflationary some of these tariffs will be. There are larger questions here about lower profit margins. Have people adequately priced that in with respect to the stock market? But a lot of people are waking up to the fact that this economy is very resilient. And right now, the effects are trickling in at a slow enough pace that they aren't a slap in the face.
Do you want a scary headline?
Please.
The scariest headline of the last 24
Please.
hours. Indeed, Glassdoor. The people who are meant to help people get jobs are cutting jobs because of AI. That, for me, is concerning for this labour market going forward.
There are these secular and cyclical trends that are overlaying upon one another, and it's making it very difficult to extrapolate out. It's Friday, bear with me. Extrapolate out these longer-term trends, and certainly in the labour market, if not in inflation.
2 hours, 30 minutes to go, Bramman.
I know. I'm just, good morning.
Both of us will get it together. Up next on the programme, Savvy Sith of Raymond James with a look at the airlines following Delta's strong forecast, plus Yahara Anand with your morning movers. Live from New York. You're watching Bloomberg TV.
Bloomberg launches our inaugural 25 African Startups to Watch list.
About 2.5 years ago, we created a solution. We are able to generate refrigeration using the sun and water. We're able to store energy in the form of ice, as opposed to storing energy in the form of lithium batteries. We integrated in every refrigerator a pay-as-you-go technology. allowing individuals and small businesses to be able to pay as low as $10 to own a refrigerator.
Uncover is a women's wellness brand that is specifically made for women of color. It's based in Africa, which is the most underserved beauty market in the world. We are making Africa a priority and not an afterthought. We believe that the population on this continent deserves to be formulated for, heard, and we are giving this consumer a voice.
Of investment agreements.
Deals were once again on display.
The Saudis are open for business.
The cessation of sanctions against Syria.
Another big victory for the Crown Prince. Concerned that none of the guardrails may be set up just yet.
Headline after headline. Trust Bloomberg for on-the-ground coverage.
The numbers will be quite substantial.
Up-to-the-minute reporting.
Driven the price of oil down.
And the analysis you need.
He's basically going to vault this region into the same sort of sphere as the US and China.
No one covers geopolitics like Bloomberg.
So the president citing all-time highs in the equity market and saying that that is evidence that his tariffs are being well received. So what happens when he says that? We pull back. We're down by 0.7% on the S&P, just on the very idea that maybe that encourages the president to go hard, go big on August 1st. So that's the equity market debate of the morning so far. Let's turn to the bond market. So far, so good this week. Yields just about unchanged on the week so far. 10-year auction, okay. 30-year auction, okay. The 30-year yield this morning high by 3 or 4 basis points. 490 on 30s. Don't look stateside. Look to Europe, Germany, France. 30-year maturities, the highest we've seen on a yield basis going back to 2011.
At a time when the economic data isn't quite as bad as people expected. And Isabel Schnabel came out and said, unless there's a massive deterioration in the backdrop, she doesn't think that the ECB really has any urgency to cut rates further. So kind of a hawkish tone from the ECB, even though some of them have talked about concern that maybe the euro is getting too strong. I do want to say, we had dollar strength this week. We had the second best dollar strength week that we've had going back to Liberation Day of 0.6%.
Super low bar, right?
Yeah.
Super low bar. But I'm with you. It's noteworthy. Also noteworthy, notable. Jamie Dimon's made a load of comments in the last 24 hours, I think over in Dublin. His point on Europe, just in a line, a few words, you're losing. That's his message to the Europeans right now.
He talked about their output and how much it just has absolutely lost share relative to what the U.S. has done. He talked about how they really haven't invested. He talked about the over-regulation. And he said, get in the game, because right now, you're not even close. And that, to me, is something that's being echoed not only by the Draghi report, by a lot of politicians throughout the region.
Euro dollar this morning, just about unchanged, 116.94. With 3 hours until the cash open for the equity market stateside with your morning movers. Here with us now is Yahira Anand. Hey, Yahira.
Good morning, John. We start with Levi Strauss, the latest company to report results, and they were solid. Look at the stock. It is up nearly 7% in the pre-market. The jeans giant hiked its full-year revenue forecast, saying that despite all those added costs from tariffs, they actually see sales rising up to 2% this year. That's due to strong demand and a strategy shift that's working, which is to offer head-to-toe denim, so not just focusing on jeans, but denim accessories and clothing. So that is helping to offset any pressure they are seeing from tariffs. Next up, we have NVIDIA, worth noting since it became the first company ever to close at a $4 trillion market cap yesterday. We are off those levels now with stock down about 0.8%, but the significant moment yesterday came as CEO Jensen Huang went to that White House to meet with President Trump. We don't know what they discussed, but there is a lot to talk about, not just tariffs, but those export controls, just as Huang is set to go to China next week. And we end with a rally in drone stocks. Red Cat Holdings up nearly 16%, while Kratos and Aero Environment is also up, and that is because Defense Secretary Pete Hegseth says that the U.S. is ready to unleash drone dominance. His plan is to fast-track drone production and push thousands of low-cost drones to troops in order for them to start testing them and training with them for combat. John?
Yahira, thank you. More from Yahira. in the next hour. On our radar this morning, President Donald Trump ramping up the pressure on global trading partners, telling NBC News he's considering a new blanket tariff rate of 15 to 20%. Trump also threatening a 35% tariff on some Canadian goods.
Raises a question who he's negotiating with. Is he negotiating with the trading partners? Is he negotiating with the market? Is he negotiating with the budget deficit? The reason why I say that is because I was struck by Vietnam. They were surprised when he announced that they had agreed to a 20% baseline tariff rate and is continuing to discuss with them behind the scenes, the U.S. Delegates, exactly what that looks like and could it come down a little bit lower. They would have been okay with like a 10 to 15%. So it seems as though the trading partners have gotten a different message and maybe their response will be slightly different if they see these rates as plausible going forward.
That's my takeaway from the whole thing, was the last point of what you said. They'd be willing to accept something like 15%. That's a whole new world compared to where we were a few months ago. Not just them, but the Europeans also willing to accept 10%.
There is a feeling that's fine. And you could talk about escalate to de-escalate. This is a president that sets the bar very high and then brings it down and makes it look like he's cutting a deal, but really he's extracted some concessions. This is why people call him an excellent deal maker. A real question, though, how far can you push it? And will he be willing to accept a 10 to 15% tariff rate if it is acceptable to them and if the market is chugging along, or is he going to try to extract more? And is that August 1st deadline going to be more of a risk event that a lot of people are talking about?
It's going to be an interesting 3 weeks still to come on the trade front. Interesting week still to come for Russia. President Trump planning a major statement on Russia for Monday. The president also saying he expects the Senate to pass a bill ramping up sanctions on the country.
And he will decide at that point whether or not he's going to sign off on that. I do wonder how much he has changed his mind, what could potentially happen over the weekend to influence him one way or another, and what this will do on the geopolitical stage. We were talking to Mike Pence yesterday, and I was really struck by what he said. He has faith that actually this time the president is going to take a harder line on Russia after seeing what happened to Kiev because he has been working with Lindsey Graham. It does seem like the tide is shifting, especially with respect to the calls around Volodymyr Zelensky over in Ukraine.
It's certainly something that the Senator Graham has been pushing for over the last few years, that's for sure. I want to turn to these comments from the JP Morgan CEO, Jamie Dimon, not just on the economy, on financial markets, some very harsh words for the Democratic Party, saying members went too far in their focus on diversity, equity, and inclusion. Dimon adding, and this is a direct quote, "I have a lot of friends who are Democrats, and they're idiots."
And he went on to say they have big hearts and small brains, talking about some of their policies. They don't live in the real world. Some pretty harsh criticism. You could say a lot of things about this. You could take this in a lot of different ways. The way that I'm curious to see how this plays out is there are a lot of people who have affiliated with Democrats who are very critical of the party. How do they give a message going forward? Because what is the Democrats' message right now?
So I'm not going to make this about one specific company. I'll just talk about corporate America at large. And it doesn't apply to everyone, but applies to many. 5 years ago, they're kneeling in front of their emblem because they believe that helps them. 5 years later, they're trashing DEI. And I think many of these companies don't have values, they have sales targets. And they're willing to do whatever it takes to make people believe that these are our values, help us sell product. My issue with that is the winds of change seem to be influenced by who is in the White House at any given time. And that seems to be what all these stories are associated with. And now, for me personally, I didn't like the virtue signaling 5 years ago, and I don't like it now. And I think for many companies, let's take a bank. For me, for a bank, I don't care what your CEO thinks about these things. When I go to the bank, I want to know my money's there. And if I'm borrowing money, I want a really low rate. And if I'm depositing money, I want a really high rate. That's ultimately what I want as a consumer. Do I want the CEO of said bank telling me about what he thinks about politics here, politics there, values here, values there, if their values seem to change every election cycle?
It's a fair point. If you take it a little bit of a step further, right now on an international stage, the corporate executives in the United States are little ambassadors going around the world saying policy does not create what we do every single day. And they're trying to distinguish themselves with their own mini platforms. It's almost sort of this political structure that is really beholden in the corporate sector that is divorced from what's happening in Washington, D.C. There is a feeling Washington, D.C. is a mess. We have it together, and this is our policy platform. And it feels almost as though that's the pitch on an international level. And I wonder if this speaks to the international change in minds, because this isn't just a U.S. sort of shifting in the winds. This is a global one, and it has a broader appeal. And it's notable he was saying this over in the UK.
We've got earnings next week.
They do.
We've got earnings from JP Morgan next week.
We do.
We're talking about thoughts on complacency around markets and DEI. And we're not talking about the actual numbers.
Well, if the numbers will come out and they'll have record profits, and it'll be great. That's basically what we've become accustomed to. You know, the world might be falling apart and lots of complacency, but
raise the outlook.
Yeah, but you know, raise the outlook. $2 billion in profits.
The big banks reporting next week. Look out for that. Turning to the airlines, we've already heard from one. Their stocks are flying high after Delta delivered better than expected earnings and restored its full-year guidance. Savvy Sith of Raymond James joins us now for more. Savvy, welcome to the program. Just fantastic numbers from Delta, reinstating the outlook, some real confidence coming from the CEO, Ed Bastian. Do you believe that is just a Delta Airlines story or a broader industry story?
Hey, good morning, John. Thanks for having me. It's a little bit of both. If you look at the 3Q guide and the beats, there was definitely good cost execution from Delta, controlling what they can control. But the optimism that they're talking about really is driven by what the industry as a whole is doing. We did see demand kind of start to wane from the really strong levels you saw in December, January as you went through April. And now we have stability. And what I think they're most excited about is just how much the industry's done to get supply to match that demand in the post-summer period. So it is an industry story, not just Delta. And then maybe as we get some level of certainty with the reconciliation bill and maybe with the tariffs, maybe that would kind of get the consumer and corporate some confidence to pick up travel again.
Savvy, the way that we were talking about it yesterday was about a K-shaped consumer and that certain airlines, particularly Delta, cater to that corporate class, have a lot of premium offerings and can have much bigger profit margins that really bolster the rest of their earnings in a way that some of the other airlines, particularly the ones more focused on budget-conscious consumers, don't have. Is that a fair way to look at it?
Yeah, that's fairly. So if you look at it, you know, the airlines that have more premium and corporate have been doing better through this kind of slowdown. But the interesting thing is, you know, most airlines, their household income, the target consumer has a higher household income. The budget traveler is where I think Delta is seeing a little bit more excitement. Main cabin is where they're expecting improvement. Again, as supply starts to kind of meet demand. And then again, as maybe we start to see a little bit more certainty and confidence return.
When you keep talking about supply, essentially they're constraining capacity as a result of declining demand. And it raises this issue about price increases. Is that still the goal? Can they still raise prices on consumers, particularly in the main cabin, at a time where they're having to cut capacity in order to really right-size the supply-demand backdrop?
It's a mathematical equation, Lisa. You know, what's happening here is you are taking the seats that cannot be filled at a decent margin off the market, right? So the average fares do go up just by the function of that. And what you need is demand improvement then to push prices higher on kind of the additional seats. So right now it's more about supply coming out and the average fare going up. And it's necessary because there are a lot of airlines that aren't profitable at all in this environment. And then hopefully as demand starts to strengthen, we'll be able to kind of pass through prices to also meet kind of the higher level of cost for airlines.
Savvy, for many of us in this market over the last several months, things have felt anything but stable. They've been incredibly volatile. That quote that came from Ed Bastian, I just found absolutely stunning. I've been thinking about it ever since it came out. Just the idea that this environment can be described as incredibly stable. Savvy, where is that coming from? What kind of stability does he see and what is influencing it?
Yeah, it's definitely, as we kind of reflected on the second quarter, it was a quarter that a lot of things happened, but nothing changed from a demand standpoint. So you've seen kind of demand bottom, but it hasn't really changed. That none of the kind of the headlines stop demand from recovering. You see, you know, green shoots of demand recovering, and then some headline happens, and demand kind of goes back to that stable level. So it's definitely interesting that demand has remained stable, which is encouraging. And what we're looking for is maybe a recovery from these levels.
Do you expect to see the same thing at United, at American Airlines? Can they repeat what Delta Airlines did this week?
Yes, I mean, again, I think they're seeing the same trends. They have some unique geographic exposures, perhaps, but one thing I would say is, again, the third quarter, Delta's EPS guide beat expectations. Half of that came from cost execution. But the component that came from demand and the stability, I think that can be replicated at American and United as well.
Savi, appreciate it as always. Savi Sith there of Raymond James on Delta Airlines. Not just a Delta story here, Bramo. Apparently this is an industry story.
Yeah, because they're right-sizing the supply-demand picture so that prices can still keep going up. She did say geographic issues, and she pointed out American Airlines as not necessarily being beholden as much to some of these trends. The geographic aspect of this is going to be fascinating. They're more focused in Latin America and South America and all of the Americas, and I wonder what the international travel backdrop is going to look like from all of these as sort of a read-through of the popularity of certain regions, differentials of FX, as well as different immigration policies.
AMH trying to get a direct flight from JFK to the south of Italy.
Evidently. Is that why she's off today?
Maybe. We'll see if she's successful or not. Let's give you an update on stories elsewhere this morning with your Bloomberg brief. Here's Lizzie Burden. Hey, Lizzie.
Hey, John. Vietnam is seeking to lower its tariff rate by the US. Sources say the country's leadership was caught off guard by President Trump's announcement last week of a 20% tariff. Vietnam is pushing for a tariff more in the 10 to 15% range. Elsewhere, Israel reportedly believes that some of Iran's underground stockpile of enriched uranium survived last month's US and Israeli attacks. The New York Times cites a senior Israeli official saying some of the material may still be accessible. The same official says that Israel had uncovered a secret Iranian project to build a bomb late last year. And Tesla is planning to expand its robo-taxi service into California and Arizona after its recent rollout in Texas. CEO Elon Musk expects the driverless cars could launch in the San Francisco Bay Area in a month or two, pending regulatory approval. Tesla has also applied to operate in Phoenix, and a decision is expected by the end of the month. And that should be my brief, John.
Lizzie, thank you. More from Lizzie in the next hour. Up next on the programme, it's not political.
Given where we are with the labor market, given where inflation has been, I just made the argument, I think we're just too tight and we could consider cutting the policy rate in July. It's not political.
Up next on the programme, Ed Al-Husseini of Columbia Threadneedle, live from New York City. This is Bloomberg.
In case you missed it on Bloomberg Insight.
I just think there's a chance that you'll have stagflation. I'm not saying it's going to happen. I don't want the reader to say he's predicting that. I'm not. But we have to be prepared for something like that. I think the global fiscal deficits are inflationary. I think the remilitarization of the world is inflationary. The restructuring of trade is inflationary. And this is not all an American thing. You know, with all those things taking place, yeah, you may be surprised.
I spoke to Jamie Dimon. He says that we should actually prepare for stagflation. How do you square that?
I think there's no question that the shock of tariffs are stagflationary. The question is going to be ultimately how high do they settle at? Right now they're at a very high level, highest in 100 years. And how long a period both is this uncertain environment and how long are the tariffs going to last? And the question now is the magnitude of the stagflationary impulse, and we just don't know yet.
Don't miss Bloomberg Insight live weekdays.
Technology is embedded in every aspect of our lives.
And laying the foundation for the future.
From finance to defense, AI to entertainment.
And from the road to the stars. Bloomberg brings you the latest stories of the people and companies pushing the tech sector to new frontiers.
And the politics that shape global tech markets.
I'm Caroline Hyde in New York.
And I'm Ed Ludlow in San Francisco.
Watch Bloomberg Tech every weekday.
Only on Bloomberg Television.
From the world of politics to the world of business, Joe Matthew and Kaylee Lines deliver news, insight, and analysis live 2 times a day, every trading day. Balance of Power at 1 and 5 Eastern, only on Bloomberg. Bloomberg loves earnings.
I know it's like your Super Bowl, right?
I can't wait. It's like opening presents in the morning.
All right, it will be exciting.
Nobody covers earnings like Bloomberg.
Pulling back from record highs on the S&P 500 this morning, we're down by 0.7% on the S&P. On the Nasdaq 100, we're down by 0.6%. On the Russell, we are underperforming. We're down by 1.2% so far this morning. Under surveillance this morning, it's not political.
If inflation comes down, we can lower rates. We should not be responding to tariffs with the policy rate. And as long as the economy's doing okay, that's fine to lower rates. And if there's any blip up in inflation because of tariffs, you just look through it and keep moving. Given where we are with the labor market, given where inflation has been, I just made the argument, I think we're just too tight and we could consider cutting the policy rate in July. It's not political.
Here's the latest this morning. Fed Governor Chris Waller breaking with the central bank's wait-and-see narrative, floating a July rate cut. The president continuing his attack on Fed Chair Jay Powell, posting on Truth Social, too late, demeans the great credit of the USA, lower the rate. Adel Husseini of Columbia Threadneedles writing this: the Fed's bias this year has been to react to incoming data rather than act proactively. They may end up looking for a huge rock to hide under in the second half. Ed joins us now for more. Ed, good morning. It's good to see you.
Good morning.
How political are things about to get in the second half of this year?
It's really tough because you have the fog of data that the Fed has to go through, in addition to this extraordinary pressure from the White House, and of course the succession conversation early next year. So anything they do will have political undertones at this stage.
Any sign at all, from your standpoint, looking at markets, that we're beginning to bake in some kind of political premium in the yield curve?
You know, not yet. The yield curve, particularly the longer end of the yield curve, has been, I think, disproportionately focused on the fiscal premium and the fiscal story over the course of the past year. That's gone up noticeably. The curve is steeper. Real interest rates are higher. But we haven't seen it in, I think, the inflation market. And that, to me, would be the center of where any kind of deviation from Fed independence would start to show up first.
And part of the reason why you haven't seen that and why you've seen implied volatility in Treasury yields actually fall to the lowest level in about a year is because there's a huge economic debate about just how inflationary these tariffs will be. We've even heard members of the Fed, like Mary Daly, say, it looks like they're going to be evenly distributed and they're not going to be that significant. You seem to disagree. Why?
Well, you know, there is a conversation to be had around just how quickly tariffs will hit the economy. In the course of the last, I think, 4 or 5 years, we've relearned over and over again that various aspects of policy have long and variable lags. It was true with monetary policy. It was true with fiscal policy. We're about to find out that trade policy also has long and variable lags. And so I think committing to a view that the inflation story is going to be very short-lived, it's going to be very long and persistent. You don't want to do that this early on. And I think you want to have the flexibility. And I think the Fed has shown to some extent that flexibility at this stage.
You said in your recent notes that we could get a bump to core PCE inflation as a result of some of the tariffs that have been announced, up to about a full percentage point, 100 basis points by the end of this year. What would that do to markets? How offsides are markets to that type of reality?
You know, not that much. I think if you look at market expectations, they're roughly for about 50 basis points of cuts this year, 50 to 75 next year. If, in fact, the inflation story is front-loaded and relatively sharp, I think cuts this year will start to come out. Maybe we're down to 25. I think it's really difficult to fully price that out. So that gap isn't huge. The gap next year is going to be massive. And I think in my mind, this is going to be the core of the debate as we get into the second half is there room for the Fed to cut much more aggressively in the event that the economy slows, this tariffs inflation story turns out to be transitory, Or will they have to remain on hold for the entirety of the year to fight off an economy that's starting to overheat, fiscal policies in play, tariff inflation could prove, I think, and this is a risk, could prove to be a little bit more long-lasting.
Ed, I'd love to know what your base case is. Do you see that dual mandate in conflict as we work our way through next year?
Not that much. I mean, my base case is perhaps we're priced pretty much to perfection this year. I don't think we can do that much more. The economic data is held in quite well, particularly around the labor market. Next year, I see significantly lower terminal rate. So where the Fed's going to land. Right now, we're landing at about 3.25 in terms of Fed funds. I think there's significant room to land a lot lower, both as underlying inflation works through the tariff story, but also because the margin of error now around the labor market is exceptionally skinny.
Coming into this year, there was a belief that the U.S. would be more resilient than the rest of the world to any kinds of tariffs. That's reversed itself. Suddenly, the U.S. is the epicenter of pain, at least as implied by markets. Are we going to see it flip back, where people start pricing in a slower growth environment for developing markets, for other even developed nations that are facing off with the conundrum of how to deal with these?
Yeah, I mean, it's an incredibly difficult story. In some ways, when you think about trade, the U.S. is largely isolated. It's a relatively closed economy. Most large economies outside of the U.S., think about Europe, China, and so on, are significantly more leveraged to trade. So if global trade starts to slow, and that is not just trade with the U.S., but trade between those other countries starts to slow as a result of our trade policies, that's going to be significantly negative for growth. That is not in the price of the moment. Risk assets in emerging markets, risk assets outside of the U.S. have rallied significantly with the view that growth there is going to be good. I think there is some room for that to reverse, for sure. The longer the U.S. economy continues to perform, even if it's muddling through, risk assets here would be looked at as quite attractive and, if anything, a little bit cheaper now relative to the rest of the world.
Should we finish on some good news then? 2 auctions went pretty decently this week.
That's right.
We can clear some supply. It's a good thing, right? Buyer's strike.
I think the notion that there's a buyer strike in treasuries, I think it's very difficult to find in the data. I think it's very difficult to find evidence for the view that foreigners have stepped back from the treasury market. And I think what we're starting to see is the anticipation building that later this year, the treasury is going to pull back in terms of supply in the long end of the curve and move most of that supply into the belly towards treasury bills. I think that's becoming a very consensus view at this stage.
This is what Lisa's been talking about over the past week.
And ultimately, the supply-demand side of this story is going to dominate in the rest of this year. Let's just to caveat that a little bit, we are trading close to 5% yields on 30-year treasuries. This is a group of people saying maybe there's value in locking money in for 30 years at 5%, and if we lose a little bit, we can buy some more. It's not people saying, oh, it's a great environment, let's buy, let's go.
There's always a price to clear supply.
Exactly.
The good news on a 10-year at least is 4.38, and not 5.38.
Correct. That's good.
And we'll
Victory.
run with that. All right, Ed, it's good to see you. Thank you, sir. Ed Housseni there of Columbia Threadneedle. Coming up next on the program, Emily Rowland of John Hancock, Jeanette Lowe of Strategas, Erica Najarian of UBS, Stephanie Roth of Wolfe Research. From New York, the second hour of Bloomberg Surveillance. Up next.
Listen carefully. Can you hear the rhythm in the markets? Not just in the syncopations triggered by inflation, but in the preludes leading to global elections, in the dissonance that moves the Nikkei, and the rising course conducted by AI. There's music in the markets, and if you want to learn to listen for it, we'll show you how.
We're building another art museum called the Guggenheim. Now, Louvre's big enough. Why do you need a Guggenheim as well, right next door?
I think it's a great question. I think the beautiful thing about the UAE and Abu Dhabi is we live with over 200 nationalities. And in doing so, they have become a part of the country's and the city's fabric. And we need to celebrate that. So we need to celebrate everybody's identity, everybody's background, everybody's heritage, everybody's history. And what a beautiful way in doing so in these beautiful institutions. These museums are educational institutions and they're community institutions. So we wanted to curate really a story where you come to Saadiyat Cultural District and you if you allow me to curate the story, you start off at the Natural History Museum. And at the Natural History Museum, you get a glimpse and you get an understanding of how we came to be, how our Earth came to be, how our universe came to be, from a scientific perspective. Once you leave the Natural History Museum, you go to our National Museum, the Sheikh Zayed National Museum. There, you understand the history of this great land, not just the history of the country, but the people of this land that have been a part of this land for over 300,000 years. You get a glimpse of what the past and the present and the future looks like here in the UAE. From there, you maneuver yourself to the Louvre Abu Dhabi, which is a beautiful universal museum. It is universal in its thematic approach. So there, you basically see a part of you on an equal pedestal with the entire world.
It's the most fascinating time for the global economy in years, and our conversations are front and center.
We're stress testing consequential ideas, and investors around the world are scoring them in real time,
helping to translate the policies from Washington into actionable ideas for Wall Street.
It's the morning call you actually want to be a part of.
Separating the signal from the noise,
with some fun along the way.
This is Bloomberg Surveillance.
What is going to be the consequence for U.S. markets? We are basically deep in the European earnings season.
Take a look at how we're faring when it comes to Asian markets.
Tune in to Bloomberg Business Week Daily.
We got to talk crypto.
From the magazine that helps global leaders stay ahead.
What's the conversation around your company?
Bringing you insight on the people, companies, and trends shaping today's complex economy.
Planning very big things.
A new level of premium.
Plus global business, finance, and tech news as it happens.
The floodgates of innovation are going to open up.
You can't fake passion. You either are or you aren't.
Bloomberg Business Week Daily, only on Bloomberg.
The economy has been stress tested by tariff man, and yet it's passing the test.
The economy has shown relative resilience.
What we've seen so far is evidence that the news flow on the inflation front is okay.
Already you're seeing consumer spending stalling out.
You are seeing pressure on some of the lower-end consumers. There is still some resilience, but it's more up the income spectrum.
This is Bloomberg Surveillance with Jonathan Farrow, Lisa Abramowitz, and Anne-Marie Hordern.
Live from New York City this morning. Good morning to you all. The second hour of Bloomberg Surveillance starts right now, and your scores look like this. Equity futures pulling back from all-time highs on the S&P 500. Negative so far by about 0.7%. On the Nasdaq 100, down by 0.6. The headline of the last 24 hours, this quote from the President of the United States. I think the tariffs have been very well received. The stock market hit another record high. The president looking at the equity market as an endorsement of his policies.
So this goes to a real question, and we have to ask this, and I don't know the answer. I'm going to be completely transparent. Does the market not believe President Trump's most extreme threats, is not pricing them in, or has it priced them in to some extent, right? Does this market believe that the president will back down from some of the more extreme threats eventually? And is that the reason why the market is not responding, a kind of game of chicken? Or has this market priced it in and realized it doesn't matter that much to an economy that is somewhat insulated to trade relative to the rest of the world?
Tough question. I'll use someone else's words to answer. Okay, someone bullish, constructive on this market. Max Kettner, HSBC. Risk assets are set to remain supported with lower sensitivity to tariffs because Q2 reporting season is the key catalyst. The earnings have been okay. And I think investors are comfortable with things because so far, and I stress so far, and we can have a big debate about what things look like in the future, but just an observation about where we are. So far, the earnings are still okay. The guidance coming from the likes of Delta, pretty decent, and the data has held up. On output GDP, not great, but the labor market all right. And then you look at things like inflation, and we haven't seen that firm up in the way people thought it would over the past few months.
Take that a step further. If you can't have a crystal ball because things are so murky, do you end up just saying, we can't know the future, so we can just know the present, and the present looks fine, so let's keep going with that? Is that essentially what people in this market are doing because the future is too difficult to really parse through? And that is what we're seeing in economic data, even at the same time that there is a huge raging debate among economists about how much we could potentially price in tariffs that haven't even gone into effect yet, that will go in August 1st, really spotlighting next week's CPI report on Tuesday.
Waitlist of BlackRock, I think, did a fantastic job of articulating this in the past week or so. If you're struggling to find macro anchors, and it's difficult at the moment, look elsewhere. Look to mega forces, AI. Look what NVIDIA's telling you. Look what Taiwan Semi is telling you. I've repeated this all week. Look what Mark Zuckerberg is telling you. That guy's going to pay someone $100 million to do one job, around one theme. That tells you everything about what's really dominating the top of this equity market at the moment. That's where the gains are.
It tells you everything about what your major should have been in college and what jobs you should have gone into, maybe if you wanted to get that $100 million bonus. It does raise a question, though. How much are we kind of hitting thin air in terms of the concentration of leadership? Big tech taking massive flows, almost record flows over the past week, because people can bet on that theme at the expense of everything else. How much is that muddying the signal from a stock market that is so heavily dominated by that, at the same time that the Russell 2000, more representative of the broader economy, is struggling to catch up? And that, I think, is something people are grappling with.
And underperforming again so far this morning. The Russell down by around 1%. On the S&P, negative by 0.7%. Coming up this hour, we'll catch up with Emily Rowland of Manulife John Hancock, following fresh record highs. Jeanette Lowe of Strategas as President Trump floats higher tariff rates, and Stephanie Roth of Wolf Research on a bifurcated outlook in the C-suite. We begin this hour with stocks down on President Trump's latest tariff threats. Emily Rowland of Manulife John Hancock writing, in our view, U.S. equities have the best chance globally of seeing positive earnings trends. It may have more room to run. Emily joins us now for more. Emily, welcome to the show. There was one line in your research that popped off the page for me. The year so far has been about politics and not profits. Is it about to change?
Yeah, John, luckily investors are going to be able to focus on something else other than political developments. There's a lot to take in, from the big, beautiful bill to tariff announcements. You can almost get stuck in analysis paralysis doing that. And luckily, we can focus on the fundamentals. It reminds us of that famous Bill Belichick press conference where he refused to answer questions about the loss to the Kansas City Chiefs and kept saying, we're on to Cincinnati, we're on to Cincinnati, and we're on to earnings season next week. Analysts are penciling in 5% earnings growth for S&P 500 companies. That's come down a bit, so the bar is lower. We're going from 13% earnings growth, just awesome results in the first quarter. This is going to be more about the haves and the have-nots going into Q2. So we're going to have to see which companies can deal with revenue growth slowing. Margins are starting to get compressed. Profitability here is coming under a bit of pressure. Those high-quality companies that can maintain those margins in the face of some of these headwinds, we think are going to be the relative winners as we head into the back half of the year.
From a true Patriots fan sitting in Boston, I'm sure.
That's right.
Just to follow up on some of that, and not the sport, the division between Europe and the United States. Do you see it flipping the other way in the next half?
We do, John, and there's just been this unbelievable outperformance of non-U.S. equities. European stocks are up double digits. A lot of that, of course, has been helped by the weaker dollar. But meanwhile, we've seen better relative economic growth in the United States and better relative earnings growth in the United States. This has been a big story around sentiment, capital flow shifting into Europe, a sell everything America trade. It's almost just like the U.S. is just getting a participation award, but Europe is really just outperforming and shining here. We think that potentially reverses again as investors can look at the fundamental backdrop, look at where better relative economic growth is coming in, and reallocate assets to high-quality stocks in the United States.
I'm picturing the U.S. equity markets with the Rocky soundtrack in the background, kind of trying to get that, gold medal.
Yeah.
But there is this question going forward: how much is this entirely driven by the big tech sector in the United States versus some overall optimism about the growth trajectory?
Yeah, the concentration risk is a worry again. The top 10 stocks in the S&P 500 back up near 40%, and the valuations are egregious. I mean, the U.S. S&P 500 Growth Index is trading at almost a 50% premium to its 20-year average. We still like tech. As you know, we've been overweight technology stocks in the United States for over 5 years. And because the earnings engine is on there, but you've got to find those quality stocks stocks at a reasonable price. You've got to protect against the valuation risk by owning things like mid-cap stocks, which are trading at the largest discount to their large cap counterparts since the late 1990s. We're looking at areas where you can find quality at a reasonable price. That's leading us to healthcare, utilities, industrial sectors, communication services. We're looking closely, I don't want to get too nerdy here, but we're looking closely at the PEG ratio right now, which is the PE ratio divided by earnings growth. It's basically a measure that tells you how much you're paying for future earnings growth. And we think that's absolutely critical here in a market that's continued to be dominated by risk-taking and really ignoring a lot of the kind of noise that's going on in the background.
Emily, I keep thinking about the phrase you used, analysis paralysis. It was very relatable. And it kind of raises this question, if stocks are the ultimate forward discounting mechanism of what the future will bring, how do you extrapolate out some profit margin when the tariffs are still being negotiated and people are still debating what kind of ramification they will have both on growth as well as inflation?
Yeah. It's so difficult right now, Lisa, and I think everybody's trying to handicap the impact that tariffs may have to corporate profits. There are also some positive elements as far as the big, beautiful bill around CapEx expensing. That should be accretive to corporate profits. We're seeing deregulatory measures sort of playing out in the backdrop right now. So there's sort of competing forces happening that may impact profits from here. You know, right now, I think the biggest risk to markets is that there is no risk. You look at the forward PE ratio on the S&P 500, we're at around 22.5 times forward earnings. That's close to a 10-year high. We don't look at valuations as necessarily a catalyst, but the starting point's just really tricky because there's so much good news being baked in. I know you love to talk about a high yield bond spread, so do we. We're at 268-ish basis points over treasuries. That is close to 10-year tights. We're seeing Bitcoin at new all-time highs. So investors are saying that everything is awesome and there's not a lot of risks that are going to play out here. We think that that's probably a bit overly optimistic. So I think, again, gravitating to those higher quality stocks, selling into momentum. We're starting to see a little bit of weakness on the momentum side, maybe reallocating into lower volatility parts of the market, which looks like the value play right now, makes a lot of sense as some of these risks may materialize into the back half of the year.
And yet, Emily, people seem to be comfortable because they believe the Federal Reserve will start reducing interest rates and then go even harder in 26. Yet when I ask this question, and you might have heard me ask it through the week, is this an equity market that needs rate cuts? The bulls keep responding no. Do you think it is?
No, I mean, not right now. But what you'll see, I think you're exactly right. There's a honeymoon phase where if the Fed indicates that, yes, they're ready to start cutting, and we've, heard that from a couple FOMC members this week that, July was on the table. I think what you'll see is a positive reaction if the Fed is cutting just because inflation's coming down. Look, inflation's coming down. Of course, we get a big CPI report next week, but we're at the lowest level since 2021. There's significant disinflation coming from the housing side. I wish more people were talking about this right now. Supply of homes just jumped 30% year over year. We have the most homes on the market since 2020. Demand is slowing in the face of unaffordability, untenable insurance costs. People are worried about their jobs. Major shifts happening. Home prices are starting to roll over. Shelter is 35% of headline CPI. So I think there's enough disinflation on the shelter or housing side to potentially overcome any goods-driven tariff inflation that we see, again, on the goods side. So there's some dynamics that are happening under the surface that bond investors are not sniffing out, which is why we still think that there's a lot of value at 4.38 on the 10-year Treasury yield here.
You like 10s here. Emily, do you like 30s? Can I sell? Are you a buyer?
I don't think it's the worst thing you can do. I mean, a 5% 30-year Treasury, of course, you've got to right-size that position because there's a lot of volatility there. But if you can lock in a 30-year yield around 5% and build that income stream, not the worst thing you could do in a portfolio.
We found one. There you go.
I was just about to say, you got a buyer. Good job. I'm impressed. You'll get a commission from the U.S. Treasury Department.
Emily Rowland of Manulife, John Hancock. Emily, thank you. Enjoyed this. Thank you very much. 30s this morning, 491, 10s, 438.
So close your eyes, buy everything, go to sleep, wake up in 2027 and figure it out then.
Disinflation argument was quite convincing, no? on the shelter side of things at least.
If you take a look at pricing on a global scale, particularly in some of the areas in the United States that were most bid up in the direct aftermath of a pandemic, you have seen price decreases. And you've seen volumes come down. If rates stay high, well, that's a natural consequence because it costs more to borrow money, so people are going to negotiate harder when it comes to the actual price. I know that some people are closely connected with that story.
Trying to negotiate housing costs and stuff like that. Yeah. I've been trying to do that for years, Bramwell.
So you see it in real time. So maybe prices will go down and then it'll get a lot more attractive.
Not all of us got that 2-3% mortgage a few years ago.
Yeah, but the prices were high.
Why
that's
you bring
the thing.
it? Yeah, all right.
Okay, whatever. But yeah,
well,
some
sure.
of us
Yeah,
really,
so high.
Great.
Yeah, okay. Equity futures on the S&P. Let's get back to that. Far more comfortable with stocks. We're down about 0.6%. Let's get you an update on stories elsewhere this morning with your Bloomberg brief. Here's Lizzie Burden. Hey, Lizzie.
Hey, John. Israel reportedly believes that some of Iran's underground stockpile of enriched uranium survived last month's attacks. The New York Times cites a senior Israeli official saying some of the material may still be accessible. The same official says that Israel had uncovered a secret Iranian project to build a bomb late last year. Elsewhere, Tesla's planning to expand its robo-taxi service into California and Arizona after its recent rollout in Texas. CEO Elon Musk expects the driverless cars could launch in the San Francisco Bay Area in a month or two. Tesla has also applied to operate in Phoenix, and a decision there is expected by the end of this month. And in sports, the women's singles final at Wimbledon will feature first-time major finalist American Amanda Anisimova after she upset top-ranked Aryna Sabalenka in the semis. Anisimova will take on five-time major champion Iga Swiatek tomorrow. And in the men's tournament, American Taylor Fritz will play Carlos Alcaraz and Jannik Sinner faces Novak Djokovic. And that should be my brief. John.
Thank you very much, Lizzie. Jannik versus Novak. That's must-watch later, right?
How many hours do you think it's going to be? 8?
5 at least. I don't know.
What do they eat before that?
The stamina's unreal.
I mean,
isn't it?
really, is it just a massive thing of pasta? Do they have energy gels?
Speaking of tennis, did you see Bill Ackman this week?
Yes, I did.
Thoughts?
On one hand, I admire that he put himself out there.
Yeah.
That's all I'll say.
I'm going to say Andy Roddick came out swinging. So if you want to see some comments, have a listen to Andy Roddick. I'll just leave that out there. Up next on the program, Trump presses forward.
The open question that maybe we're getting a little bit of an answer to is if you get enough resilience in economic data and the stock market trading at all-time highs, does that beholden the administration to sort of press forward with tariffs?
Up next, we'll catch up with Jeanette Lowe, strategist from New York City this morning. Good morning.
Making money isn't about drowning in emotions. It's about understanding what's actually happening. Markets are the best way to glean signal from noise, and that is what we try to do every morning. This is Bloomberg Surveillance.
Jumpstart your trading day on Bloomberg Open Interest.
2 hours of single stock stories that are driving the opening bell action. We'll take you to Wall Street, Main Street, the C-suite, and beyond.
These are companies that are growing their market.
The great companies in the U.S. are the companies hitting the cutting edge. That's a different story.
Get the inside track on what's buzzing in markets.
With the players who are shaping the narrative.
If you have bad earnings reports, you're going to get punished.
They're not buying what the industry is selling. Join us on Bloomberg Open Interest every trading day, only on Bloomberg.
Why do the biggest names in business choose Bloomberg Television?
That's a great question.
It's a very good question.
Interesting question. Good question.
Great question.
I so appreciate that question. You certainly ask interesting questions.
Bloomberg Television. Top experts, great questions.
So two-day winning streak on the S&P coming into Friday, heading towards the weekend. We're down by 0.6% so far this morning, down by about 0.5% on the Nasdaq. Lisa talked about the underperformance in the Russell. The Russell 2000 this morning down around about 1%. Under surveillance this morning, Trump presses forward.
The open question that maybe we're getting a little bit of an answer to is if you get enough resilience in economic data, labor market data, you don't start to see a move higher with any, meaningful magnitude in the inflation data and the stock market trading at all-time highs, does that beholden the administration to sort of press forward with tariffs?
It's the latest so far this morning. Stocks closing at record highs just yesterday as President Trump heightens his rhetoric on trade. The president threatened Canada with a new 35% tariff on goods and told NBC he's eyeing blanket tariffs of 15 to 20%. With those comments, equities retreating by about 0.5% so far this morning. On the latest, here's Tyler Kendall. Morning, Tyler.
Yeah, hey, John, good morning. Well, these recent moves really indicate that President Trump at the moment has no plans to retreat when it comes to his tariff plans. And our analysts at Bloomberg Economics crunched the numbers, and the average U.S. tariff rate is already up about 10.9 percentage points compared to when President Trump took office. It sits around 13.3%. So now imagine that with a higher baseline tariff rate between 15 and 20%. Not to mention some of these individual country tariffs reaching up to 50% when it comes to President Trump's updated rate. Of course, another updated escalation that we got overnight was now a new threat of 35% against Canada. Importantly, a U.S. official does confirm to Bloomberg News that USMCA compliant goods are still expected to be exempt. That's going to be absolutely critical since the bulk of Canadian imports into the U.S. are typically USMCA compliant. Data shows us it's about 60% of the goods that come over the Canadian border. But still, this isn't going to be welcome news for the Canadian Prime Minister Mark Carney, who's tried to leverage his personal relationship with President Trump to negotiate. The thing is, with Canada, as well as a lot of our other trading partners, is that the White House wants a range of concessions. Look at the letter that President Trump sent to Canada last night. It talks about fentanyl concerns, also market access for U.S. dairy farmers. But we know just the other week, talks basically went off the rails because of the White House's dismay over Canada's plans to collect revenue from its digital services tax, which it ultimately had to abandon. John, just making this picture so much more complicated, of course, are those sector-specific tariffs, which is, of course, the latest update that we can just add to the list of updates from this week. Canada is one of the largest exporters when it comes to copper, no doubt complicating negotiations as everyone rushes towards that August 1st deadline.
Those levies still to come. Tyler, thank you. If you want some comfort, Kellyanne Shaw, earlier this week, former Trump trade negotiator, came on the program, sat around the table, walked in, and she just said, get a beer, take a break. It's going to be a messy few weeks because the president's going to start anchoring to the extreme. What have we had so far? Big tariff on Canada, more tariffs on the likes of copper, and elsewhere 15 to 20% blanket for anyone who's not managed to negotiate anything.
The difference this morning is the president is now pointing to the stock market, saying he's getting a green light to go further, or to even just keep it at some of the rates that he's been announcing in these letters. And everyone gets a letter, and this is what the letter says, and the market's digesting it okay. Does that raise the ante for how much actually gets through in the very end?
Here's the take from Jeanette Lowe of Strategas, a bad company. Even if some of the tariff levels issued in Trump letters are designed to accelerate negotiations with some countries, not all countries will reach deals. Tariffs are going higher from here. Jeanette joins us now for more. Jeanette, welcome. I just want to build on Lisa's point. Do you think this record high in the equity market is a green light to keep pushing?
I think the important thing is that if you look back at what happened on Liberation Day, Trump put very aggressive tariffs on the table. We saw a sharp stock market reaction. And then you had the threats of there could be, shortages on the shelves and things of that nature, which then started to make the president walk that back. Now we have more fiscal policy. We have the tax bill, the One Big Beautiful Bill Act that has been enacted that provides some fiscal policy cushion, provides some relief to consumers and businesses with regard to the tariffs. And now we have a stronger stock market at this point. So the market isn't looking like it's as negatively impacted. So that does embolden the president to go forward and be more aggressive now. We're also not seeing inflation show up yet. But at some point, there maybe start to see some increases in inflation in the CPI data or even in company profits. And that's something else that we're watching quite closely, is to see if there starts to be more economic pain that might show up. It might not be until closer to that August 1st deadline, but that then may make the administration try to rethink how these things get calibrated.
Jeanette, I want to pick up on something John was asking earlier. How much opposition is there to some of these policies from the Democratic Party, given the fact that, it's kind of a grand experiment, and if the economy doesn't roll over and the income from tariffs really offsets the deficit, who's going to really lobby against these?
Right. I mean, so I think one of the things that's going to be important is at some point, we do have inventories that were pulled forward ahead of some of these tariffs. The longer they're in, that's going to change the makeup of this picture. So the Democrats have an issue where, they've wanted to put into effect more restrictions on trade in some ways to help trade unions in the United States. Maybe not obviously to the extent that Trump is doing, but it does bring up the question of how do you then roll these back? I think there is definitely a difference when you saw the Biden administration able to keep the tariffs on China in place that Trump imposed, but that's much different than putting in, say, 20% tariffs on EU goods or 35% tariffs on Canadian goods. So there can start to be that pushback there. And you did see, obviously, earlier this year, Tim Kaine, senator from Virginia, put forward legislation to kind of walk these back. That did not pass, but that is something that they're probably going to push again. And if we do see more economic slowdown because of the tariffs, that could be something that then gets more traction later on.
We initially thought coming into this year that this would mostly be about China and the rest of the negotiations would be fairly easy. That, of course, has been significantly challenged, and now we have the potential for some sort of additional meeting between Chinese and U.S. delegates in the next couple of days. At the same time, that the tariff rate on Canada seems to be similar to the one on China. How do you make sense of this? What's the ultimate goal when it comes to China?
Well, I think we do still have to keep a difference between what is happening with China and what is happening with the rest of the world. One of the things, obviously, Trump did say that the Canadian tariffs were based on fentanyl, but also other things, other market access issues, mentioned dairy in the letter. We have actually seen more fentanyl coming across the border if you look at the most recent customs data. So that could have been an impetus for this. The digital services tax was also an irk for the Trump administration that they wanted to get taken away. But I think that they're ultimately, if we still have this carve out for goods that are USMCA compliant, that is significant. I think there's going to probably be a push to get more goods to fit that USMCA compliance setting so that they would be able to enter the U.S. tariff free. But there's definitely still a difference with China. If you look at China, we still have tariffs from Trump's first term. Those were never removed. Those were kept in place by Biden. They were actually increased. Trump has now increased them even further. And if you look at a lot of the trade deals or the discussions that have been occurring with the administration and other countries, it's also about country of origin. Is China putting goods into Vietnam that then get shipped to the United States? That is something that the White House would like to stop. So we still think that there is much more aggressive tone towards trade with China and trying to get production out of China and into other countries or back to the United States. And that is still going to be a difference going forward, regardless of the talks that may happen.
Jeanette Lowe of Strategas, a bad company. Jeanette, thank you. That last point is so important. We talked about this quite a few times on this program. Democrats complained about the president's tariffs in his first term, kept them. In some places, put them up. That's going to be the test in the next general, because what you're also going to see this time is some real tariff revenue. If these levels stay, it's going to be hard to campaign against that.
Especially if that means raising taxes on the other side or else having a larger than expected deficit. This is the conundrum that the next election will be debating about.
Years away.
Yes, exactly.
Don't have to think about that right now.
1.5 years.
Up next on the program, Erica Najarian of UBS as JP Morgan CEO Jamie Dimon warns markets are too complacent, plus Yahira with your morning movers and a downgrade for a top name in the copper industry.
flood of investment agreements.
Deals were once again on display.
The Saudis are open for business.
The cessation of sanctions against Syria.
Another big victory for the Crown Prince. Concerned that none of the guardrails may be set up just yet.
Headline after headline. Trust Bloomberg for on-the-ground coverage.
The numbers will be quite substantial.
Up-to-the-minute reporting.
Driven the price of oil down.
And the analysis you need.
He's basically going to vault this region into the same sort of sphere as the US and China.
No one covers geopolitics like Bloomberg.
Good morning. This is Bloomberg Surveillance.
Welcome back to the opening trade. Watch Bloomberg Tech. This is the Asia Trade.
This is Wall Street Week. Welcome to Balance of Power.
This is Bloomberg Television. It's a multi-trillion-dollar industry. We'll show you what's happening in ETFs like no one else. ETF IQ, only on Bloomberg.
Technology is embedded in every aspect of our lives.
And laying the foundation for the future.
From finance to defense, AI to entertainment.
And from the road to the stars. Bloomberg brings you the latest stories of the people and companies pushing the tech sector to new frontiers.
And the politics that shape global tech markets.
I'm Caroline Hyde in New York.
And I'm Ed Ludlow in San Francisco.
Watch Bloomberg Tech every weekday.
Only on Bloomberg Television.
Through Thursday, coming into Friday, so as of the close just yesterday, stocks and bonds almost totally unchanged. Yields on a 2-year, unchanged. 10-year, unchanged. This equity market basically unchanged, positive 0.02%. This morning, pulling back by 0.5% on the S&P, by 0.5% on the Nasdaq. This week was a good week to take a vacation. In the bond market, it is interesting. Nevertheless, let's split this up in two, the front end and the long end. Some comfort this week at the long end of the curve. Brought to you by two auctions, 10-year and 30-year supply went okay. So let's move on. Front end of the curve. I'm not saying we won't talk about it the rest of the year, we will. At the front end of the curve, a big debate starting to emerge. All of a sudden, I think we are talking about real dissent in July. There were some people who saw the FOMC minutes early this week and said they were dated because we just had the jobs data, which would make it difficult for the likes of Governor Waller to make an argument for a rate cut at the July meeting. Governor Waller came out yesterday and essentially told you there's a decent argument for a July rate cut.
And a lot of people in the market agree with him. And I think this is important, even as he pushes back and says, look, this is not political. We are seeing disinflation around the margins. There are people in the markets, including in BlackRock's David Rogel came out with the FOMC meeting minutes and said that easily they could see a July rate cut simply because the inflation data has been relatively benign and there are signs of a slowing in the labor market. This isn't necessarily political, but it's going to be framed in a very political way.
Bond yields this morning are higher on a 30-year, up by 4 or 5 basis points, 491. We'll never move on. Highest yields on a 30-year, going back to 2011 in Europe, in France, in Germany. European story still brewing. 2 hours away from the cash open in the equity market. Let's get you some morning movers. Let's cross over to Yahira. Hey, Yahira.
Hi, John. Any wavering you're seeing in the equity market is not showing up in crypto. Take a look at these crypto-linked stocks. Coinbase, MicroStrategy, Mara Holdings, and Bit Digital are all rising after Bitcoin surged to new highs, now topping $118,000. What a run. Next up, we have Freeport-McMoRan. The stock is down 2.25%. I've mentioned the American mining giant a lot this week. That's because it was thought that it would stand to benefit from President Trump's 50% tariffs on copper imports. But UBS just gave it a downgrade. It is now down to neutral. Analysts there saying that they expect a softening in demand and fundamentals to weigh on copper prices over the next 6 months. So throwing a bit of cold water on the optimism there. And we end with SoFi Technologies. The stock is down about 1% after TD Cowen started coverage on the stock, giving it a hold rating and saying that the stock looks fairly valued from here. But this stock has had quite the run. It is up nearly 40% in the past month as investors caught wind of potential policy changes coming to student loans that could funnel billions of dollars to private lenders like SoFi. John?
Yahara, thank you. More from Yahara in the next hour. On a radar this morning, President Donald Trump threatening a 35% tariff on some Canadian goods. The announcement coming after he told NBC News he's eyeing blanket tariffs of 15 to 20% on many trading partners.
I keep going back to my big question. Is this stock market pricing these tariffs in and saying it's okay because the stock market is not the economy and it's a lot of big tech stocks that are relatively immune? Or is this stock market betting that the president's going to back down? And if it's the latter, then how much does it set up a big game of chicken between the president and the markets where there is a clearing point, and we could reach that